So we'll watch what happens with gilt yields and what that does to UK house builders today. Was that all yesterday's move? We will see. Siemens in focus. This is on the lifting by US regulators of chip export licenses to China. So we'll watch Siemens and others. And Ryanair having to cancel some flights, Guy, 170 flights, in fact, due to air traffic control strikes in France.
I can hear the steam coming out of Michael O'Leary's ears at the moment. The frustration with the first wave. French ATC, always an issue for him. Anyway, let's talk about the opening wave here for the market. As you can see, the FTSE 100 is up a little bit this morning. Remember, it is mechanically dispositioned to be moved by what is happening with sterling, but it doesn't seem as if that is the factor that is affecting things this morning. Looks pretty much in line with everything else. The IBEX is up by 0.2%. The FTSE is up by 0.2% as well. The DAX, wow, there must be no news in Germany this morning. It is out early this morning and up by 0.4%. The CAC is up by 0.3%. You do wonder actually whether equities are the place to look this morning. There are plenty of assets that you should be focusing on. Are equities the place to be kind of focusing your attention today? I suspect the bond market, what is happening in foreign exchange, may be a bigger factor a little bit later on. But you could see, potentially you could see a big reaction in equities, particularly going into a long weekend, if we do see an outsized print either way when it comes to NFPs a little bit later on. Let's talk sectors. Let's figure out what is happening there. Critty, over to you.
Absolutely. We are seeing a broadly green on the screen this morning when it's in the sector perspective. I'm trying to find the underperformers, and really they're all concentrated in the utility sector, which I think is fascinating. If you're thinking about a defensive trade, utilities is the outperformer, which tells you this is a risk-on market right out of the gates, at least when you look at the FTSE 100, or at least, the Stock 600, but also the FTSE 100 as well. I'm waiting for a more dramatic reaction from the last 24 hours, Anna, and I don't see it.
Well, we'll go to the gilt market for some drama, shall we? We saw big moves higher in gilt yields yesterday, up by 16 basis points on the 10-year horizon. Today, we take back some of that, unwinding around a third of yesterday's moves. We just take it in basis points, simple terms. So the 10-year yield on gilts down by 6 basis points this morning. So we are reversing some of those moves, those words from Keir Starmer saying that his Chancellor will be with him for years to come. Seems to be enough, at least, to calm the markets in the very short term, but crucially not taking us back to where we were, either on the pound against the euro or on gilt markets. So some level of nervousness, and linked to that then, we are seeing some real estate stocks gaining a little bit, but similarly not recouping all of the losses of yesterday. Some of them are down more than 3.5%. Today, the likes of British Land, Seagrow, Shaftesbury Capital up by less than 1%.
Does the market believe that Rachel Reeves is secure? Not entirely convinced, looking at the price action this morning, that there's a level of conviction in that. So maybe it's just a time thing. Do we need to wait longer? Do we need to watch and see what happens here? I don't know. It's going to be an interesting one to pay attention to, Critty, in terms of the sensitivity the UK market has to the politics that exist here in Britain.
Yeah, absolutely. And I think this is really crucial as we talk about what some of the individual kind of factors are. Where does this get priced in from an equity perspective, as we were talking about from a bond market perspective? Because again, coming back to the FTSE 100, I'm not seeing a ton of that reaction as well. If you look at the broader market, though, you do see some reaction, like the Siemens. That is, of course, going to be a story that's related to the trade, to the chips, and that conversation. We're going to dive into that read through in just a moment as well. I'm seeing a little bit of underperformance from the commodity sector. Rio Tinto, NL, however you say it, is seeing being a little bit on the back foot. But again, it feels like a light volume kind of day. It feels like a macro story to me. So let's bring in a true expert here. Henry Allen, macro strategist at Deutsche Bank Research, joining us around the table. Henry, let's pretend the market hasn't opened just yet and talk about what's going on in the UK. Because I think this is fascinating that we're seeing, it doesn't feel like that much of a reaction function. What's going on here?
Well, I think the market's been really reassured by Keir Starmer's words overnight that, he said that Rachel Reeves is going to be in a position for many years to come, as was said. But I don't think the market reaction is actually to the person of Rachel Reeves or even her position. It's what she represents, because Rachel Reeves, as Chancellor, and indeed when she was Shadow Chancellor, made a big play that we are not Liz Truss. We have these very strict fiscal rules, at least in her narrative, that they were going to stick to. And what the bond market is concerned and why it sold off so aggressively wasn't because Rachel Reeves per se will lose her job. It was that the new Chancellor, whoever that might be, and we're already seeing this pressure from Labour backbenchers in the media, might ease the fiscal rules, which is in essence code for borrow more money, and then you risk the kind of Liz Truss scenarios that we saw 3 years ago, or at least edge closer to them.
Well, we've been talking throughout the show about whether this kind of UK freak out, if we will, in the gilt market yesterday is a canary in the coal mine for all the other deficit issues we see around the world. But before we get to the bond market, why is the equity market not reacting more? And I'm not just saying this to the UK drama, but also you're seeing deficit issues in France, in Spain, in Italy. You're seeing it in the United States, and the equity market is looking through it. What changes that?
So I would disagree slightly with that because, yes, actually yesterday the FTSE 100 did underperform the rest of the European market. And actually, if you look at the FTSE 250, which takes not the 100 biggest companies, but the 101st to the 350th biggest companies in the UK, that actually had its worst day yesterday since the Liberation Day turmoil in early April. And that's a more domestically focused index. So I personally don't entirely believe that the equity market, particularly the domestically focused stocks, are entirely looking through that. I think there is a lot of nervousness because the government have kind of boxed themselves in. They've said they won't breach these fiscal rules, but then they've also said that they won't raise a lot of the major taxes like income tax and VAT. They've proven it's very difficult to cut spending. We've had the U-turn over welfare. We've had the U-turn over the winter fuel allowance. So the market is thinking, how on earth do they get out of this? And it's not obvious which way they turn because every option seemingly is unpalatable.
Henry, so we're in an interesting place where our guest in the last hour said that some areas of corporate credit look like a safer bet, more attractive options than government yields right now. How would you look at the two and the sort of relative risks when we're talking about a period post-COVID where government debts went up and corporate balance sheets have been repaired?
So I think the risk right now on the credit side is that spreads are still very, very tight by historic standards. So
complacent.
Yeah, and I think, to be fair, with the broader kind of cross-asset moves, the S&P 500 at record highs, European equities also close to record highs, I think there is that complacency. I'd be a bit reluctant to say that spreads can go much tighter than here, given how close we are to the kind of post-global financial crisis tights. But clearly, I think that there's a nervousness among long-end bond yields throughout the world, not just in the UK, but more broadly. We've seen that in various auctions that have gone badly. We've seen that in France. There were big jitters over their deficits last year following the elections. That still hasn't been sorted out. Obviously, Germany are now making a big push on the fiscal side. There's nervousness in Japan over their debt, and of course, with the tax bill going through the US. So pretty much every G7 country has this problem. And I think it's a reflection of the fact that, countries don't need to be at the mercy of the bond market at the end of the day. The problem is, as the UK and the US both show, is neither country has run a budget surplus since the early 2000s. And if you want to spend more than you tax, that's a decision you can make, but that in and of itself is going to make you at the mercy of bond investors to some extent. And until that changes as a political choice, we're still going to be trapped in this dynamic.
Yes, and the gilt market sending quite clear signals yesterday, which no doubt will echo in Downing Street to some degree. Henry, the other thing we're preoccupied with right now is tariffs out of the US, and we are trying to get our heads around the latest news flow and what it tells us about where the tariff conversation goes. So we've had this example of Vietnam, a 20% tariff there, which is higher than where we are now, 10, but it's lower than 46, which had been talked about at the beginning of April. Are we getting closer to understanding the landing zone for these tariff conversations? We've got the UK, we've got Vietnam. Do we have a sense of what the end game will be yet?
I think we're getting a little bit closer. So, for example, the fact that even the UK still faced that 10% baseline tariff was instructive because the UK is a country that has fairly balanced trade with the United States, and it's also a US ally. So even a country like the UK couldn't get those tariffs lower than 10%. So that 10% baseline does seem to be something of a flaw. But then also you've got China, which of course is Trump's big target. He's attacked them for their trade surpluses. They're obviously a strategic rival. Even there, though, Trump dialed back those tariffs from a high of 145% all the way back to 30%. Clearly, that's only for 90 days, I'm conscious, but the fact he did that was indicative. So the landing zone appears to be in this kind of 10 to 30%, and Vietnam having 20% kind of seems to fit into that pattern that if even kind of a notional US ally like the UK and then a rival like China, between 10 and 30%, that seems to be
It's a big range, though, isn't it? If you're a business that produces a lot in Asia and you're trying to ship it to the United States, you don't know what to assume at this point.
Yeah, assume nothing, because everything changes so fast at the moment.
Yeah.
Well, does it? Equity markets, if I just looked at the equity market, I would assume that everything is great. There's so much noise in my head at the moment about all the different things that are happening. What's the UK? What's happening with the tariff story? What's happening with the rates narrative? Will Powell keep his job? Will he not keep his job? Who's the next Fed chair? There's so much going on. You know, I look at the equity market, and if I just looked at the equity market, I would think that everything's great right now. Explain to me why we're in the scenario that we're in, with equity markets looking good and volatility as low as it is.
I think there's a couple of reasons. So one is that the macro fundamentals are still pretty robust. And actually the fact that the data, the hard data, has been so resilient since Liberation Day has meant investors have felt there isn't going to be a recession. We had that big sell-off mainly because investors started to think there would be a recession. The fact we're not getting that is very promising. The other thing that I think is keeping a cushion on things is that policy, whether that's tariffs or fiscal policy, is to some extent endogenous to the system. We kind of treat it as this exogenous variable, but actually every time that we've seen issues, for instance, the turmoil after the tariffs, the turmoil with fiscal policy, consistently, policymakers have rowed back. So actually, I think the market is actually acting as a constraint on policy and preventing outcomes that would lead to a bigger deterioration in those macro fundamentals. So as long as that remains the case, and policymakers kind of remain in this channel whereby they, from a market point of view, are considered sensible, then I think the all-time highs can continue.
So I can turn the television off. Don't
say that, guy.
I know.
Nope.
I can cancel the news feed. I can do all of these things because it doesn't matter, because I just need to look at the equity market, because the equity market is correct in assuming that, all things being equal, policymakers aren't really going to upset the apple cart. Is that that's the essence of the trade right now?
I think so, because it's not in these policymakers' interests for the apple cart to be upset. At the end of the day, these are politicians who want to get re-elected. They want to be popular. Trump doesn't want a huge wave of inflation from tariffs, having seen what inflation did to lots of governments around the world who weren't re-elected.
But he's changing immigration massively. There are factors that seem to be that have yet to show. Is it just that they haven't shown up yet? The impact?
I think there is some element of that. I mean, and certainly I'm conscious the inflation experts have always said, look for the impact in the June and July CPI data. I'm conscious that's July 15th, that CPI report. But, we've had 4 downside CPI surprises in a row. So I think the market is thinking, if we can get another downside surprise, if we don't see an obvious impact from the tariffs, that keeps the door open to Fed rate cuts, and then the rally can continue. So, the fundamentals are in place. When the Fed are cutting into a soft landing historically, that's been a tremendous scenario for risk assets.
That's what we're seeing right now.
I feel a lot better now.
Precisely.
So thanks, Henry.
Yeah.
Thanks for that.
No
okay, Henry Allen, a macro strategist at Deutsche Bank Research. Thank you very much indeed. Let's talk about what the Core 6 looks like and figure out where we're going next. Joe, what do you got?
Today, because we are seeing a little bit of positivity in that one today. We're up around 1.5% at the moment. This tied to this news overnight that the US removing this restriction on chip design software, and Siemens being one of the key firms that is actually producing this software, along with a couple in the US, which we'll have to watch in US trading as well. So a bit of a boost for that one. It's worth a few $100 million was the estimate I saw in terms of annual revenue for that unit. Then we've got these home builders in focus, as Henry was discussing a moment ago. It's all about whether or not the UK borrowing will have to go up, given what we saw yesterday. Potentially not so much about Reeves' position herself, but whether the gilt yields are going to remain elevated. And we saw a big drop down in the home builder stocks yesterday. At one point, they were down the most since 2022, so the biggest drop in a few years for those stocks. Coming up very slightly, but on a 2-day basis, still down the most in around 3 or 4 months for those stocks. But a bit of a boost, a bit of a relief today. Then over in pharmacies, we've got Redcare Pharmacy. This one outperforming in Germany on better sales. A lot of uncertainty on that one at the moment around new regulation coming in on prescription drugs in Germany. So it's had a bit of a volatile run, but doing a bit better on the sales for Redcare at the moment in Germany. Then back in the UK, we've got Watches of Switzerland. This one catching me by surprise this morning because the calls look pretty solid on this. The sales looked okay, but I've been speaking to traders in my IB and they're saying that the margins do look soft, predicting margins down 100 basis points in the year ahead. They're expecting them only to be down around 20 basis points. So that does look very soft. It's really the Rolex trade. So the only way to trade Rolexes in terms of the stock market, pretty much across the world, being the only listed seller of Rolex watches. So it's an interesting stock to watch. Then in terms of the broker calls, Rio Tinto, that one downgraded. Critty mentioned the decline in that one earlier. That is cut today at Berenberg due to weakness in iron ore prices. So they come down to hold, and Rio slipping very slightly. And then finally, Nordic Semi was an underperformer in the semiconductor space because Bank of America thinks consensus estimates are too high on a number of semiconductor stocks at the moment. Nordic Semi in particular, they go underperform on that one, and it's falling 4% in Oslo this morning.
All right, Joe Easton from our equities team, we thank you so much for walking us through some of those early movers of the session. Joe was going into the micro there, but when you look at the broader indexes, you're not seeing a ton of action this morning. Where's the drama? Are we just used to the drama?
We're going to a long weekend, and we've got payrolls coming up.
Yeah, fair.
What do you want to do this morning? Do you want to take a big position? I don't know. I'm not sure that anybody's going to be sort of massively long risk.
Yeah, and the rollback in the gilt yield spike of yesterday
Yeah.
is sort of gathering pace a little. We're down 6 basis points.
We recovered about half of it.
Yes, roughly, almost. So we do seem to be retracing at least yesterday's drama, if that counts as a small drama.
I think we'll take it. I'll take it. Absolutely. I think it's also another key piece is that we broke Swiss CPI earlier in the morning. We should mention that the Swiss is at session highs. And in fact, as we've kind of gone through the rest of the show, we have seen continued weakness in the euro, the pound, and the dollar against the Swissy. Speaking of currencies that perhaps aren't or are depreciating against the dollar or moving against the dollar. Let's talk about some data that's hitting the wire as we speak at the moment. This coming out of Spain, the June services PMI rising to 51.9 reading. The forecast was 51. Now, this is significant, of course, because when we look at some of the Spanish data, we have seen it be in expansion territory for quite some time. Not a ton of reaction in terms of the euro, but Spain is the exception to the rule of some of the data that you've been seeing across the board in Europe. When you look at that and break it down by services, you're looking at a services number, that was a services number. The composite is coming to 52.1. The forecast was 51.2. On the surface, Anna, these are some good numbers.
Yeah, and we've been asking lots of times whether the American tourists who were such a big boost to Spanish, Italian tourism last year, whether that would continue with what we're seeing in the dollar. We'll dig into where the services boost is coming from. Coming up on the programme, Siemens says it's received notice that some US chip curve restrictions to China have been lifted by the US administration. We'll have the latest on Trump's trade deals and chip restrictions. That's next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Foreign and Central Portugal, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Welcome back. 20 minutes into the session. We are pre-NFPs, non-farm payrolls, over in the United States, and we're pre a long weekend over in the United States as well. Probably means things are going to be quite quiet today as we work our way towards both of those two events. We are obviously watching what is happening in Washington and the big, beautiful bill and what future it has as well. So there's a lot to think about this morning. One thing we are a little bit more certain on is what is happening in the chip space. We do have some easing of restrictions when it comes to what is happening with the restrictions out of the United States into China. That's having a positive effect, as you can see, in terms of some of the chip stocks here in Europe. You've got Siemens trading a little higher, Infineon's tracking a little bit higher as well. So some positive effect coming off that. This, as the Trump administration has lifted some of the recent export license requirements for chip design software sales in China. Washington and Beijing obviously implementing a trade deal for both countries. There's an easing of restrictions on critical technology around rare earths out of China and chips into China from the United States. Mackenzie Hawkins joins us now. Mackenzie, let's just kind of talk me through why this is happening. Is this part of the deal that was recently done? And how much does it unwind what was there before?
So the U.S. in May imposed export restrictions on a range of critical technology shipments to China, not just semiconductor design software, but also jet engine parts, ethane, nuclear materials. And this was because Washington was dissatisfied with how many rare earth licenses Beijing was approving for export to U.S. companies. And we had several weeks of ratcheting up of controls leading up to these trade talks in London last month, at which the two sides agreed we will mutually lower these restrictions as long as one another allow the exports of materials that we think are really important. And so the U.S. has started to actually do that this week. They lifted restrictions imposed on electronic design automation software, which is what's used to actually design chips made by everybody from NVIDIA for AI components to simple power generation components. And also they lifted controls on ethane, a class of natural gases used in plastics production.
Talk to us about what this means for the strategy as a whole, Mackenzie, because as we are watching some of these restrictions at least curbed in the States, there's still a big, big push in terms of investing in stateside chip manufacturing. You're seeing that as the one big, beautiful bill. It's a key component of it. What does this mean for the strategy as a whole?
So the U.S. has for years been trying to limit China's ability to develop a robust domestic semiconductor industry that could allow Beijing to access advanced AI and benefit its military. We've seen several escalating restrictions on the sales of advanced chips themselves, also the tools used to manufacture them. And initially, it appeared that the restrictions on chip design software were following that same trend. But they only stayed in place for under 2 months. And this was the first time that the U.S. has sort of explicitly made export controls, which have historically been treated as a national security policy that's non-negotiable, something that's on the table in trade talks with Beijing. But Washington has drawn a clear line. They've said that the controls that preceded these earlier trade talks with China in Geneva are not on the table. Most importantly for Beijing, access to NVIDIA's most advanced AI chips.
All right, Bloomberg's Mackenzie Hawkins, we thank you so much walking us through some of the dynamics and developments around the chip trade. As Mackenzie was speaking, we got some headlines coming from China, actually commenting on the dynamic between Vietnam and the deals coming out of the United States as well.
Yeah, absolutely. So China's saying it opposes any trade deal that infringes on China's interest. And this is relevant in the Vietnam-US context because the United States has imposed tariffs on Vietnam, of course, 20%, but also they have this transshipment tariff, which is seen as being something that will impact on China's ability to put product through other parts of Asia into the United States.
Very hard to police.
Very hard to police. and China very creative in trying to find ways to do that through other geographies, perhaps seems to be one of the read-throughs from our reporting this morning. Let's go from one thing that has captivated the markets, that is trade tariffs, to something else that's firmly in focus for us over the past day or so, and that has been the UK gilt market. We're seeing a bit of an unwind in yesterday's move in gilts. Gilt yields are down this morning, 6, 7, 8 even basis points at the longer end of the UK gilt curve. So unwinding around a half of what we built up yesterday in terms of that gilt yield. Let's bring in Bloomberg UK Markets editor Moena Coniam, who can give us some perspective on what we're seeing here. I'll start with gilts, because we just showed what's happening with the gilt move. I mean, we're sort of unwinding half of yesterday, I suppose. So what's your takeaway, Moena, from the market's response on day 2?
Well, it is unwinding. Things are looking better this morning. We've seen the 30-year yield coming back about 6 basis points. But yesterday, we ended the day down about 19. It fell a little bit more than that earlier. Sorry, up 19. And that is a really big move. And it was sparked by a lot of speculation, a lot of concerns which are based in real maths, but that have been festering there for a long time. And it really just showed how fragile the market's perspective of the UK economy is. Yeah. That, we saw this in January as well, when there was very little concrete information, but sort of got itself into this frenzy. And that's quite worrying in itself. Now, things look better this morning. Obviously, Keir Starmer has come out and really fully backed his Chancellor, Rachel Reeves. But the question remains as to what was going on in the first place. And the market really didn't like that question of uncertainty at all.
So what are we doing now? Are we just reading tea leaves down in Westminster, trying to understand what is going on? How do we do that? What am I watching for in terms of my understanding as to whether or not the support around Rachel Reeves is real?
Well, we have to see what happens today. I think Keir Starmer did make it quite clear in his interviews late yesterday, and I believe there's been more this morning, saying that she's going to be in that job for a long time. Of course, that's something that somebody has to say, and you can't ever know what's going to happen. I think what the rest of the Labour Party does in terms of, behind the scenes, the discussions that are going on will, of course, bear a huge influence, what comes out, what gets leaked to the press, and really whether we hear a bit more about what really was going on yesterday.
That'd be nice.
And then we're just looking towards the budget.
Yeah.
I mean, that's when actually all of this will come to fruition in terms of what options does the Chancellor have. Her fiscal headroom is incredibly tight. The U-turn on the welfare bill has not helped her position in terms of actually making the sums add up, and the market knows that. But, she has stuck to her fiscal rules. In the past, she said she doesn't want to raise taxes. There aren't very many options, and we'll have to see which way things go.
Bloomberg's Moena Coniam walking us through some of the budget restrictions in the UK. In the meantime, as she was speaking, we did get a headline crossing the Bloomberg terminal. Trump tax bill clearing the House procedural vote. Looks like a green light when it comes to the actual bill itself. We will keep you posted as we get those updates. Coming up, an exclusive conversation with the head of wealth over at Citi. Stick with us. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing,
you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We do have some headlines crossing the Bloomberg terminal at the moment. The Trump tax bill crossing a procedural vote. Now, we had started this program about 90 minutes ago with 5 naysayers, 5 people who said that we are not going to move forward with this procedural vote at all. It looks like now that we have gotten there, we are actually seeing potentially a green light for the one big, beautiful bill to actually cross. And I think this is very significant because the concerns here was that it actually increases the deficit by something like $3.3 trillion on top of a $36 trillion price tag we already have. So lots going on there. We're going to keep you apprised of all the developments out of Washington, D.C. as we get them. You can see a late night for some of the congressmen over at Capitol Hill. Not much market reaction off the back of that, though, but it is something that is talking a lot about in terms of where the U.S. stands, how the rest of the world is viewing the United States right now. I think we have the perfect guy to have that conversation with. Joining us for an exclusive this morning is Citi's head of wealth, Andy C., who has come on a whirlwind tour, coming to London, just meeting a lot of clients here in Europe. But I've got to ask you, how are the clients here in Europe viewing America right now?
Well, I mean, I think they see the strength of the leading U.S. companies, of course. They've got an eye on the deficit topic that we talked about in the medium and longer term. I think the tax bill itself is making its way through Congress basically as expected, and on the margin is stimulative. But, you know, you can't discount the U.S. economy. It's obviously the force in the global economy, the level of talent, innovation, capital in the U.S. economy is unmatched around the world. And while, you know, this has been a roller coaster ride in the first half, investors come back to understanding that there are companies in the U.S. that just aren't matched by their peer set around the world, and they're investing behind them.
There's a big question, there has been a big question, especially from a lot of ECB central bankers lately, who've been talking about this idea that, okay, maybe the U.S.'s turn is over. This kind of structural reallocation is here to stick because Europe has some new fundamental growth drivers when it comes to Germany, when it comes to perhaps the hope of a little bit of deregulation. Are you seeing that? Are you seeing in the clients you're speaking to some of the perhaps warmth around investing in Europe?
Well, I mean, I think we are seeing that. I don't think we should be surprised. We came into the year with U.S. equity markets as a unprecedented share of global markets, and obviously trees don't grow to the sky, and so to see that trend to tail off is not a surprise. We do see more interest in the U.K. and in U.K. investors. Actually, in the first half, our business in the private bank, the investments business grew most rapidly here in Europe in the first half, so it's been a very active time with clients. You know, what we're hearing in corporate boardrooms is very upbeat. We see discussions, that we see our M&A pipeline and M&A dialogue very strong across the investment bank. My colleague Viz Raghavan and team are super busy here in London specifically and across Europe. And so I do think this is a dynamic time in Europe. And, you know, and on balance, as the proportion of U.S. exposure in client portfolios has reached highs, we do see incremental dollars being invested in Europe.
Do you see a difference? Good morning, by the way.
Sure. Good morning.
Do you see a difference in the approach being taken by US clients versus rest of the world clients?
Very much.
Okay.
Yeah, very
Just explain
much.
it a bit more.
Well, there's a tremendous home bias among U.S. investors.
Yep.
I mean, we've been talking to U.S. investors about being more globally exposed for my whole career, almost 35 years, and still U.S. exposure is pretty limited. When we leave the U.S., everybody's a global investor outside the U.S.
Yep.
And so the dialogue that we have is much more about, global asset allocations, the conversation we were just having around, hey, where do you go at the margin? It comes up very rarely in the U.S., honestly.
Okay, so how do you build a business for that? That increasingly, is it increasing differing approach? How do you build Citi Wealth to take account of both of those two pools of investors that feel like they have very different objectives in terms of what they may be looking for?
Well, I mean, hey, to a certain extent, Citi was built for this. Obviously, our headquarters is in the U.S. We're deepest, in the U.S. and in New York. But this is the world's most global bank. And so the fact that we have, the dynamism and the insight that comes from being a U.S. bank, but we've got truly global DNA is what our clients are looking for.
So you are set up for the world that you feel we're going towards. You don't need to change anything, is it?
Very much. I mean, you think about Citi's global network, to the extent that volatility is rising, that some of the questions that we've been talking about are on the minds of investors. How does geopolitics and some of the rebalancing of global exposures, how does that come into bear with portfolios? Citi's the place to go to have that conversation.
And I can ask you a bit more about what you said there about the UK. You say you're seeing a lot of interest in the UK. Unpack that a little. Is that interest in UK assets, or is that from wealthy people in the UK interested in talking to you? What's the UK driver?
Well, I mean, first of all, the UK is the hub of our business across the region. We just had 200 private bankers and investment counselors here in the UK for our annual get-together of that team. This is the logical place to do it. Our business is growing strongly in the UK. Obviously, policy changes in the UK and across Europe are top of mind for clients, and we see topics like the non-dom discussion very much on the mind of clients, and they look to Citi to have particular insight there. We also see clients around the world who see the UK as a very attractive place, to be investing on the increment. I mean, I recently had a conversation with a client in Hong Kong who has moved more assets to the UK for a very simple reason. Property rights have been respected in the UK for 1,000 years, and that stands out globally. And so that's something that's very fundamental, but easy to forget.
Okay, yeah, that's really interesting. That sort of longer view on certainly one UK asset in particular around property. But we do hear a lot about non-doms leaving, or the wealthy feeling more mobile and perhaps incentivized to leave the UK by policy changes. On the other hand, some of those, the wealthy want to go to the Middle East, and then you get flare-ups in violence in the Middle East. And I wonder how that factors into conversations. What do those conversations look like?
As you would expect, incredibly unique to each client. There are clients who are anchored here in the UK, and almost regardless of tax regimes, they're going to be here in the UK. This is their lifestyle. There are others who may have global businesses. They're here in the UK, and they're worried about topics like inheritance taxes, and is it going to push them to a position where they might have to make a decision about their holdings in a company, which is really not consistent with what their next generation would like to see in terms of bringing that company forward. We see for every conversation we have around UK-based clients that are thinking about, is this the time and moment that I might want to relocate? We see other clients who are thinking, hey, the UK, as I said earlier, may be a very attractive place. They're looking at the U.S. and changes in the U.S. and thinking maybe the UK is the place where my kids might want to go to college, where we might want to spend more time. And so it's a two-way trade in terms of clients in and out of the UK.
Andy, let's talk a little bit about how Citi specifically is approaching this rather than the macroeconomic environment. We should remind our global audience, you joined Citigroup, and it's about September of 2023, with a pretty big project in terms of turning the bank around, and specifically wealth, where we know Jane Fraser says a lot of the gains are about to come from, the next leg of growth for Citi is about to come from. What's been the hardest part of that job, of that restructuring?
Well, as you said, Jane has been leading here a very broad-based restructuring of the company. I only got here 18 months ago. This has been going on for a number of years. Citi is on the move. This is a bank with tremendous heritage and unmatched global platform, and today has a strength and momentum behind the company that we haven't seen in decades. Coming into the wealth business, in many ways, my job was, how do we take an extraordinary set of ingredients and turn it into the number one wealth franchise in the world? And those ingredients are the brand, a client franchise around the world, talent and platforms to be extremely flexible and serve clients in all jurisdictions. But the business had been underperforming over the last 7 quarters. Revenue's now rising, expenses are coming down, returns are rising. We haven't reached our goal in terms of being #1 in wealth management in the world, but we've got one of the fastest growing wealth businesses around the world, and we do things for clients that stand out.
Jim Farley over at Ford overnight talks about the fact that he thinks half of all white-collar jobs at the business are going to disappear as a result of AI. What's the number going to be like at Citi? What's the number going to be like at Citi Wealth? How does the wealth business take this technology, adapt it, use it into a business that is quite extremely client-focused and the relationship matters? How different is the AI story at Citi versus, say, a Ford? And how are you thinking about it? How big a change is going to be? Is it going to be Farley-like in terms of the kind of shift that we're potentially going to see at the way you operate the business?
It's somewhat of a different story than a manufacturing company like Ford. I mean, we don't expect the person-to-person interactions that happen between our bankers and advisors and clients to become fully automated anytime soon. AI is an extraordinarily powerful tool for this business. It's going to reshape our workforce. What we see happening here, though, is to take many manual tasks in the middle and the back office, to automate those and give us the ability to add more resources to the front end of our business and have more advisors, more bankers, more investment counselors in front of clients. So I think
you hire more at the front end and less at the back.
Correct. I think employment levels are going to be relatively constant in the wealth business, but I think we're going to see that balance between how many people are in front of clients versus how many are behind the scenes shift in terms of giving us more bandwidth in front of our clients. Again, that's a terrific story in terms of growth and efficiency, returns for shareholders, and just how active and present we are in markets. I also think when you look at the last 30 years, the story in wealth management has been a very powerful one for clients. Rising quality and lowered costs. AI is going to continue and propel that story forward. We're going to be more proactive with clients, more consistent advice to clients, and we're going to be able to deliver it more economically. So I think this is a powerful catapult forward for wealth management.
Yeah, and Andy, so then that sounds like productivity gains, and how quickly do we get to those? What is the sort of delivery time on all this investment that everyone is doing in tech, in the wealth management sector?
I mean, I think to a certain extent the risk is that we're underestimating how quickly this is going to be upon us. I mean, we all see how we're living our lives today, how many incremental searches we're doing on Perplexity or ChatGPT versus Google, for example, and you see it in the data, we feel it in our lives. What we see through partnerships with companies like Google and Palantir, we're seeing the ability to solve challenges we've had operationally in our business in a couple of quarters that people thought were going to take 5 or 10 years to solve. And to solve those problems, in some cases, at 1/5 or 1/10 of the cost that we expected. So that's very powerful, and I think it augurs for change coming more rapidly than we expected.
Andy, a final question to you, and I want to go back to where we started on this conversation, which is potential tax code changes. And this is, of course, something that directly affects the wealthy, directly affects the clients you're speaking to. There are potential tax cuts, if this bill goes through, for the United States, potential tax hikes coming down in the UK. Again, big potentials. We don't know what those look like. Are you seeing that divergence actively affect people's allocations, where people want to live, how people are thinking about the U.S. versus the rest of the world?
I mean, I think in the U.S., for all the headlines and all the news, including this morning out of the U.S., this is unfolding basically as expected. Most current policy rolling forward, some incremental tax cuts and tax relief that'll benefit consumers broadly. Maybe the most consequential, medium and long-term story coming out of the tax bill is the expensing of R&D and capital investments by companies, which we think, over time is going to drive investment in U.S. businesses. So this is, I would say this is a very consistent policy regime in the U.S. That's to say, we still have, we've got a medium and long-term deficit problem, which is out there and it's not being addressed. But, I think markets are going to view today and over the next couple of weeks as a relatively stimulative.
Are wealth clients sensitive to that, to the deficit concern? Does that even affect that cohort?
No, I mean, it's an increasing topic of communication or discussion among our clients as it is, in the broader marketplace. It's not driving investment decisions right now, by our clients, and it's not a dominant discussion. We had many client conversations this week in London. I would say 75% of the conversation is AI. What's it mean for my company? What's it mean for my workforce? How quickly am I going to have to adapt to this? And how do I invest in a very volatile, uncertain, quickly changing, even chaotic marketplace. And our message is a simple one. Asset allocation matters today more than perhaps ever. And so you've got to be very disciplined and understand your asset allocation, and you've got to be watching data and watching markets extremely closely, which is why we think for wealth management, this is a time when advice is going to be prized by clients.
And watching Bloomberg Television. Andy.
Very much.
Great to see you. Thanks for stopping by to see us. We really appreciate it. Come back anytime.
Thank you.
Very nice to see you here in London. Andy C, City's head of wealth. Coming up, we're going to be back and focusing more on what is happening here in the UK. The UK Prime Minister Keir Starmer belatedly backing his Chancellor after a tearful appearance in Parliament, sparking something of a sell-off yesterday in the gilt market. We'll have more details on that story next. This is Bloomberg.
Estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Bersachi in Doha, Qatar, and this is Bloomberg.
"47 minutes into the equity market session, you are looking at a broad bid, not a convincing bid, but at least a broad bid across Europe this morning as we await a long weekend in the United States. We await the passage of the big, beautiful bill. We await what happens next with the non-farm payroll numbers. There's a lot of things we're waiting for, so I think we're just largely sitting on our hands this morning, enjoying maybe a nice coffee. Talking of which, let's talk about Italy and the data that is out this morning. 52.1 is the services PMI number for the month of June. That is down quite sharply, I would argue, from 53.2, the prior number, but is slightly also worse than the survey number. So things may be softening up a little bit, but still positive in Europe, which seems to be maybe the narrative that we continue to watch for at the moment. Decent growth, okay growth relative to expectations around Europe. No real surprises.
No, we had a few surprises for the gilt market yesterday, didn't we? We're winding some of those back. Let's bring you up to date with what we've got. So Keir Starmer, the British Prime Minister, has been out making comments. Well, last night backing his Chancellor belatedly, but this morning he's out on the wires talking to a radio channel in the UK, saying that the UK government is committed to fiscal rules and economic stability. This after gilts have been making up some of the ground today, after UK Prime Minister told the BBC that Rachel Reeves will stay on as Chancellor for many years to come, with the words he used overnight when speaking to the BBC. This after her tearful appearance in Parliament sparked a bond market sell-off yesterday over speculation about her future.
With cutting regulation, planning and infrastructure is pounding forward, building 1.5 million homes, the biggest investment in social and affordable housing, and of course, Mr. Speaker, the 3 trade deals. Remember the ones that they couldn't get, including the US trade deal. On Monday, those tariffs came down. That secured the jobs at JLR. That's who we care about on this side of the House.
How awful for the Chancellor that he couldn't confirm that she would stay in place.
So, Bloomberg's managing editor Adam Blenford and Valerie Teitel are back with us around the desk to talk about the UK. Adam, good morning. So, what's the assessment this morning of what we're waiting to hear on the UK side of things, and how safe the Chancellor's position is?
Well, good morning. We heard there, you heard from the House of Commons yesterday, Keir Starmer not giving that backing to Rachel Reeves, but then things progressed as ever in UK politics very quickly, and by the end of the day last night, Starmer was out talking to the BBC, giving a lengthy interview in which he was really effusive about their partnership, talking about them being in lockstep and giving a really seemed like a cast iron guarantee that the Chancellor would be in position for a very long time. I think he said past the next election. He thinks along the lines of we work together, we think together, those sort of things. So he's really tethered the two of them together this morning. That, I think, has helped bring back those gilt yields and calm things a little bit. But the missing piece of this, of course, is that we haven't heard from Rachel Reeves at all since then. She wasn't up at the dispatch box yesterday. She was observing and obviously upset. And we haven't heard a reason from her as to why this was. And Starmer diplomatically and, of course, very politely refused to go into any further detail.
Yeah, really interesting. In that interview he gave late last night, then, Guy, he was saying, no, this is a team that really is working together, unlike other teams that we've known in the past, where the Chancellor and the Prime Minister haven't always. I won't name any names, but obviously referencing some Labour Party history there, it would seem.
It feels like he was told to say those things by the gilt market, effectively. Is that the narrative? Do you think Rachel Reeves would be still in position if the gilt market hadn't done what it did yesterday? How sensitive is this government in the long shadow of Liz Truss to what happens in bond markets?
Well, clearly UK assets are vulnerable in the shadow of Liz Truss. If you would cast your mind back, we had that slightly incredible period where it takes a lot to remove a Chancellor, but for a period of a year or so, we went through a basket full of them very, very quickly.
Is that the collective now?
The collective now for
there are others, I assure you.
A basket full of Chancellors, like an inflation basket. But the Reeves and Starmer have been, until now, really close together. You've not been able to put anything between them. She's, of course, been trying to push through these spending cuts in order to try and improve the country's fiscal position. She's got all these factors weighing on her freedom to raise money. How is economic growth doing? Not as well as they hoped. Fiscal rules that restrain borrowing, and of course, then unable to get the Labour Party backbenchers to approve £5 billion in welfare benefit cuts. So she's in a bit of a bind. That's a difficult position professionally and politically for someone to be in. But we remain in the dark as to whether that was the cause of what they saw yesterday. But markets were clearly unnerved. It didn't take much, as many analysts said, indeed. Whatever the underlying reason, they were a bit becalmed before that happened, but it didn't take much to upset markets in that context.
Well, Valerie Teitel is also around the table. Val, dive in here, because the bond market reaction was really interesting. What does it respond to now? In the last 24 hours, all the analyst commentary has said this is about how long Rachel Reeves stays in that seat. Now what? Now what do they respond to?
Well, I think the whole worry yesterday was maybe the market overreacting, saying, Starmer might throw out the entire framework of his economic policy and start over again. And I think that's what the bond market was really worried about. Any change in the chancellor or any change in direction, I think the market just assumes the fiscal slippage would happen, the fiscal rules would slip, there would be more government borrowing needed, and that's what was priced in yesterday. And I guess since we've gotten just words about stability since then, that's given a bit of reprieve to the bond market. We now retraced about half of yesterday's move in the 30-year gilt yield. So we're up still around 10 basis points over 2 sessions.
And we did see this spill into other European bond markets. We saw French yields, for example, up by the close, 10-year, I think, up 7-8 basis points. It's built into currency markets as well. The pound was weaker yesterday. It was weaker against the dollar, but that's confused by other factors. The euro really benefited and, in fact, hasn't really unwound the gains it made yesterday against the pound.
Yeah, when you're looking at euro GBP, it does look pretty stable. But, I mean, the move in cable yesterday was pretty disastrous. 1.3% move to the downside off the back of the rise in gilt yields. I mean, that's just the Liz Truss combination all over again. And in fact, if you look at that rise in gilt yields, we really haven't seen something like that since the Trump tariffs were announced. And if you exclude that, because that was factors outside of the UK government's fault, you really do have to go all the way back to the Liz Truss
very different magnitude.
See that kind of, it's very different magnitude, but on a daily basis, a 20 basis point rise in the back end is something that is very uncommon.
Lots to watch when it comes to the pound and where these UK story goes next. Bloomberg editor Adam Blenford walking us through some of those politics. We thank you so much. Val, I'm going to hold on to you because there's plenty to go through when it comes to what's going on latest the agenda. We are counting down the hours to the U.S. jobs report. That coming up at about 1:30 p.m. UK time, which is largely expected to have some sort of effect on the currency market, perhaps on the other end of that currency pair of cable. So, Val, hop in here. 106,000, that came out weird. 106,000 is a survey number. 96,000 is a whisper number. I'm stealing Guy Johnson's question. Do we want to beat or a miss?
Well, it depends on if you're long or short the dollar. I would say that. But I keep reloading my eco screen to see if this survey continues to track lower. It's tracked lower all week.
Yeah.
It started out at 119. And then after that big ADP miss, after the worries about what that private payroll data showed, where it was a massive miss to the downside, showing a contraction in jobs, we've seen that non-farm payroll estimate continue to stick down to 106K. But to your point, do we want a beat or a miss? I think it really depends on what your outlook for the U.S. dollar is. If you think, or if you're short U.S. dollars, if you want the dollar weakness to continue, a big miss to the downside would do that, as the market would start to price in sooner rather than later Fed cuts. Maybe that July pricing starts to go up.
Is it sub 100? Is it 70? Where does the market think Powell's got to cut rates right now?
I think something south of 70K would change the pricing on July. Now, we still do have a CPI print. I know you mentioned that before on the 15th of the month. So there's still more evidence before the Fed convenes their meeting on whether they do a rate change at that. But I do think 70K seems to be the kind of line as to whether we price in more probability of a July cut.
And it'll be interesting to see whether the market responds to the job creation number, the unemployment number, all of that in focus then in terms of thinking about that Fed reaction function. Thank you very much to Valerie Teitel. So this data comes early. It's not Friday, everybody. It is Thursday. I'm going with the idea that we've got 2 Fridays this week. That feels like a good place to be.
I like the idea of 2 Fridays.
There we are. So we're going with 2 Fridays, but today's is Thursday, the 3rd of July. That's it for the opening trade. We have built back some of the ground lost on UK gilts yesterday. Stocks in Europe are up. The pulse is up next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg. Relief rally, UK gilts rebound as Prime Minister Keir Starmer says Rachel Reeves will stay on as Chancellor after speculation about her future sparked a sell-off. Washington announces a trade deal with Vietnam and lifts some UK-US chip curbs on China. Plus, House Republicans express confidence that Donald Trump's massive tax bill will be passed to meet the president's Friday deadline as the legislation clears a procedural vote. Now, there is, as you guessed it, quite a lot going on in the markets. Let's get straight to our market check. Now, bonds are pretty much steady. Shares rising modestly ahead of today's monthly non-farm payrolls report, which is expected to show a slowdown in U.S. hiring. Yes, hold on to your seats. It's Thursday, but we have the monthly report. Tomorrow is, of course, the 4th of July. Now, the yield on 10-year U.S. government debt declining some 2 basis points. Dollar little changed. We're, of course, also looking at sterling. Pound rebounding some 0.2% after suffering after suffering yesterday the worst performance among major currencies. And then we, of course, look at the UK 30-year yield at 5.326. We'll have a full roundup of everything that's going on in the UK. Overall, if you look at the European markets map, they're probably looking at what's happening in the US. Look, cross-asset moves underscore cautious optimism. Again, as it feels like a lot of traders are contending with pockets of uncertainty ahead of the unemployment report, or employment report, I should say. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, UK gilts paring some of their losses after the Prime Minister Keir Starmer says Rachel Reeves will stay on as Chancellor as he sought to end speculation about her future. Markets had tumbled after a tearful appearance by Reeves in Parliament, fueling rumors that she was about to leave her position. It came after Starmer failed to back her fully during Prime Minister's questions after an embarrassing U-turn on the government's flagship welfare reforms.
The fact is, Labour MPs are going on the record saying that the Chancellor is toast. And the reality is that she is a human shield for his incompetence. In January, he said that she would be in post till the next election. Will she really?
She certainly won't. Mr. Speaker, I have to say I'm always cheered up when she asks me questions or responds to a statement, because she always makes a complete mess of it and shows just how unserious and irrelevant they are.
How awful for the Chancellor that he couldn't confirm that she would stay in place.
Well, we're now joined to talk about all of this by Subita Subramaniam, Head of Investment Strategy at Saracen & Partners, Adam Blenford, our Managing Editor for the MEA News Desk, and Marina Konyam, who covers UK markets for us. So this is a truly team effort to try and understand what's going on. Adam, I mean, what did you make? You know, it was pretty extraordinary, actually, watching everything unfold yesterday. Starmer has since given an interview to the BBC saying, look, Rachel Reeves will stay on as UK Chancellor despite some of the setbacks. I mean, is that locked and loaded?
According to him, it is, yeah. It's one of those, as we've had quite a few of them in recent years, extraordinary high-speed moments in UK politics where an incident, as you saw there, a heightened moment in Parliament, which was really quite intense, looking back on the clip there, you know, that classic head-to-head of Prime Minister's questions, putting people really in a personal spotlight, sparked that market sell-off, as you talked about. And then Starmer came out last night, perhaps having failed for whatever reason to overtly back his Chancellor in the chamber. He came out and gave an interview to the BBC, and he was really, really effusive. You know, we're in lockstep. We work together. We think together. Rachel Reeves, according to the Prime Minister, is going to be Chancellor for a very long time through the next election. So he has now, interestingly, tethered himself very closely to her, but the markets may have retraced some of their ground, but we don't know yet. We haven't heard from Rachel Reeves herself. We haven't understood what was the cause of yesterday, but equally, none of that changes the UK's fiscal position, as I'm sure you'll talk about with your other guests in a second. None of that changes the wider position, which has put the pressure on Rachel Reeves and put the focus on Keir Starmer in the first place. So the story has a long way to go.
Yeah, and Subita, I mean, apart from the fact that it's actually a very uncomfortable watch because of, you know, you don't really know what the Chancellor's going through. It's the fact that, you know, gilt really moved on the back of it after the huge setback the day before because of the welfare mess, frankly. So how does the UK, I mean, it's a good reminder that, you know, markets are there and that the UK is a small open economy at the mercy of strangers. Like, where does the Chancellor and actually the Prime Minister go from here?
So I think, you know, I think the good news, the reason we have gilts rallying today is basically because they acknowledge that budget constraints do matter for the UK, and you just cannot sort of have a magical way of growing your economy without actually, you know, either having spending cuts or raising taxes. So we now know that they will respect the budget constraints and Rachel Reeves will remain as Chancellor. But the fundamental questions for us as investors is really, can you tax your way into growth? Which is really where we're coming to, because I think everyone is now expecting that in the autumn statement, we'll have tax increases. And the next question is, what kind of taxes and what will that do for the growth of the economy?
Yeah. We're just getting some breaking news. UK bonds actually extending against a 30-year yield, falling some 10 basis points to 5.32. Marina, I mean, this goes back to the reaction from the markets yesterday was really, really swift. And I wonder whether, you know, it's bond investors just being on tenterhooks, given what's happening in general, or is that there's always a concern, an underlying concern on the UK because of what happened with Liz Truss?
Absolutely. It was a very swift reaction yesterday. We are seeing that come back today, but we're still only halfway between the amount that the 30-year gilt actually rose at its peak yesterday. So we haven't fully clawed that back yet. I think it's quite interesting to look at what's happened to the 30-year gilt actually over the last few years. Now, it obviously did rise a lot yesterday, but not as much as it did on the global economic anxiety in April and May, and not even as much as the last time that everybody had a panic about the UK in January. But if you look back historically, those yields are still quite elevated compared to prior to the 2022 Liz Truss mini-budget situation. We haven't really come back, and that does mean that there's just no room for yields sort of going up actually becomes a self-fulfilling panic because there's not much space already for the Treasury. Borrowing costs going up is a real problem because they are already historically very high.
So, Subita, I mean, what does it mean for the budget? Does she go back and readjust? I mean, we don't really know where if it's the tax rises or where she takes the money from.
I mean, I think it's unlikely they go back to the welfare bill as a source of spending cuts. I mean, the sort of mind-boggling thing for us is really we do have the triple lock on pensions, which remains in place. And if you think about, how do we pay for this, that's not even on the table today. So it looks like we're just going to go back to tax increases as a way of paying for this. And I think that's actually quite negative for UK growth over the long term. I think something we haven't talked about is just the OBR's sort of adjustments of its forecast on the UK productivity, and that is going to actually cost about 10 billion. And so I don't know that actually, raising taxes ever more at a time period where the US is actually cutting taxes is going to make the UK more attractive, attract more investment into the UK. So I just think, we're in this sort of realm where the clear vision and economic strategy of this team hasn't really been spelled out. I mean, if they stand for growth, how exactly are they going to achieve that while respecting their budget constraints?
Yeah, and Adam, I mean, given what happened yesterday and all of these questions, I imagine the Chancellor will just be tested and tested and tested.
Yeah, and they can see now that the Labour backbenchers, who we didn't know what this group was when the government was elected a year ago, when Labour won that election with what was really a very large majority and over 400 members of Parliament. But it turns out that, of course, many of them have very small majorities. Some of them probably don't expect to be there in 4 or 5 years' time at the next election. They actually proved this week that they can make much more trouble for the government than perhaps it looked like on paper when you did the raw maths a year ago, and that backs up the idea that it's very difficult to go back to the welfare bill, as you said. Labour perhaps historically more comfortable with raising taxes, but as was said, what does that do for the growth environment? But Labour's project seems they've boxed themselves in from the very beginning, didn't they, with some of those pledges?
Does it mean? I mean, the Prime Minister, has been trying to chase reform voters, right, in the last 3 to 4 weeks. And now he has to keep the party together. So are we going to see, if not a radically different, policies that will change quite dramatically?
Keir Starmer always tries to chart what appears to be a kind of sensible, stable course, but his options continue to narrow because of so many of those commitments that they laid out really very early on. A commitment in the manifesto not to raise taxes on working people, a sort of refusal to go back overtly to raising income tax and VAT, and of course what the markets particularly say about the changes to the fiscal rules.
Okay, thank you all for joining us. Adam Blanford and Marina Konyam-Subita Subramaniam from Sarazen & Partners actually stays with us because we turn to U.S. politics now. As President Donald Trump says, the U.S. has reached a trade deal with Vietnam, giving zero tariff access to American companies while slapping a 20% tariff on all Vietnamese imports. Now, Hanoi has not confirmed the framework deal. So for more, let's bring in our EMEA News Director, Roz Madison. So, Roz, essentially, what's the substance of the deal?
Well, we don't know a ton about it, as you say, beyond the headline numbers, which is 20% tariffs on Vietnamese exports to the US and 40% on transshipments. We don't know, for example, if Vietnam is getting anything in turn because they had asked for some recognition of being a market economy. They're also asking for lifting of curbs on high-tech exports. There's no detail as yet from Vietnam or from Donald Trump about whether any of that is included. So all we know are those headline figures so far. And obviously a big focus of this with Vietnam for the US has been transshipments, which is code for stopping Chinese goods coming into Vietnam and onto the US, and perhaps with a little bit of tiny production going on along the route, and that hence that 40% figure on transshipments. The question is, will that achieve anything, and how does that affect the Vietnamese economy? It's all about pulling Chinese production out of China, encouraging companies to relocate out and to curb those transshipments. We did see a rally in some shares yesterday on the back of this news from Donald Trump, and particularly textile companies, shoemakers and so on. A lot of stuff is made in Vietnam and moved on to the US. But the question is, like all these framework deals that we're seeing so far, there's a big announcement, not a lot of detail, and it seems like most of it is getting pushed back down the track. Let's get at least, say we've got a deal, and then we'll figure it out later in a way.
So we have, of course, the Trump administration lifting chip curbs to China, which we'll talk about a little bit later, but there's also this big, beautiful bill. So where are we on that? And again, the implications are far and far-reaching.
Well, interestingly, we just got through this procedural vote in the House, and that had taken many, many hours. It dragged out Republicans using that as a chance to air their grievances about the latest version of the bill, and that had gone on and raising, obviously, Donald Trump's concerns. He was up on social media saying, guys, this should be easy. We need to get this done because we're edging towards his July 4 deadline on it. But it recently did pass that key procedural vote, and that means it is moving towards a full vote on this bill, and we may even get that in a matter of hours or into the US day at some point. But clearing that hurdle is a sign that perhaps they are having success at bringing these Republicans together, because they can only afford to lose 3 in all of this in the end. And what you've got is Republicans with differing views on either end, but they are making progress.
Yeah. Roz, thank you so much. Terrific update. Roz Matheson there with the very latest on the U.S. Still with us, Subita Subramanian. Subita, I mean, when you look at actually all of everything that's happening in the U.S., I mean, there's tariffs, there's the bill. First of all, it will have an impact on inflation.
Yes, so I mean, in terms of the One Big Beautiful Bill Act, I think our expectation is it does pass. It's actually going to have a fiscal stimulus into the U.S. economy this year and next. It's really a question of, how big it's going to be. Our estimates are anywhere from 30 to 40 basis points for both years. Now, if you just step back and think about what we expected in February and March when DOGE was, really all the rage, we actually expected that the U.S. economy would actually have a fiscal contraction. So now we are putting in place a fiscal impulse into an economy where we are starting to see fewer immigrants. We have an economy that's actually slightly softening because demand is pulling back because of tariffs. It's actually highly complex for businesses to navigate this. But, ultimately, I think just like the UK, but the US certainly enjoys an exorbitant privilege. Yeah. The One Big Beautiful Bill is incredible in terms of just the lack of fiscal restraint. Yeah. And there are no consequences for now for the US.
But Subita, I mean, I've heard from more and more of people actually being worried, right? Big Wall Street saying at some point, we're not worrying about it now, we should, but at some point, something could happen with an auction because you can't just print money like that. You can't have that much debt and not have any consequences.
So I think, I think we are very concerned about just the complete lack of fiscal restraint as far as the US is concerned. I mean, I think the CBO, the Congressional Budget Office, basically projected fiscal deficits of about 6%. Now, as a result of this bill and the version that was passed by the Senate a day or two ago, fiscal deficits are going to be running well above 7% forevermore, as far as we can see. And actually, that makes no sense. So there is no plan in place for the U.S. to actually pay for any of the spending. And if you think about it, Social Security, Medicare, and interest payments are roughly 50% of U.S. budget. So there is no plan. And for now, investors seem comfortable funding the U.S. government, but foreigners are becoming incredibly uncomfortable.
Subita, when you look at tariffs, is that a way to get money in? Again, there are many questions on whether this is a negotiating tactic or it's literally just money in the coffers. So
from our perspective, I think now, for the month of June, the U.S. Customs basically raised about $28 billion in tariff revenue. So that really equates to around $350 billion if you run it at an annual rate. And now that's actually quite substantial.
I was going to say it's not nothing.
It's actually quite substantial. So set against a budget deficit of, say, $2 trillion annually, you are raising revenue. So I think of tariffs as basically a consumption tax on U.S. consumers that they're putting in a stealth way. It has a secondary objective, which is basically to reshore a ton of manufacturing, which they consider strategic, back into the U.S. So I'm not sure that these tariffs ever go down, and I think they just start to inch up over time.
The employment figure today is extremely important because it gives us an indication of what the Fed could be looking at, maybe a bit of softening in the employment numbers. And we heard from Jay Powell, we were in Sintra doing a big panel with him, that actually he's worried that inflation does pick up in the next couple of months because of the tariffs.
Yes, and I think we are likely to have soft inflation over the next couple of months. It's coming about for a number of reasons. Just uncertainty. People do not know what's happening. So basically, no one is hiring, and they're not letting go of workers. You have an economy in standstill. But at the same time, you have to absorb. If the government is raising roughly $350 billion in tariffs, someone is paying for it. Ultimately, it's being paid for within U.S. borders. So it's either U.S. businesses or U.S. consumers. And I think most people would assume that consumers pay roughly sort of 50% of that. So it's going to show up in inflation.
But the consumer remains strong because the U.S. consumer so far has always been there. If we start having doubts about that, then all bets are off.
So I think the U.S. consumer has been quite strong right now, but a lot of it is really reflecting the fact that a lot of spending has been brought forward. The U.S. consumer is incredibly smart. If you look at Q4 and Q1, they really brought forward a ton of imports from the rest of the world. They have been incredibly astute and actually much better than markets at actually forecasting that tariffs are going to go up. Having said that, though, I do worry about the impact of immigration on U.S. demand. We've had 9 million immigrants enter the U.S., and actually they have contributed to demand, housing, a whole range of goods. And I think, if we actually start turning that negative, where some people are actually expecting that, you will start to see a pullback in demand as well.
Thank you, Subita. I mean, I love the idea of front-loading shopping. Subita Subrahmanyan there, head of investment strategy at Sarazen and Partners. Coming up, an exodus of wealthy foreigners is accelerating after a UK tax crackdown. Our next guest says London is still the best place if you're rich and if you're young. We'll have more on that. This is Bloomberg.
Up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome back, everyone. Now, we are keeping a very, very close eye, of course, on anything UK, given what we saw in gilts yesterday, and, of course, the Chancellor, Rachel Reeves. Now, UK 30-year yields falling some 12 basis points, the biggest intraday drop since April. So we're keeping an eye on it, but a reminder, the Prime Minister did seem to give his full confidence in the Chancellor in a BBC interview late last night. Now, barely a day passes by without a big investor or a big entrepreneur leaving the UK after the government abolished a 2-century tax break for non-domiciled residents. Now, the exodus could lead to a net drain on the economy, but my next guest believes these reports are missing a crucial indicator, and that's age. Well, joining us now is Raja Mekwar, Chief Executive of Calista Direct Investors, a firm that helps family offices to invest in private markets and alternative assets. So, Raja, thank you so much for joining us. Now, first of all, you're a believer in the UK. Why?
I'm a believer in London as a global hub for finance and private investments.
Okay, so that's a good start.
Yes.
Does anything change because of the non-dom rules?
Yes, of course. I mean, money that made it, money that wants to look for something else than just hard work, has to look for a better shelter. But I think the UK lives this as a traumatic experience. If you look at France and other countries in Europe, they've been going through such motions for a while. And depending on what the governments do, wealth is very mobile. Wealth is flexible, but it doesn't mean that the actual capital, that the brain behind the capital has to leave. And I think that's where London still wins.
Raja, I mean, do you think that there's actually, there was, I don't know if there's a misunderstanding, that actually taxing non-doms on everything that they have abroad was the big problem. So it's the ultra wealthy that said, actually, I don't need this, I can move elsewhere.
Absolutely.
Do you think there'll be a U-turn on that?
Well, I hope so, but I'm not a politician, and I know I've been working and looking after family capital in private equity for 20 years, and that wealth looks after its money in a different way, to any other asset owner. And the UK has been home for 2 generations at least, so it is traumatic. But honestly, a lot of the resources stay here. The brain power is still here. And actually, London is a hub for deal making, whether we like it or not, and that's why we opened an office here.
And why do you think that is? Is it the rule of law? It's always been seen almost like a satellite to the U.S., right?
Absolutely.
That it was a more mature market than some of the Central Europe.
That's a big factor. There's also the fact that there's critical mass here, and it's been here for so long. And I think London has been the home for private capital for so many years now. It was the first economy that also looked at private equity, although it's been caught up on by other countries. And what I see in my generation, a lot of people have left. But in the younger generation, they all look to London because there is no alternative in Europe.
And I guess, this is also universities. Is there anything that you would tell the government now to do to make sure that that doesn't change?
Well, I would say, with Brexit, if you leave aside the non-dom abolition, I think Brexit has made hiring non-UK talent very difficult in London, but just as it has made UK talent difficult to be hired in Europe, and we've experienced it both ways. So I think easing those rules for super talent, like we used to have these, high potential migrant worker type of visas, that's very important, because without talent, there is no wealth creation and there is no wealth.
Raja, when you see, and it's, when you look at actually post-Brexit, there's more and more people leaving London for a number of reasons. So it could be tax, it could be non-doms. It feels like they're either going to New York, maybe a little bit less so at the moment because of some of the politics there, but certainly Dubai. Is there anywhere in Europe that's attracting talent?
Look, Europe has become multi-hub. There was even a time for startups, it was good to live in Lisbon or Barcelona or Madrid. But honestly, if you want to have a serious institutional career in private equity and investment banking, no one replaced London. I don't think it's going to happen overnight, especially also because the largest market is the US and the first port of call for Americans is London. And speaking of taxes, our wealthy American families, when they come to Europe, their playground is London, and they own homes here, and the tax rules don't apply to them. So I think we should nuance this, but for sure, I'm not saying it's good news, but it's a bit more nuanced. And I would say the generation that's coming up now, looking to work hard and make it, still look to London as their first port of call as well.
And is that, for the wealthy Americans, is that, ease of language, but also rule of law, or is it just the ecosystem that London has?
It's all of the above, and I would add something very important that we always overlook is the mindset, the way of work, the mentality. The bridge between New York and London is so easy to make if you just interact with people. If you go to Paris or Milan or Zurich, that changes very quickly.
When you say that a lot of firms continue to open in London, including your own, is that again to test the market to then expand in Europe, or is it really just because London also has the perfect time zone? It has a lot of benefits.
I think for Americans, it's the first port of call before maybe moving to other cities. But for us Europeans, it's really because we realize that a lot of the relationships for deal making transit through London, and so it's a good hub to come and centralize the meetings and create this kind of critical mass of relationships and opportunities.
On the show we talk a lot about IPOs. When are we going to see a big IPO? Now there's talk about some of the big UK firms actually moving to the US because there's more of a liquid capital pool. Does that make a difference to your clients?
Well, family capital is long-term capital. It's also flexible capital. Yeah. So we look to exit, of course, at some stage, but it doesn't matter if it's short-term or mid-term, and what matters the most is it the public market that's the better option, or can it be other types of exits? I don't think that's a primary factor for decision-making of where you actually invest your money and where from.
So interesting. Thank you so much for joining us. That was Raja Mekawar, Chief Executive at Callista Direct Investors. Coming up, we discuss the latest in tech and VC investing with industry veteran Eileen Burbidge. That's next, and this is Bloomberg.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here in London, and these are your top stories. Relief rally, UK gilts rebound as Prime Minister Keir Starmer says Rachel Reeves will stay on as Chancellor after speculation about her future sparked a sell-off. Washington announces a trade deal with Vietnam and lifts some U.S. chip curbs on China. Plus, House Republicans express confidence that Donald Trump's massive tax bill will be passed to meet the president's Friday deadline as the legislation clears a procedural vote. Now, some breaking news. Bloomberg has learned that BlackRock is considering a sale of its stake in the leasing rights to Saudi's natural gas pipeline network back to the energy giant. Now, as far as we understand, there's no final decisions that have been made, and there's no certainty that the deliberations will lead to a transaction. But again, it's interesting as we look at pipelines and future security of energy and the energy complex. Now, let's get on to tech. Now, with Meta hiring its new superintelligence team, robots in China playing football matches, yes, they are, and the IPO market beginning to pick up, the tech sector shows no sign of slowing down. So where does the UK fit into all of this? Well, joining us now, industry veteran Eileen Burbidge, a founding partner of Passion Capital and executive director at Fertifa. Eileen, so good to speak to you. I mean, there's a lot going on in this space. Yes. It's all about AI. Do you want to be an AI, or do you want to look at the margins?
You know, I was thinking about it on my way in, and it's so great to be back. So thanks so much, Fran. We've been chatting through the years for almost 10 years, I think. And when we first started chatting and I started coming on to speak with you, we spoke about tech and digital as its own sector. And we used to speak about the rise of tech and whether or not we thought this was going to be something that would affect other industries. And I remember saying then, I think over time it won't be its own sector. Similarly, I think, yes, there's lots of froth, there's lots of investment. All the movement and momentum is in AI right now. And I think over time, it's going to be a given. It will be part of any industry, any technology, any company, and any commerce that's still around in 5 to 10 years' time.
So when you look at, you know, I know you're raising a new fund to invest primarily in the UK. Yeah. Like, what opportunities do you see in the UK?
Yeah, so in the UK, I still think we have such a great strength of talent. I really do, especially with what's happening sort of socioeconomically with macroeconomics and the geopolitical climate. I really think our universities, our talent pools, really, really strong. We continue to attract people from abroad, whether it's from North America or from the continent. We've got the best university system really in the world. Imperial now ranked #2 in the world. It's fantastic. And so I believe we still have the talent concentration here in the UK. I think we have the ambition.
I think we're winning on the research front and in the labs. What we're getting better and better at now is commercializing, so I'm really optimistic about that.
I love hearing that. What do you think of the EU AI Act? So is there too much of a burden on actually EU companies?
I don't know that it's a burden. I think that at the same time, clearly the EU is trying to fund infrastructure as well, along with everybody else, right? The UK is trying to do the same. Everyone's trying to think of their sovereign approach to AI infrastructure and to make sure they don't have as many dependencies on import as they have had historically.
I mean, we've seen a couple of, I mean, there's been a lot of tech news in general, but, you know, there's been a Meta investment in Scale. Has that changed your approach to VC?
No, I don't think it had changed the approach to VC at all. I think these larger companies are always going to be acquisitive and really, really clever about it, and that makes sense. And frankly, from a VC's point of view, exiting to a business like Meta or having a company go public, the result economically is probably very similar. So I don't think VCs, sorry to be so cynical about my colleagues or even myself, we're not really picky about where the exit is. Trade sale's great, listing is great, and I think the more opportunity there is, the better.
But so Monzo's thinking of listing either here or the U.S. Does that make a difference for you? You know, would it show if they list here? Does it change significantly to show the world that actually the UK is really attractive?
I think I've got to be careful here because I'm actually on the board of Monzo, so Passion Capital is the largest shareholder still. And so there's lots I would love to say, but I can't speak on behalf of the company or the board. If it were to list in future, clearly the decision does rest between the US and the UK. At the moment, it's the 7th largest bank in the UK, and obviously it's got more than 12 million customers now in the UK, so it makes a lot of sense as a UK story. But clearly, as it starts to develop its international approach, and as it starts to see that the US is very, very receptive to really profitable, really strong growing, really, really great businesses, that's something it has to consider as well. But those are conversations that I think are some ways out. It's early.
Eileen, I mean, is there something that frustrates you in the UK about, you know, scalability or how, for example, you know, the government is dealing with a lot of the tech companies? Because you laid out all the good things about the UK. There's a lot of things that this country could do a lot better.
I think that's true, but I think that's true about everywhere you are. I mean, I wouldn't be particularly happy or content if I was in the US right now either. So I think I'm an eternal optimist, right? I'm an investor, so I'm always going to see the glass half full. You're right, there's so much more that could be done. We could have a lot more sort of flexibility, a little less friction, but to me that's just opportunity. And I think it's about where we are on the spectrum and how that sort of journey has been. And again, we've been talking for years and years and years. We are so much further along than we were even 1 year ago, 2 years ago, let alone 5 or 10. And I really think the trajectory we're on is really, really strong. The UK is really, really poised to have a breakout.
Do you see actually a lot of capital coming from the US into the UK?
I think what we see now is really interesting because of what's happening geopolitically. We see a lot more capital looking at the UK because maybe it's even a hedging strategy. The U.S. feels a little less certain or predictable right now. You never know quite what's going to come out of the administration. And so for the investors of the investors and the sort of at the top of the funnel, you're seeing a lot more exposure or looking for exposure and hedge against the U.S. So we're seeing a lot more Asian money, a lot of Middle Eastern money, and a lot of continental European money looking at the UK, much more than maybe it did before.
I mean, you see this, you know, U.S. trying to fight when it comes to AI, and it's like a big race with a lot of implications. Does it actually materially make a big difference to companies in the UK or in Europe?
I think what will make a difference are tariffs, are the export sort of controls, because they will determine what they rely on for their needs. I think it's really interesting that's going to play out in the U.S. And China. And I tend to agree a little bit with what, you know, Jensen Huang would say this from an NVIDIA point of view, but his view that the export controls preventing him from being able to ship more to China is really just going to give China an even greater sort of forcing function to develop their own IP and to accelerate their investments. So in a way, it's leading them to actually pay even closer attention and pour more money into it. They probably would have anyway. The question is how much more have we spurred them on, or has the U.S. spurred them on because of their export restrictions?
I mean, what do you think is there actually a company that you wish you had invested in Europe?
There are lots. There are lots of companies. I mean, I still think, and sometimes we get credit for actually investing in Wise. Still love that business. Still love what Christo and Tavit have done with that company. That would be one that I'd loved. I'd always talked about Onfido as being an anti-portfolio company, but there's so much. I mean, that just demonstrates. Yeah. I think at Passion Capital, we've had such a great run, and we're so proud of Monzo, Go Cardless, businesses like Poly AI, Butternut Box, but there's still so many more that we would have loved to have been in, and that just means we have quite a rich and deep ecosystem here.
Eileen, so good to speak to you. Thank you so much for coming on. Eileen Burbidge, they're a founding partner of Passion Capital and executive director at Fertifa. Now let's bring you some other tech news. And OpenAI has agreed to rent a massive amount of computing power from Oracle as part of its Stargate initiative. Now sources say the rental will total about 4.5 gigawatts of data center power in the U.S. Oracle is also said to be developing multiple data centers across America to meet the additional demand from OpenAI. Tesla shares jumped after the car maker posted a less drastic decline in vehicle sales than the most pessimistic analysts feared. Now, the company delivered just over 384,000 vehicles during the last 3 months, down 13% from a year earlier. While that leaves Tesla in a difficult place to avoid another annual drop, some investors were braced for a plunge in sales of more than 20%. Now, coming up, as coffee prices fall, will you be paying less for your brew? Well, we'll discuss the outlook with Andrea Illy, the chairman of Illy Cafe. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Welcome back, everyone. Now, Arabica coffee prices have fallen to their lowest in 7 months. Now, the return of dry weather has helped accelerate harvesting in Brazil, but concerns over global demand for coffee has seen roasters push up prices recently. Well, we're now joined by Andrea Illy, the chairman of the Italian roaster Illy Cafe. Andrea, as always, thank you so much for joining us. I mean, it's a great pleasure because we drink a lot of coffee to wake up in the morning. How is the company responding to a decline in green coffee prices? I mean, what does it mean for the consumer at the end of the day?
So, we did anticipate a decline because this was, you remember last time I was here, I said it's purely speculative. Turns out that there has been maybe possibly a surplus in the last crop and a substantial forecast for a substantial excess in production for the years ahead. So there are new plants being planted, new areas being developed, stocks which are piling, several countries which are producing, overperforming. It's typical. Every time you have the prices reaching a peak, then you have a production skyrocketing. And so we didn't increase price too much, so we kept our volume,
right?
Increasing market shares. And of course, we will have an arbitrage between our cost, our margins, and the cost of coffee, which in the meantime is turning in a positive direction.
Sandra, does it change your outlook?
No, I would say I was a little bit more concerned after having made thorough studies I had a long trip in the Minas Gerais area, where 50% of the Brazilian coffee is grown and 20% of the world coffee is grown. Last year was serious. Why? Because the first time in history, the Niño did impact. And 3 different areas of production, all 7 months without 1 drop of rain, and peak temperature much ahead normal.
Yeah.
Was it exceptionally? Probably yes, because last year, the sea didn't increase as much as it did in the last 10 years. So therefore, the Niño was stronger, and the area of geographical area of influence has been higher. But good news, many different practices and investment for resilience, resilient agriculture, from regenerative agriculture, which is the most, let's say, the first step and most promising, irrigation, new techniques for, plant rejuvenation, renovation, new area development, as I said. So it's very promising to see how the market is reacting, because there is desperate willingness to produce coffee from the grower side.
I know, because the demand actually is increasing quite a lot, right, in terms of
not as much as it used to increase, because there has been a kind of a level off with the global let's say, as we knew it from years ago. It's not the same, let's say, buoyant trend. It is a little bit more flatter, but China is growing its internal consumption. US is keeping increasing consumption. Europe is more flat. And the Middle East is coming up, and India, minor countries, let's say, minor geographies.
Andrea, I know you've always actually spent quite a lot of time looking at agriculture and doing it sustainably. Do you see any reason to fear a supply shock on the Arabica front this year?
I would say no, because as I said, already last year has been quite a shock with one drought in Vietnam, one drought, severe drought in Brazil. It proved to be extremely resilient, as proven by the fact that there has been no physical deficit. It has just been a big alarm, which triggered a gigantic speculation. So this resilience can only increase thanks to the new practices, the new knowledge, and the new investment in the fields. This initiative, let's say, promoted by the G7 last year under the Italian presidency, is to launch a public-private partnership for mobilizing impact investment directly in the plantation. Is significant because it did mobilize efforts from any different possible actors, like the World Bank, like the Inter-American Development Bank, like many private funds. So there are investments which are, let's say, coming in the plantation in different countries, and all doing the same things, which prove to be, let's say, effective. So this is very positive.
Andrea, when you look at higher retail coffee, I mean, is that impacting some of the consumption, or have you seen, consumption change? Do people have higher quality coffee but less coffee?
Coffee is typically inelastic because we kind of need it in our life. And
that's true for journalists. I don't know if it's true for everyone.
And the portion of the budget that it drives is very, very small at the end of the day. So there is a kind of elasticity, not so much by drinking less cup, but wasting less and maybe downgrading a little bit the coffee you buy. So that means that volume-wise, we don't see a contraction of volume. Values has been, let's say, a little bit elastic, but less elastic than other products.
Yeah. How are the Chinese consuming differently to the Western
They
world?
are becoming kind of internal. So they are trying to consume their own brands. So there are brands which are reacting really strongly to the international, let's say, penetration of American and other brands. So that means that it became a kind of internally focused. And I'm not aware about how much is the Chinese coffee production growing, also because there is a kind of a limit from the ecosystem point of view. But I see that there is in line with this idea of China to be kind of nationalistic a little bit in terms of attitude.
And they consume it at home or in coffee shops. I remember you telling me actually years ago that the UK, when you have a coffee, people want to sit and spend a long time actually at coffee shops, which is very different to Italy, for example, where you have an espresso and you go.
Yes, coffee shop is experiential. Yeah. You typically go to coffee shop in China to meet or show off, yeah. But not necessarily you drink coffee. This is the point. At home is more, let's say, consumption as a habit, and it's still predominantly instant coffee. Although in the, let's say, area where there are more expats, there is a substantial espresso-based drinks consumption in Shanghai and other coastal cities.
Andrea, you must have been hit by tariffs, right, from the U.S. Did you front load? Was there a big shipments in the U.S. ahead of the tariffs?
10% from the export from Italy to the U.S., and we hope this will be fixed.
Will it?
I don't know. Will depends on the negotiation with Europe, which is undergoing those days.
Yeah.
And yes, it's tricky also because I think at the end of the day, it's a pity we have been there since over 45 years now in the United States. And it would be really a pity to completely, let's say, change our trajectory, which is very much in collaboration with the U.S., let's say, administration for that. So we are discussing, and we are planning maybe to accelerate our decision to produce locally more of the products which are typically consumed in the United States. We'll see.
So interesting. Andrea, as always, thank you so much for joining us. Andrea Illy there, the chairman of Illy Café. Now, the ECB's Olli Rehn has also told us that euro area inflation could stay below 2% or the 2% target for too long. The central bank has forecast 18 months of inflation below its goal as U.S. tariffs dent confidence. Well, Rehn, who heads Finland's central bank, spoke to me at the ECB Forum on Central Banking in Sintra, Portugal.
We have to seriously look at the economic analysis at a time when we take decisions. And we have many challenges, many shocks currently. As I look at the landscape, we have geopolitical tensions, we have a trade war, we have artificial intelligence that is changing the working life and industrial competitiveness. So all these factors play a role when we take decisions. And as I said, in the near term, risks to inflation are two-sided, and especially I would be quite concerned. I'm quite concerned about inflation being below target for an extended period of time. We have to stay vigilant and we have to be alert and act with agility as needed and if needed.
Governor, do you share the concerns of the ECB Vice President that a euro at 120 could be problematic?
Well, we are following closely the developments in the exchange rate, but the exchange rate is not a policy target for us. Our mandate is price stability, and we look at the exchange rate from that angle, how it affects our growth and inflation outlook, how it affects the strength of monetary policy transmission. And in fact, you can see different factors at play in this regard. I mean, the appreciation of the euro is affecting, if it is persistent, it is affecting cost competitiveness of European export industries. On the other hand, the recent international capital movements have reduced the term premium, and that has eased financial conditions while the other factors have tightened them. So in that sense, this is an empirical question, and we have to look at that once we take decisions.
But could you say that the euro has been of help to getting to the 2% inflation target, and now it could become a problem?
Well, that may be a bit simplified. That's your job, of course. But I would say that the appreciation of the euro has indeed helped us reaching the 2% target for now. Let's see if the exchange rate developments become more persistent or how they evolve. And we are monitoring that in light of and from the standpoint of our price stability mandate.
Well, that is the ECB's Olli Rehn speaking to us in Sintra. Now, UK gilts rebounding after Prime Minister Keir Starmer confirmed Rachel Reeves will stay on as Chancellor of the Exchequer. Well, markets slumping sharply yesterday, amid speculation about Reeves's future, adding to existing investor concern about the state of Britain's finances. Our very own Ven Ram, our MLive strategist, joins us now from Dubai. Ven, always so good to speak to you. I mean, this episode, frankly, hasn't been very helpful for easing market skepticism towards UK assets.
Morning, Francine. Good to be talking to you, and congratulations on the fantastic set of interviews out of Sintra. So on the UK, I think that the markets have kind of rallying hard. Gilts are rallying hard this morning, but I think that the risk premium that that traders embedded into UK assets is going to stay for a while, because the rolling back of those removal of those welfare measures means that the UK government is left with a fiscal gap of about 5 billion. As you will remember, in March, the government made efforts to restore the headroom, in the fiscal headroom that Reeves has set for herself. So that was 9 billion. So if they're going to surrender 5 billion, it raises the question, how are they going to make up for the shortfall? Spending has already been restricted. And in the context of UK, I think what looks most appropriate is further tax increases. And that is going to be a curious mix, because you've got fiscal tightening on the one hand and monetary policy loosening on the other hand, and that will kind of confuse the curve, and that will keep the curve steeper for longer. So I think that, while the relief rally in gilts today is welcome news for the markets, I think that investors are going to be erring on the side of caution, and I think that that risk premium is going to stay higher for longer.
Ven, turning to the U.S. and June's non-farm payrolls report out today. I know it's a Thursday, but tomorrow's the 4th of July, so don't panic, everyone. It's out in just a couple of hours. What are you looking out for?
Well, I'm particularly looking at the unemployment rate, Francine, because if you look at the market forecast, the markets are primed for a number of 4.3%. If that is accurate, that will be the highest. We haven't seen a reading like that since 2021, really. So that will be a pretty high number for the Fed vis-a-vis its own projections for this year. And if the number shoots to the upside, I think that the markets will be emboldened to price in further cuts. At the moment, the markets are thinking about 2.5 rate cuts from the Fed by the end of the year. But I think that if that number is on the higher side, I think that the markets will be emboldened to price in 3 cuts, meaning September and 2 more before December by the end of the year. So I think that, that is what the markets are primed for. I don't think that the markets are going to, even with a higher number, I don't think the markets are going to make July a central possibility, simply because inflation later this month is forecast to come in higher. So the Fed may want to watch the trend with the jobless rate rather than react to one-off high print.
So, Ven, I mean, what else, when you look at some of the reaction function, there's many question marks actually on. I mean, the ECB seems fine, but there are many questions on how Jay Powell reacts to a lot of things. How do you see inflation going, or how do you see the main vantage points over the next couple of weeks?
Well, I think that I think they are watching the inflation print like hawks, particularly because they want to see how this tariff drama is going to play out on inflation, and that is what they've been. That is what has been holding them up vis-a-vis further rate cuts. So I think that is going to be the most crucial factor, which is why I think that July is not in play.
So interesting. Ven, thanks so much. Ven Ram there, our MLive strategist, of course, based out of Dubai. Up next, we have more market moves. We talk, of course, about UK and the non-farm payrolls. Bloomberg Brief, that's next, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Are you worried about your borders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment? appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person to not manage that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments. And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. On to the final vote. House Republicans clear a major hurdle to advance President Trump's tax bill. Trade talks, bargaining chips. The U.S. lifts export curbs on China for semiconductor design software. And it's Jobs Day. Coming a day early, forecasters anticipate the Trump admin's policies to begin hitting the labor market. The most Friday of Thursdays. If you are in the U.S., congratulations. You made it to the end of the week, and you made it to the end of the week with another all-time high on this equity market. But we are hanging tight. Little change this morning, actually exactly unchanged on the S&P 500. NASDAQ barely moves. Russell 2000 futures, those continue to outperform. It is Jobs Day, 2.5 hours. 106,000 is the estimate for today. It is a bond market that is, though, rallying this morning, led by the front end, down by 2 basis points, nearly 2 basis points for the 10-year, but it really has been the UK bond market that's been dragging around global bonds over the past 24 hours with the fiscal concerns, the scares of is Chancellor Rachel Reeves out or not. Keir Starmer confirms she is. So we're getting a big rally. You can see it at the bottom of your screen with gilts this morning. So that's lifting global bond markets as well this morning. Okay, let's get you some stocks to watch. With that, it's Joe Easton. Hey, Joe.
Hey, Danny. So we're watching these industrial software stocks this morning. As you mentioned there, we have seen news of the US removing these restrictions on China in terms of the sales of the software used to design semiconductors. All very complicated stuff, but we are seeing moves higher in Synopsys today. That's up 6%. Cadence Design Systems up the same amount as well. We saw Siemens rallying here in Europe, so keep an eye on those today. Then we've got delivery stocks in focus. BNP Paribas, Exane upgrading a couple of those. So FedEx is the one they like as they navigate the disappointing results from last week in terms of the Amazon impact. Amazon not as profitable for FedEx despite all those parcels that are delivered, and UPS also comes up as well. So gains in both of those delivery stocks this morning. Then finally, Tesla. Not so much about the spat between Musk and Trump. This is about the sales. We did see a jump in the stock yesterday. It was up 5%, getting back closer to that record high. And we're up once again this morning. So expect to see Tesla continuing that run. And as always, check out the Before the Bell opening wrap for the fantastic summary of all these news movers and more, Danny.
Joe, thank you so much. Appreciate it. And should just flag that equity markets will be closing at 1 p.m. in a holiday shortened trade. So get your movers in now. And in just moments, we're going to take a closer look at gilts in this global bond market on fiscal concerns. Noon's Ella Hoja will be joining us. And later in the hour, we push ahead to the jobs report with Mizzou host Steve Ricciuto. Now, UK 10-year yields are pairing losses and rallying this morning after sinking yesterday on speculation surrounding Chancellor Rachel Reeves' future. Ella Hoja of Newton Investment Management writes, quote, UK markets became the center of attention. Oh, sorry, rather, this is not Ella's thoughts right here. Let's take that down. But markets have become the center of attention in the past 24 hours. Let's indeed get Ella Hoja's thoughts on this. She joins us now. Again, that's not a direct quote from her. Ella, I want to get your thoughts on what's happened in the UK gilt market over the past 24 hours. Investor fears may be calm this morning after Keir Starmer saying that the Chancellor Rachel Reeves will be sticking on, who is more concerned about the fiscal picture. Just how sensitive does this market remain to be?
Yes, it's interesting because gilts are very closely watched by investors because this is where we first started fiscal concerns a few years ago now, right? So we had that mini episode of September 2022, which turned out into a major episode for bond markets. So yesterday, a little bit of a reminder of what happens when bond investors get nervous on fiscal. So you had bond yields up, sterling down, and UK equities underperforming relative to other markets. So I think, look, the mentality has shifted in bonds. We've talked about this a few other times on this show in terms of the jitters around fiscal concerns. Those remain. We're very much in that path for bond investors, and it explains why we've been seeing steepening of curves. So it's not just pertinent to the gilts, but because of the need of funding from foreigners for the gilt markets, those nerves are pretty frail. And so it shows how little room there is to maneuver from a fiscal perspective, particularly for the UK.
But it also is a reminder, Ella, that though the concerns might be similar, it is a very different market between the US and UK, that you can have this instantaneous, really sudden reaction. Whereas in Washington, D.C., there is a vote ongoing right now. I believe in about 30 minutes, we're expecting the House to do the final vote for the One Big Beautiful Bill. And it's a bond market that hasn't been reacting. Is there enough premium priced in for growing deficits?
The answer is no. And the way we can compare that is if we look in the sort of pre-2000s world where we demanded more term premium to be out in the curve, we sort of repriced relative to that history, but only about halfway through if we look at our models, which means there's still more room to go. So even if just comparing to where we were pre-2000s, right? So if you look at the long history of bond markets, when there's concerns on fiscal, when there's concerns on inflation, term premium can rise substantially. So the short answer would be probably we haven't priced enough risk premium.
We haven't priced enough risk premium, but it's a market that maybe is paying more attention to the cyclical factors of where growth is going and what sort of Fed cuts we might get, Ella. Does that at the end of the day not weigh out what is, again, not cyclical, which is secular, which is what's happening with the fiscal budget? Is at least in the term, in the here and the now, are Fed cuts in the economy not outweighing that for this bond market?
I think that's the reason why the front end is more anchored. So you look at the 2 to 5 year part of the curve and yields are much better behaved. It's also one of the reasons why the 10-year yield is at 4.25%, given those fiscal concerns. If it wasn't for the cyclical weakness that we're seeing, so we're seeing things soften down in the US, then perhaps bond yields would be significantly higher. Look, I'm definitely in the camp that believes fiscal will matter for the medium to long run. It's very difficult to know exactly when we engage with that, and the case in point has been the UK, but it's very much on the forefront of investors' minds, and it's a sentiment issue. So the moment that markets decide to engage with it, you can move pretty rapidly.
Can we talk about the sentiment right now, Ella? Because risk assets have been doing extremely well, from credit to equity. How do you interpret the trend we've seen at the past 3 months? Is it renewed risk appetite and sustainable momentum, or is it just something of a correction of what was really negative sentiment to start the year?
Well, there was a lot of negative sentiment. We had a lot of event risks. We had a lot of policy reaction functions. So we've sort of priced a majority of those out. And look, volatility is suppressed. Where bond yields are trading in the soft landing narrative, So if you look at that perspective, there is nothing that's sort of concerning investors too much. And we've navigated a couple of potential hotspots this year, whether that was in the Middle East or around April, you know, with the tariffs oncoming. So we've kind of gotten comfortable to this environment now where volatility is low, growth is okay, even if it's slowing down, but it's not a disaster, and policy is easing. Because if you look at across the world, central banks have been easing policy. So this is how you can explain it. Doesn't mean you can extrapolate this in the future. It's going to depend a lot on what happens to inflation, because we have this base effects component that starts to peter out into the second half of the year, and how we're going to feel about fiscal, right? Because this is going to matter. And I really believe in the next 2 years, this is a very major theme for financial markets.
But if you want to buy risk assets, Ella, why would you even stop? Because we've learned, to your point, that war doesn't disrupt the trend, or if it does, it happens very quickly. You can even go back to COVID. You can go back to tariffs to start this year. The rebounds seem to be getting quicker and quicker. Ella, is it now just this Pavlovian urge to buy the dip that continues to be fortified and justified, but what we continue to see year after year?
Yes, it's been validated, right, and rewarded to do so. So you've been incentivized to buy the dip, and even the retail component of markets has learned that reaction function and has been rewarded handsomely for it. But this is where I bring this dynamic of what happens to bond markets, because I do think it could be a driver for risk over the next few years. And the reason for that is every time we've sort of gone through this range of 5% and above, we've sort of started to reprice risk in a very different way. So because we're trading in this sweet spot, there's no reason to panic. And when you get the panics, as you say, they tend to be short-lived and they're faded fast. And the policy reaction function has supported that, right? So we've had either a response from the Fed or central banks, or we've had a fiscal response, or in the case of tariffs, we had a bit of a reversal in the policy. So you've been rewarded to play that way. That's why I think, aside from that, the dynamic that could dominate is where interest rates land on the long term. And I think that's a bond market issue, and that's going to be the driver going forward.
Hey, Ella, just quickly, to be clear, do you think that 5% is higher, and higher is something realistic for something like the 10-year? Because you say that that's the level that would upset equity markets.
It's given us a good range to play for and against, right? So that 3.5% to 5% has been a strong range for us. So we've tried to push against it in either direction. I reckon over the next, I cannot tell you exact timing. Timing is not my forte, but I can say that with conviction, actually, that over the next, let's say 6 to 12 months, we're probably going to push on the upside of that and explore new highs in yield. Yes, and I think it's driven by this. So lots of supply. Who's going to buy that supply in the absence of a major cyclical slowdown? I think that's the big question to answer.
All right, Ella, we're going to have to leave it there. Thank you so much for joining us this morning, Ella Hoja of Newton Investment Management. Let's now get you some other top stories trending on the terminal this morning. As we've been talking about, UK markets are rebounding, pairing steep losses after Prime Minister Keir Starmer said Chancellor Rachel Reeves will stay on in his cabinet for many years to come. UK markets slumped on Wednesday over speculation on Reeves' position. European companies, including ASML and Airbus, have called on the EU to suspend the implementation of its landmark AI regulation. Firms say the EU is risking its own ambitions in the field by reining in the most powerful AI models, calling on the President of the European Commission to take a more innovation-friendly approach to regulation. And a member of Bank of Japan's board has warned that the central bank's rate hike cycle will resume after what he believes is only a temporary pause. The member kept his hawkish tone despite the cloudy economic outlook, particularly amid ongoing trade uncertainty between Tokyo and Washington. Coming up, almost at the finish line, you're looking at live pictures of the House with Republicans clearing a critical procedural hurdle to advance the big, beautiful bill. The debate goes on. We'll have the latest on your brief.
Because when it comes to everyday Americans, this one big, ugly bill will hurt the quality of life of hardworking American taxpayers, and it's all designed to put a happy smile on the face of billionaires. That is inconsistent.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Foreign and Central Portugal, and this is Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
There's this feeling that the labor market is contracting.
There's some risk that layoffs are growing.
Medium-term outlook is the economy should be fine.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The weakening trend continues.
This is a trend. We're seeing declines.
If you're not with a job right now, it's harder to find a new one.
The June Jobs Report, today on Bloomberg.
It's been a good day. We're in a good place right now. This is the legislative process. This is exactly how I think the framers intended for it to work. We feel very good about where we are, and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people. This is going to be a great thing for the country. Look forward to moving it forward.
Just a few hours ago, the House finally voted to move towards a final vote on President Trump's so-called Big Beautiful Bill. You're looking at live pictures of Hakeem Jeffries, representative there, debating this bill. He's been speaking against it, as you likely would assume, from the Democratic representative. Let's get more now from Bloomberg's Josh Galou, who's also been tracking the vote. So, Josh, what comes next?
Well, as you said, overnight in Washington, they were able to do, the Republicans were able to clear a procedural hurdle that brought the bill to the full floor for debate and ultimately a vote, which we expect to happen relatively soon now. It's of course a major development because it answers the question of whether, many of these holdouts within the Republican Party were willing to set aside some of their skepticism about the fiscal impact of this bill, which is estimated to be roughly adding $3.5 trillion to the deficit over the next 10 years, and instead go along with the strong political push by President Trump to get this bill passed not only in its entirety, but also by the July 4th self-imposed deadline that he wanted, and it looks like it's on track to do so.
Yeah, and it took a while, Josh. It's been the longest GOP House vote in history. They set a new record with this. And to your point, President Trump putting on Truth Social, basically saying MAGA's not happy, it's costing you votes. What are you trying to prove? What are you waiting for? Josh, does this really just show that the president still has the ability to move his party in the direction that he wants?
I don't know that there's any other way to read this other than a massive victory for Trump and really just bowling over the fiscal conservatives who have stood on the sidelines here and tried to put up some barriers. They've tried to give them a little bit of political cover with an accounting gimmick where they essentially say that they don't count the Trump tax cuts from 2017 as any. They count that as the baseline, so they're saying the additional tax cuts will not add to the deficit. So that's giving them some political cover, but really here, this is a huge victory for Trump in pushing through his domestic agenda. And it doesn't really indicate that there's much opposition within the party that at least would make a difference. Of course, as we know, this is being done through reconciliation, which requires only a simple majority. It means all the Republicans, other than they can only stand to lose 3 in the final vote to get it passed. But you know, that's a huge amount of solidarity for an otherwise controversial bill that's going to really raise questions about people's reelectability depending on how this impacts their districts. They've had to swallow what are going to be massive cuts to Medicaid. You know, in rural areas, that's really going to hurt some of these people, and they're going to have to answer for it. Although some of these things are not going to take effect until after the midterm elections by design, so they may be able to dodge that bullet. But in any case, to your point, this definitely shows that Donald Trump still has his party well within grasp.
All right, Josh, we're going to have you back because, as we've been noted, this is a vote that is still ongoing. We did hear from Johnson saying that it would likely be passed before people had their morning coffee, so that could be any time, or for our viewers, you're probably drinking it right now. Josh, thank you so much. Now, in the meantime, in Washington, D.C., President Trump announced late yesterday that the U.S. has reached a trade deal with Vietnam. It will be a 20% import tariff. Bloomberg's Brendan Murray joins us now. Brendan, do we have the blueprint? Does it seem like more deals like this are on their way?
Yeah, it seems like the trickle of deals that we've seen over the past couple of weeks. We had one with the UK, we had an extension of an arrangement with China, and then now this Vietnam deal. This trickle of deals is going to start picking up some pace over the next several days for this other deadline that Trump has set of July 9th for negotiations to conclude, for countries to put their best deals on the table, and for him to be able to announce more arrangements like this. The Vietnam deal is important because Vietnam is a place where a lot of exports have come instead of coming from China over the past few years. So Vietnam's trade surplus with the U.S. has widened considerably. So the Trump administration has this kind of two-tiered system: 20% tariffs on Vietnamese imports, and then a 40% tariff on imports deemed to be actually produced in China but just transshipped through Vietnam. So we will look closely to see whether this is a template for other deals for countries in Southeast Asia, as the administration tries to bake in some of this idea that countries ought to de-link themselves with China in global supply chains.
The market reaction was also fascinating because it was one of relief, it was one of a rally, Brendan. But if you just look at a company like On, for example, that makes the running shoe, they had assumed for their guidance a 10% tariff from Vietnam, to which it has huge exposure. 20% is double what many, including companies like this, had been expecting. Brendan, what will be the ramifications of that?
Yeah, exactly. These companies are going to they're going to take a hit on their margins in the short term, but overall it seems like the market is saying these adjustments can be made without huge damage. Remember, Vietnam was facing a tariff of 46%, which would essentially cut off a lot of, if not all of trade. So I think there's a bit of relief that the worst case scenario didn't happen, and we'll see whether other countries in the days ahead. We hear that India, and have reported that India is close. There are other countries that consider themselves to be in the final throes. Switzerland, Taiwan, the list goes on. But so we will see. The Trump has his big beautiful bill to look at today, but these trade deals are coming right on the heels of them.
All right, Brendan, thank you very much for that. That is Brendan Murray, and you're watching Bloomberg Brief.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Get you some front page news this morning. First up, most outlets leading with the House bill vote. The Washington Post among them, clearing a procedural hurdle on Trump's agenda that now paves the way for passage. We're keeping an eye on the progress of those votes. Hakeem Jeffries speaking now out against the bill. Speaker Mike Johnson says that the Republican leaderships have enough votes to send the bill to the president's desk before July 4th. And an interesting one on the Journal reporting that CEOs are saying the quiet part out loud, AI will wipe out jobs. From Ford to JP Morgan, bosses are telling investors that they expect corporate workforces to be smaller while AI replaces white-collar work functions. Now, speaking of which, we are going to be getting the jobs report in just about 8:30 a.m. We're going to count down to it. We're going to be catching up with Mizzou host Steve Rasciuto on that next. You're watching Bloomberg.
Had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. On to the final vote. House Republicans clear a major hurdle to advance President Trump's tax bill. Trade talk, bargaining chips. The U.S. lifts export curbs on China for semiconductor design software. And Jobs Day coming a day early. Forecasters anticipate the Trump administration's policies to begin hitting the labor market. It is Thursday, but it is the last day of your trading week after an all-time high yet again for the S&P. It is little change this morning. It seemed that the trade deal with Vietnam was the latest fuel for the fire. But it is Jobs Day. It is a bond market, though, that is rallying. Ahead of that, perhaps it's the UK bond market that's pushing things here. You can see gilt yields on the bottom of your screen after the Prime Minister reaffirmed that his Chancellor will be staying on. Your 2-year yield down by 1.8 basis points. Your 10-year yield about 1.5 at 4.26. Let's get you some stocks on the move this morning before the early close. 1 p.m. is when equities will close. Joe, what you looking at?
Hey, Danny, I feel like that early close makes my segment even more important today because you need to get those orders in before 1 p.m. But what we're looking at is the industrial software makers, given that news on the restrictions against China being lifted in terms of being able to sell the software that designs the chips to the Chinese. And we are seeing a gain in both Synopsys and Cadence Design here in the pre-market. And we also saw Siemens gaining in Germany as well. Keep an eye on those two here in the pre-market. And then in the delivery space, FedEx and UPS, both of those upgraded at Exane BNP Paribas this morning, which thinks FedEx is actually going to be the one that's going to navigate the headwinds coming in from Amazon. Amazon, in FedEx's report last week, was actually a bit of a wait, not as profitable on the stock as expected. Both of those edging slightly higher today. Then finally, Tesla getting another boost. It was up 5% yesterday following those stronger than expected quarterly sales in the EVs. We're up another 1% today. Will we soon head back to the record high? We'll have to see. But Tesla edging higher once again in the pre-market today, Danny.
Joe, your segment is always important, regardless of when markets close. Thank you very much for your work this week, Joe Easton there. Now, in just under 3 hours' time, we will be getting the June payrolls report. Pleased to say that Bloomberg's Michael McKee joins us now for a preview. Mike, great to see you. So what are you looking out for?
I'm looking out for Highway 22 in the Hamptons and how crowded it gets, how early. If we get a big number or really no number today, people are going to have to stay around and trade longer. Otherwise, we're out the door. The numbers are expected to show some impact of trade and chaos in the fiscal space, with just 106,000 as the forecast consensus, 95,000 for the whisper numbers, so Wall Street leaning towards pessimism. Unemployment, 4.3%. This is going to be a case of rounding when we look out to 3 digits, because we barely rounded down to 4.2 last month, and it could go as high as 4.4, depending on where we end up. Jobless claims are out today as well. 241,000, that's about where we are right now, so if there's a big change there, that could also have something of an influence, although payrolls is the number to rule them all. Continuing claims is the one people have been focused on, because how hard is it to get a new job? It seems to be getting a little bit harder if that number goes up to something else for people to watch. It's so early in the morning, I couldn't come up with a better title than Datapalooza for these things. We also also get the trade balance today, the advanced trade number, much bigger than anticipated. We'll see when they put services into this, whether it really moves or not. ISM Services is out at 10 o'clock. Less influence now because we'll already have the payroll numbers, but people will be watching the prices paid number. That is forecast to be about where the ISM manufacturing prices paid number are, showing some inflation out there. We get factory orders, the capital goods number expected to be unchanged from the earlier durable goods report. I do have one other chart, though, Danny, I want to show you because given the way this is all set up, yesterday we had the ADP number minus 33,000. That's influenced everybody to move their overall forecasts a little bit lower. Last time we were this low on ADP, negative 53,000 for March of 2023. The whisper number that day was 215,000, and look what we got, 238,000. But look what happened since. They've revised that 238 down to 85. So we could get a huge number today, we could get a low number today, and it won't be accurate either way. Steve Rasciuto is going to join you, and he can explain why. But there is a very wide error band around this. And the bottom line is the Fed has to respond to the number it has, not the number that it eventually will be. So if we get a big or bad number today, then the markets will create an agenda for the Fed July meeting. I don't think the Fed is going to move a whole lot.
Well, good. You could have gone to the Hamptons before the ADP report. It doesn't
get
even
out
matter.
there before the traffic gets
By the
really
way,
bad.
Datapalooza, just the worst party.
Yeah.
Just like, come on. We need something better than
We need something better. All right. By next month, y'all come out with something.
Yeah, perfect. Mike, thank you so much. Michael McKee, looking forward to you breaking down those numbers in just under 3 hours' time. As Mike hinted at, also around the desk is Steve Rasciuto, Chief U.S. Economist at Mizuho Securities. I'm guessing we can discount ADP on your end too, but what are you looking for? Because look, ADP, maybe you can't because the trend has been lower. Maybe it highlights a trend that we're going to see with NFPs too.
Well, there's no doubt that employment growth has slowed. Uncertainty has created some economic impact. There's no doubt about that. But when you look at things like claims, you look at where claims are relative to where the trend of claims is and how low it actually is. You look at continuing claims, especially relative to the number of covered employed, we're at all-time bottoms. Then you look at the JOLTS data that came out the other day, with openings being up more than expected, with quits being up more than expected, and layoffs being down more than expected. There was the trifecta of the JOLTS data all going in the direction of, labor market's really not going anywhere. Mike's right that, data gets revised substantially. The market does react to the data as it comes out. So does the Federal Reserve. That's what they unfortunately have to do because that's where the models are based off of. I think the reality is the economy's doing okay. Uncertainty has certainly biased things down. The question is, where do we go when the uncertainty lifts? And I think the progress being made on the tax bill is being ignored. This is a fairly significant stimulus. And even though we look at it and say, when you break it out over 10 years, it's this much a year. But if you look at the way the bill is structured, the bulk of that stimulus comes in 2026.
Yes.
And there is some in 2025, which is why there's a rush to get it done. So I think this is all, again, part and parcel of the administration trying to ramp things up going into the midterm elections in 2026.
So if we have the bulk of the stimulus happening in the short term, does that mean sort of the ruptures we get from the concern about deficit, the irresponsibility of it, that the timing is that you first get the stimulus and then those concerns come later?
Unfortunately, the question is, will those concerns ever come? Because we've been talking about budget deficits since Ronald Reagan went from 50 plus to 50 minus billion surpluses or deficits to 450 billion. We've been calling the end of the bond market. We also thought we'd never get back to a balanced budget, and we did. It took us a long time, but we did get back to it. And there was a time we were worried about the scarcity of Treasury debt. So the reality is the markets are big. Nobody else is borrowing but the federal government. Households are deleveraging. Corporates are deleveraging. The net demands on capital markets are not great. And that's the reason why long-term real yields are not being pushed higher.
Just one other thing on that. If we are going to be getting a bulk of stimulus in 2026, it's also when we'll have a new Fed chair. What happens if we get that stimulus at the same time we have a leading voice at the Fed who is pushing for more and sharper rate cuts?
The thing that I think people are missing over and over again is when you look at the dot plot, because we all love the dot plot, right? The chairman is one dot on that dot plot, and there is no bold dot to indicate the chairman's vote. The chairman is one vote. The chairman doesn't determine what the committee does. And this is where I think there's a misperception about what happens. Yes, the chair may be able to influence the debate, but at the end of the day, the committee takes the vote, and it's the committee's vote that counts.
But it is a precedent. I mean, it is convention, let's say, to follow the Fed chief, to have him be the leading voice. Are we entering a period then where convention is thrown aside? And doesn't that complicate the Fed's communication? Because when the Fed chief speaks, it's something you listen to because of that power that they have.
The Fed chair speaks for the committee. And that's part of the process of why the Fed's vote, the chairman's voice gets to be heard more, because they speak for the committee. The committee, however, is what he's speaking for, not for him or her own personal opinion. And we have seen historically in my day, not most people's day, where a Fed chair went into a vote and was outvoted, and he subsequently went to the White House to resign. And this was Paul Volcker. The only chairman in modern history whose vote counted more was Alan Greenspan. And, you know, we saw where that got us in terms of the financial crisis. Chairmen are one vote. That's it. They can't determine what's going to happen. The committee makes the decision. There's decorum. There's process. They have certain things they have to do. They have a dual mandate. It's all legislated by law. The ability of the chairman to influence the vote is one vote.
Steve, before we go, I just want to leave it on one other question, because the Wall Street Journal had this really interesting story today, basically saying CEOs are saying the quiet part out loud. They're talking now about how AI is going to be resulting in job cuts. Everyone from Ford to Microsoft. Andy Jassy had a really strongly worded email to his employees, basically saying some of your jobs are going to be replaced by AI. You should probably get on top of this thing. Have we started this cycle yet of AI displacement? Has it begun, or is this a concern further out in the future?
Again, when the technology revolution began, when the internet explosion took place, when computers showed up on people's desks, large sections of publication systems went obsolete. And over the years, we went from having secretaries and typing pools and everything. All those jobs are gone, okay? At the end of the day, employment's still higher. We can focus on the negative. We don't see the positive. The reality is there are a lot of other jobs that will be created as a result of AI, freeing up resources from other areas, because money that's not being spent on those people is going to be spent on new investment. And that new investment is then what drives the economy. And this is where it's easy to identify negative. It's harder to see the positives. And this is why it's easier to tell a bear story than it is to tell a bull story.
Yeah, I mean, these hyperscalers have been spending so much on it. So, I mean, at least that is certainly playing out now. Steve, thank you so much for joining.
Cheers.
Really, really great to have you on, especially on a Thursday that feels pretty much like a Friday, which I think we're all happy about. Mizzou host Stephen Rasciuto there. Coming up, we were just talking about it. We're going to get back to it. House lawmakers debating President Trump's tax bill right at this moment, ahead of the final votes. We're going to have more on that coming up next.
That diagnosis changed my life. And while I am grateful to be here, I can...
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
As
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
It's been a good day. We're in a good place right now. This is the legislative process. This is exactly how I think the framers intended for it to work. We feel very good about where we are, and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people. This is going to be a great thing for the country. Look forward to moving it forward.
Speaker Mike Johnson confident that a vote will be finalized this morning in the early hours. You're also looking at live pictures of Minority Leader Hakeem Jeffries. He's expected to speak on the floor for about an hour as lawmakers gear up for a final vote on President Trump's tax bill. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, the procedural hurdle was cleared. What now?
Yeah, hey, Danny, good morning. So it appears it took this overnight session, but Republicans are on track for final passage of President Trump's one big, beautiful bill. To sort of get our bearings here, what's happening right now is House Democratic Leader Hakeem Jeffries is speaking. He's afforded something known as the magic minute, which means he can essentially go on for as long as he wants. He started speaking at 4:54 a.m. Eastern, and our reporting indicates we're expecting him to go about an hour or so. And once he finishes, then that's when the vote on final passage will begin. We are not expecting the final vote to actually take that long because it does appear that they've reached some sort of deal, some sort of agreement with those holdout Republicans to get them on board. So we're expecting it to be a pretty snappy vote at the end of the day in order to get it over the finish line. And that's really one of the big questions remaining here. What did those holdout Republicans, particularly members of the House Freedom Caucus, get in exchange for their votes? Because I have to say, I was on Capitol Hill yesterday. I spoke with Congressman Chip Roy, a Republican from Texas, who was one of those holdouts and threatening to bring the Senate back into Washington in order to negotiate this. But for context, the House is voting on the Senate's bill with no changes. This bill is not ping-ponging between the chambers because that would have taken way too much time and they would have failed to meet President Trump's July 4th deadline. So we're waiting for any sort of indications on if the White House offered, for example, executive orders or promises of more legislation down the line in order to get their votes on board. That's going to be really critical here. Or did, Danny, President Trump's pressure enough? Was that enough to get the Republicans over the finish line? Just lastly, I will say the magic number that we are looking for going forward is 217. That is what they need in order to pass this package.
What sort of pressure have we seen from the president, Tyler? Because it does seem that he had been putting statements out on Truth Social all throughout the night as these votes were taking place.
So we know that he was in constant contact, was the framing that an administration official told us here at Bloomberg News. When it comes to the sort of calls that he was making, he also had invited some of the members to the White House yesterday. Though I have to say, after those Republicans did return to Capitol Hill, it didn't appear to be enough. So they started to dispatch administration officials to Capitol Hill overnight. And one of the themes that we keep hearing about is that administration officials spoke about the fiscal trajectory of the country. We know that they like to talk talk about the idea of stabilizing the debt to GDP ratio when fiscal hawks raise concerns about how this will add to our mounting national debt. They also like to talk about tariffs as a revenue raiser, for example. So we have a feeling that a lot of those conversations were probably happening overnight. So that's sort of the pressure that was applied yesterday. But more broadly, if we look at the holistic picture, President Trump has been threatening to primary some of these members if they don't get on board with his bill. And I will point you to one member in particular, Thomas Massie, a Republican from Kentucky, voted against this bill back in May, but he flipped his vote and he voted in favor of the rule earlier this morning. And that is significant because it does appear that he's trying to make amends with the Trump administration, since we know that he would like to see the pressure let up after President Trump did launch a super PAC to fundraise against him in his primary, even if he did get a boost from Elon Musk.
Tyler, after this bill does pass, we've heard from the likes of Kevin Hassett saying that after it passes, trade deals can come through. We already got one from Vietnam late yesterday. Is that the order of things? Should we expect more announcements from this White House once the bill is finished?
Well, that's definitely what the White House would like to see happen. We know that they are trying to show forward progress, and it was interesting to hear the surprise announcement yesterday from President Trump announcing what the tariff levels would be when it does come to Vietnam. We are watching very closely a few other economies in Asia that this administration has indicated could be top of the line and priority for them in order to advance that agenda. It's really important to them because they are looking for a confluence of different economic factors to happen over the summer. First was the taxes, then they want to see the tariffs, and they really want to tout the revenue that they are getting from the tariffs as well.
Tyler, thank you so much for your coverage. Looking forward to it all morning as we track the votes. Tyler Kendall in Washington. Meanwhile, the Trump administration has also lifted export license requirements for chip design software sales in China as part of the trade deal to ease some restrictions on critical technology. Some of the affected software providers include Synopsys and Cadence Design Systems. They're both jumping in the pre-market trade. Joining us now is Bloomberg's Peter Elstrom. Peter, why the let-up in this restriction?
Yeah, Danny, it was just in May that we heard from these companies that they had been hit with these new restrictions on what they could do, what they could sell to their Chinese customers. It seemed like the Trump administration was pretty determined to convince these companies. They supply EDA equipment, electronic design automation tools. These are software tools that companies use to actually design semiconductors. The Trump administration wanted them to stop selling those tools into Chinese customers as part of this broader strategy of trying to hold back China's advances in technologies, critical technologies, particularly semiconductors. Now what we're hearing is that's back, they're pulling back. This is part of the broader trade talks where the U.S. and China are trying to reach some sort of compromise. When China pulled back on shipping rare earths and minerals into the United States, this EDA restriction was put into place in reaction to that. So now we're seeing a let-up as the two countries kind of back away from that extreme position that they had in the past with these trade talks, and they're moving towards some sort of compromise.
There's that element of it, Peter, but then there's also the likes of Jensen Huang, who's been very vocal in saying that what is happening with these restrictions is limiting American technology's ability to grow, and instead you just get more homegrown Chinese technology that can supplant it. Does this suggest at all a Trump administration that's more amenable to that argument at all, Peter?
Well, it's interesting. You definitely hear that argument much more, especially from Jensen Huang, who, of course, has a lot of money on the line. NVIDIA would love to be able to sell all of their AI chips into the Chinese markets and many other markets, too. What we did not hear, though, is that the Trump administration is backing off NVIDIA chips in particular and restrictions on them being sold into China. Those are much more sensitive. Those can be used to train the kind of AI models that you would see from the likes of DeepSeek and Alibaba. They're pushing quite hard to develop those technologies. So allowing EDA tools to be sold into Chinese customers is one thing, but allowing NVIDIA's most advanced chips to be sold into Chinese customers is not on the table at this point. That's much more serious and does not look like they're going there. But you raise a good point. There is this argument that if NVIDIA is able to sell into the Chinese customers, then those Chinese customers are not going to turn to domestic alternatives. Huawei so far has been the most advanced at developing alternatives to NVIDIA chips. If Huawei is able to get pretty good volumes and pretty good revenue from this, they'd have more resources to be able to pump into that effort, the research effort that they're making right now. So that's the argument. We've heard a bit about it. It doesn't look like that side is winning at this point, but they're not done certainly making that argument.
Peter, really appreciate it. That is Bloomberg's Peter Elstrom. Now, coming up, we're going to set you up for your holiday shortened week. We're going to have data coming ahead of July 4th. That's next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Let's get you set up for your trading day on this Thursday. House lawmakers are set for a final vote on President Trump's tax and spending package this morning. Plus, we get a lot of data because markets are closed tomorrow. We're going to get the jobs report, jobless claims, all those at 8:30 a.m. Then PMIs at 9:45 and 10 a.m. Eastern. And just as a reminder, U.S. equity markets will be closing early, 1 p.m. ahead of the July 4th holiday. All right, a check on your bond market. Ahead of that jobs data, 106,000 is the estimate, 95,000 is the whisper number, but perhaps what's driving things more this morning is what's happening in the UK. You can see 10-year yields down by 8 basis points. That's after a lift of nearly 16 basis points yesterday. That was the biggest rupture in UK bond markets since the Liberation Day turmoil in April. All of that surrounding concerns about the fiscal deficit there and whether the chancellor would stay on. So it is a global bond market rally this morning. All right, that's it for your Bloomberg Brief. Surveillance takes things from here. This is Bloomberg.
cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Most likely, we see a slowdown in payroll growth. Over the next couple months, we see this gradual slowdown.
The data is going to weaken. The growth rate is going to fall. The unemployment rate is going to rise.
If you get a 0.2 rise in the unemployment rate, the market is going to respond quite negatively to that.
Labor demand has cooled significantly, but we're not seeing mass firing.
If we see a sub 100,000 job and certainly a negative jobs number, that would start to create the narrative of weak, hard data that would allow the Fed to cut rates.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, they have the votes.
We're in a good place right now. This is the legislative process. This is exactly how I think the framers intended for it to work. We are going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people. Look forward to moving it forward.
House Republicans heading towards a final vote on the one big, beautiful bill. As investors gear up for a very rare Thursday jobs report later this morning, President Trump is doubling down on his criticism of Fed Chair Jay Powell. Is Operation Get to the Beach slightly delayed?
And that seems to be the story of the year, where every time we think that maybe we're getting some certainty, it seems like, oh, just hold on a second, there's just one more wrinkle. That said, heading into the second half of this year, one thing that I've really noticed in all of the analyst notes and frankly in the policy as we see solidify in Washington, D.C., there is a modicum more of certainty, a sense of we understand what the range of extremes is, and we have a greater sense of exactly what could get through the House, what could get through the Senate, and what Hakeem Jeffries is holding up for a couple seconds before it gets through.
Few more hours?
Yeah. I don't know. I think the magic minute is more like, the magic hour. So we'll see.
Then once you get past taxes, it's on to trade on July 9th. One of my favorite stories of the last 24 hours. Vietnam, you get a 20% tariff, and Nike rallies. Nike rallies because 20% is not 46%, and apparently that is good news.
Yeah, Nike, Lululemon, we saw on holdings because they were worried that they might get something like a 45% or 46% rate, which was the initial one that was placed on Vietnam. There is this feeling that given how much lower costs are in places like Vietnam, something like a 20% tariff rate could be absorbed. There also is a feeling of the punitive aspect of Chinese exports that go through Vietnam. That's going to be 40%, but it's not going to necessarily be a deal breaker where suddenly trade between Vietnam and the U.S. are cut off. So is this the paradigm where you just want certainty and then we can rally even though it means the highest tariffs going back to the 1930s?
We'd love some clarity on something right now. Later this morning at 8:30 Eastern Time, you get a jobs report. I'm not sure you'll get any clarity whatsoever. Whatever this number looks like, there'll be a massive debate on Wall Street. Is it a reflection of draining immigration out of the labor market, or does it speak to a weakening In jobs, this is what we're expecting. The median estimate in our survey, 106K. The high is 160, the low is 70. The president's already saying too late, should resign immediately. And I have to say, when he put that out on social media yesterday, a lot of people asked the same thing. Did the president just see the jobs report? And that's unnerved some people going into this.
Yeah, which raises this issue of how they're going to message it, which you've been asking about for quite a while. You have to wonder that. He's also been calling him too late for a while, and this was tied to some of the renovations of the Federal Reserve, so hard to really parse through this. That said, what is weak? And we've been talking about this extensively. A low headline number doesn't necessarily mean a weak market for jobs. It might just mean that there is a low hiring, low firing dynamic. That's the reason why 4.26% unemployment rate going up to 4.28% will be deeply parsed. And if it goes up to 4.36%, all of a sudden the world will collapse because you've got a 4.4% unemployment rate rounded up.
Stephanie Ross is going to join us later from Wolf Research, right? And I remember a few months ago, she said, you could see jobs sub 100K and you could still see unemployment held steady and it maybe even falls. That's a dynamic that I don't think we're prepared for, but it's a lot of things that are on the minds of economists right now on Wall Street.
Yeah, she also thinks that the headline number is going to be something like 130 jobs added, but then it's going to get revised down to 100,000 jobs added in the post-payrolls revisions, which just highlights the number generator that we're talking about here and how much people take a look at this stuff and say, okay, this is an approximation of now, it will change.
Jobs report at 8:30, 8:31, the rush to the beach begins here in New York City ahead of the long weekend. Equity futures on the S&P just about unchanged on the S&P 500. Coming up this hour, Max Kettner of HSBC with stocks back at record highs. Andy LePerrier of Piper Sandler as the House nears a final vote on the tax bill. And Sarah House of Wells Fargo looking ahead to the payrolls report. We begin this hour with our top story. President Trump's tax and spending bill heading for a final vote in the House. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, we're getting closer.
Yeah, hey, John, good morning. We're definitely getting closer. It took all day yesterday and an overnight session, but it appears Republicans have paved the way to pass President Trump's cornerstone of his legislative agenda. Now, to sort of get our bearings on what's happening right now, we see House Democratic leader Hakeem Jeffries. He's speaking on the floor. He's afforded something known as the magic minute, which essentially means he can talk for however long he wants. He started at 4:54 a.m. Eastern. We're not expecting him to go on that much longer because once he stops, that's when we are expecting that vote on final passage. And we're actually thinking that that vote's going to get wrapped up pretty quickly because it appears that these holdout Republicans were able to reach some sort of deal in order to get them over the finish line. And that's one of the biggest questions here this morning, because I have to say I was on Capitol Hill for a long time yesterday and I spoke to many of these holdouts, including the chair of the House Freedom Caucus, Andy Harris, also Chip Roy, a Republican from Texas, both of whom were threatening to bring the Senate back into session. But at the end of the day, that's not what happened. The House is accepting that Senate's bill. So that means, did they get some sort of concessions from the White House when it comes to executive orders or legislative commitments down the road? Or was President Trump's pressure enough to flip them alone without any sort of tangible concessions? Because, John, flip they did, including one member that we have been watching closely, Thomas Massie, a Republican from Kentucky. We weren't expecting him to vote for this. He voted no on the package back in May and faced a primary challenge from President Trump because of it. He voted in favor of the rule. That was a pretty significant development, and we are expecting that he could vote for final passage here, although anything could really happen.
Tyler Kendall with the latest. Tyler's going to be tracking the story for us throughout this morning. Tyler, thank you. Can we stand those pictures just for a beat? Trying to figure out if she was sleeping or on the phone.
Oh, she was 100% sleeping.
You think she was sleeping?
Absolutely. Look at her eyes. I mean, honestly, I don't blame any of these people. They've been up all night. They've been up. They came from their beach to come back to vote on this. They don't exactly look pleased. Check it out.
What did you do yesterday? Like the world's smallest violin for these guys. Yeah. Here's the view on Wall Street this morning. Max Kettner of HSBC writing, with widespread pessimism and markets facing a massive wall of worries in the coming weeks, there's more than enough to keep investors cautious. Max joins us now for more. Max, you've been constructive, bullish for quite a while now. Do you think this market is going to look through any potential weakness at 8:30 Eastern Time?
Yeah, I think it depends what kind of weakness we get. I think if we track sort of like roundabout within 50K downwards of price, I think that actually would be taken probably with a sigh of relief after the negative ADP numbers yesterday. So if we had a sort of 60, 70, 80K number, I do think that actually is probably a pretty good Goldilocks kind of outcome, where, you know, you get yields down, but also risk assets across the board can rally, perhaps even with a bit of a weaker dollar, because people would probably take that as further evidence of the labor market getting a bit weaker, even though I'm not fully on board with that, because again, when we look at a lot of the data, even yesterday, right, a lot of the focus was on that weaker ADP data. But let's face it, when we look, for example, at the job cuts number yesterday, which frankly everyone sort of ignored, but then, you know, you look at that, that's been going down to pretty much the lows from late last year, with pretty much almost all the sectors recording less and fewer job cuts. And still, people are squarely only focused on that negative kind of connotation. And that really tells you also where positioning is. So what is remarkable still to us, I keep banging on about it pretty much every week when I'm on with you guys, it's like, oh yeah, positioning is still low, people are still bearish, and there's still no sell signal, and it just keeps continuing. We're still at an all-time high, we're printing new all-time highs in stocks, spreads are grinding tighter, and you're still nowhere near, you're a gazillion miles away from a sell signal. And that's what keeps this market in this kind of Goldilocks state.
Max, yesterday was a really interesting case study, I think, for the trade story. A week away, the president comes out and declares some kind of an agreement, a trade deal with Vietnam. And companies exposed to Vietnam, the likes of Nike, rally on it. 20% tariffs and Nike rallies, because this market was still anchored to the risk that maybe it's going to be the 46 he announced on April 2nd. Is there a read-through there from yesterday, maybe into July 9th?
To me, there is, because not only in terms of the amount of tariffs, but also in terms of perhaps any kind of potential deals until then, or maybe even perhaps after the 9th of July. Because, of course, you know, I think the market, and particularly risk assets, will take it increasingly as a positive once you get another couple of trade deals over the line. And, of course, you could say, well, but the average tariff rate, isn't it going to be higher, and obviously much higher than compared to what we had a year ago or even 6 months ago? Fine. But what we do have is clarity. We have less uncertainty. And let's face it, when we look, for example, at all these sort of popular economic policy or political uncertainty indices, trade policy uncertainty indices, all of those have been in uncharted territory, particularly in April. They've been even higher than during the depths of the COVID lockdown. And of course, any kind of marginal decline in uncertainty, any kind of marginal increase of clarity, in fact, should be helping investment. It should be marginally helping perhaps consumers, helping companies to have a bit more clarity and to move on from that in the second half of the year.
Which raises this question, Max, what's being priced in? I mean, essentially, anytime we get clarity, people say, oh, that's priced in. But the clarity is different every single day, whether it's the clarity of what kind of rate we're talking about with tariffs, or the clarity of how big the U.S. deficit is going to be. All of these worries that we had earlier in the year that are now being shrugged off as priced in. How do you determine between rational versus numb?
I think it is entirely rational, because when we look, for example, at what is expected for the Q2 reporting season, about to start next week, you know, we started the Q2 expectations, bottom-up expectations from consensus about 3 months ago with around about 10%. We're almost only at 3.5% now, right? So consensus is saying earnings sequentially, quarter on quarter, will be dropping by 1.5%. Even tech earnings are expected to be flat quarter on quarter. So you can already tell what consensus has been doing, you know, and what they're sort of pricing in terms of the earnings development, and what they're really expecting in terms of the fallout, even during a quarter where top-down we're probably seeing a lot of evidence of front-loading of activity. Bottom-up consensus is actually saying, despite that front-loading, and despite that front-loading perhaps helping activity, that still wasn't enough to actually keep earnings higher. So to me, when we look at the next 2 months, you know, when we get those earnings, particularly from the mega caps, always remember the mega caps, they make most of their earnings outside of the US. They make above 50% of their revenues from outside of the US. So the weaker dollar is a massive tailwind there. I think there's a very, very decent chance that we actually do squeeze, and we do squeeze a lot higher in the next month or two after the reporting season, and particularly the tailwind from that weaker dollar. I think that is not at all baked into those earnings expectations and not priced in yet.
Is there anything you could see at 8:30 a.m. Eastern time that could change your view and make you question your thesis?
No, not really. I'm pretty convinced right now, to be honest. So, because the problem also is on the labor market. It's kind of cherry picking right now, right? Obviously, people have been looking at the ADP yesterday, but you can look also at the Challenger job cuts, and you get a completely different picture. You can look at jobless claims, you know, initial jobless claims. Yeah, they're down a bit. Continuing claims have gone up a lot. But again, even there, when you look at 3 states, you look at Texas, Florida, you look at Minnesota, actually, that's almost 70% of the increase that we had in continuing claims since the end of April. So very specific factors, not broad-based. Right? We look even at warn notices, fine, but if you look at the warn factor, that is still within the range since COVID ended in 2021. So, there's a lot of things that when we look a little bit under the hood, the labor market weakness does not look as acute as people are sort of selling it, I think.
Hey, Max, just to put what you've just said another way, you're basically telling Lisa that you don't care what the number is at 8:30 Eastern Time. It's not relevant to you.
It's not really, because I think we've had such huge levels of uncertainty, right, in the last 3 months that I just can't. I have a really tough time to compare that to a normal time in January, for example, or sometime last year. Who knows? Isn't the fact, for example, isn't the risk much bigger that, we had in April and May, we had 140 and 150K job gains, roughly, during peak uncertainty. Doesn't that also mean, doesn't that introduce the risk that in the next 3 months, if we get a bit more clarity, if we get slightly less uncertainty, doesn't that really introduce the risk that perhaps we get 1 or 2 months of really strong jobs data? As much as I buy the story of, tariff-related front-loading of activity, but isn't there also perhaps companies sort of holding off on hiring, companies holding off of investment with a bit more clarity, with a bit more certainty? Doesn't that also introduce the risk that companies then are actually returning to investment, returning to hiring? And I think that's where consensus is completely oblivious right now. Everyone is steadfast on no, H2 is going to slump like crazy and there's no way around it. I think there has to be a few nuances. There will be some reversal of this front loading, but on the other hand, isn't there also, from this decline of uncertainty, a bit more clarity? Shouldn't there also be a bit of a tailwind from that? And I think people are pretty much totally ignoring that at the moment.
Hey, Max, thank you, sir. We're not now. Max Kettner of HSBC on upside risk. There's an additional way of summarizing what Max just said, and that's you can go on vacation right now, apparently, and skip payrolls at 8:30 Eastern Time.
Sometimes the data just seems so messy and all of the uncertainties are just so overwhelming that you can ignore them all and stick with your thesis based on a whole host of different inputs. It really raises this question: how do you strip out the signal from the noise at a time that is incredibly noisy?
The estimate in our survey, 106,000. The jobs number drops a little bit later this morning. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Morning, Danny.
Good morning, John. President Trump's one big, beautiful bill is onto its way to a final vote in the House. Republicans cleared a procedural hurdle to advance the tax and spending bill early this morning. Debate now underway. You can see Hakeem Jeffries there setting up a vote later this morning ahead of Trump's self-imposed July 4th deadline. We're going to bring you the latest developments throughout the morning. Elsewhere, President Trump says that Federal Reserve Chair Jay Powell should resign immediately. This after the head of the Federal Housing Finance Agency called on Congress to investigate Powell, alleging that his recent testimony to the Senate about the central bank's planned renovations to its headquarters was, quote, deceptive. And in the UK, Prime Minister Keir Starmer backed Rachel Reeves to remain Chancellor into the next election and for many years after. Yesterday, he had refused to say whether she would remain in the job until the next election. Starmer later told the BBC that he works in lockstep with Reeves and she is doing an excellent job as Chancellor. And that's your brief, John.
Danny, thank you. Appreciate it. He butchered that yesterday, didn't he?
The tear heard around the world. I mean, honestly, and it seems like unless people understand exactly why she was crying and whether she actually is going to stay, there still is some skepticism being baked.
When it was the Truss government, they blamed Truss. They didn't blame Kwarteng. For some reason, when it's the Starmer government, they blame Reeves and not Starmer.
To an extent, it also shows how much Starmer's fate politically is tied to Rachel Reeves, because he cannot just separate himself from her by saying, I don't fully back her.
We're going to have that conversation later on this hour and talk about the implications for foreign exchange. Up next on the program, the mega bill advances.
We feel very good about where we are and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people.
Up next on the program, Andy LaPerriere of Piper Sandler, live from New York City this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars.
Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We are heading into the long weekend at all-time highs on the S&P 500 futures this morning, totally unchanged. The next stop for this market, 8:30 Eastern Time. The jobs report just around the corner. Under surveillance this morning, the mega bill advances.
It's been a good day. We're in a good place right now. This is the legislative process. This is exactly how I think the framers intended for it to work. We feel very good about where we are, and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people. This is going to be a great thing for the country. Look forward to moving it forward.
Here's the latest this morning. House Republicans heading towards a final vote on the president's one big, beautiful bill after working overnight to flip the holdouts. Joining us now is Andy LaPerriere of Piper Sandler. Andy, welcome to the program, sir. It feels like we're getting closer. Any reason to believe this doesn't get done before the holiday?
Well, I think with the vote on the rule last night, the odds that you're going to have people vote against final passage are really low. So I think you should take Speaker Johnson at his word that he's got the votes.
Andy, what is in this that has become the most controversial point for Washington, D.C.? What is within the bill that seems to be the biggest issue right now in the nation's capital?
Well, I mean, you had the holdouts, I think, were really focused on 2 things. So on the moderate side, you had the Medicaid cuts, and on the conservative side, it was kind of a combination of the degree to which the bill increases the deficit, and then you had people like Chip Roy focused on provisions of the IRA when certain equipment has to be placed in service in order to qualify for tax credits. And I just think that when you get deeper and deeper into the process, the leverage of individual members just declines, right? I mean, you're going to I think the leadership and the president are going to ask, well, you're really going to take this bill down because you don't like the placed in service date? I mean, this is the president's entire economic agenda here, and you're going to vote no over that. So I think, that's what we're seeing, that it is tough to vote no at this point in the process. And we'll find out a little later if they got anything overnight in terms of concessions on future things, but the bill doesn't change. And so as soon as Mr. Jeffries is done, they'll have the vote and it'll pass.
Just to be clear, Andy, that means that anyone who's professing to be a fiscal hawk right now has just been playing kabuki theater, correct?
Well, I wouldn't exactly say that. I mean, I think that they might have gone into this hoping to get some concessions, and it's possible that there is some concession, that's in the future. Some kind of promise that was made. It's hard to know, exactly what was promised overnight. Well, I think we'll find out that in the coming days. But look, I think at the bottom line is if you're a Republican, do you support extending the 2017 tax cuts? Do you support more border money? Do you support more money for defense? All the things that are in this bill, you're going to vote no because of one of your concerns. Now, obviously, the size of the deficit is a pretty cosmic concern, but you're not going to materially change that at this point in the process, or as really one individual member of Congress. I mean, I think the pieces that are in this bill are the pieces that needed to be in there for you to get a majority in the House and a majority in the Senate.
Given how significantly it does increase the deficit, how much does that really put the onus on these tariff negotiations, the trade negotiations, to raise revenue from some key trading partners? We got the Vietnamese agreement overnight. We have a host of others that might be in the pipeline. Do you expect there to be a lot of a firmer line because of the revenue needed?
I honestly think that these things are completely unlinked. I think the president wants higher tariffs because he believes in higher tariffs, and I don't think that the tariff revenue it had played any meaningful role for hardly any members in terms of looking at this bill. The president is not focused on the deficit. Just thinking about this bill, which does add to the deficit. The president proposed trillions in additional tax cuts and took off the table the biggest programs. He's not focused on the deficit. That's not why he's doing these tariffs. He wants higher tariffs because he believes he's a protectionist. That's why he wants higher tariffs. So I really don't think there's a link here. Also, I mean, some of these tariffs, if it works the way the president wants it to work, like the product tariffs result in bringing manufacturing back home, well, then they shouldn't raise any revenue down the road, right? I mean, the steel and aluminum tariffs, if it succeeds the way the president wants it to, it shouldn't raise hardly any money. So I really don't think this is about money. I think this is about the president trying to completely reorder U.S. trade.
Andy, appreciate the views. As always, thank you, sir. Andy LaPerriere there of Piper Sandler. The next stop, of course, after we get through the tax bill, we get through payrolls. Next week, July 9th, the deadline, the self-imposed deadline to negotiate trade agreements with the United States of America. Happening right now in the United Kingdom, it's been a volatile 24 hours for British assets. Sir Keir Starmer, the British Prime Minister, speaking at the moment, saying, I have every faith in the Chancellor. We work in lockstep.
Yeah, and Rachel Reeves, the Chancellor, declined to answer any questions about why she was observed having a tear running down her cheek in the Commons. And this really raises the question, what will it take for Keir Starmer and Rachel Reeves to reduce or reverse some of the sell-off that we saw yesterday in response to this feeling that maybe Keir Starmer was trying to distance himself from Reeves' policies after he did an about-face with respect to certain welfare reforms, and then it raised some real questions about the fiscal sustainability of the UK government.
And then the market got him back in line.
Exactly.
We've seen that a few times so far in 2025. That's a conversation we'll have in just a moment with George Saravelos of Deutsche Bank, plus Danny Berger with your morning movers and a new member of the S&P 500 from New York City this morning. Good morning. You're watching Bloomberg TV.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Two hours away from the jobs report, just around the corner. Record highs coming into Thursday. Payrolls Thursday. It's hard to get used to. Don't get used to it. It's not going to happen again anytime soon. Futures on the S&P unchanged, on the Nasdaq also. With a few hours until the opening bell, let's get you some morning movers with Danny Berger. Morning, Danny.
Hey, John. Well, we learned that the U.S. would be lifting license requirements for chip design companies to be selling into China. It's part of the trade deal, and in exchange, as we've been learning the contours of U.S. and China's deal, they would be getting more rare earth minerals for the U.S. But in some, that means for companies like Synopsys and Cadence Design Systems that sell the software that are necessary to design chips, that they can now sell into China. For these companies, it's at least a tenth of their sales. So you can see the big reaction, 6.5%, 5.8% respectively for the companies. Also, some sell-side moves this morning. A double upgrade by BNP Exane to FedEx, saying that this company is way oversold and that it's outperforming its peer UPS. That yes, it has competition from Amazon, but it is still outperforming in that context. So shares up 1 1/3%. The last one, more sort of a technical thing, probably the best name of any publicly traded company, Datadog at Design Software. They are now joining the S&P 500. Dow and S&P announced this yesterday. It's replacing Juniper, which is getting taken out because it's being bought by HPE. Because a lot of passive money flows into the S&P, that's automatically a boon for the shares. So those are up more than 9%, John.
Danny, thank you. Appreciate the update. Big rally there in the pre-market. On our radar this morning, one of our top stories, the House moving towards a final vote on President Trump's tax and spending bill after clearing a procedural hurdle. Speaker Johnson saying Republicans have the votes needed to pass the bill, despite a handful of holdouts remaining.
So a real question here is, what did those holdouts get in order to get on board? Because there were a couple of no's that turned into yes. What I find interesting is only 12% of participants in a Deutsche Bank survey thought that the U.S. fiscal deficit will significantly influence the market in the next year. And right now, it seems as though there is a level of impunity, at least in the United States, about the deficit increasing. Over time, a majority of those surveyed thinks that it will make a difference. So this sort of speaks to the different iteration and the way that people are responding to what's getting passed in D.C.
One number, 425. 10-year bond yields at 425. Just pretty low considering where people thought we might be a few months ago.
Totally contained, and a lot of people think that as much as people cry about bond vigilantes, they don't tend to wake up until there's really a key question that arises about fiscal sustainability, and that's nowhere near for the United States. That said, longer term, you see it in the 30-year, getting a little itchy, and you can kind of expect that to continue.
Bond yields down this morning by 2 basis points on 10s. Call it 426 now, down at the front end by 2 to 3 basis points. A 2-year yield at 376. Elsewhere, the US and Vietnam reaching a trade deal after weeks of negotiations. Vietnam agreeing to a 20% tariff on exports to the US, doubling to 40% on goods transshipped through the country. In return, Vietnam dropping all levies on US imports.
Yeah, although that's a little bit, I don't know, a little gratuitous given the fact that it's not as though Vietnam is importing tons of goods from the United States. So it's probably an easy ask considering all the panoply of potential options by the United States. The bigger issue here is certainty, and you pointed this out earlier, and I think it's really important. The likes of Nike, Lululemon, the likes of On Holding, all rallying because at least they understood that it was a level that allowed them to keep producing in Vietnam, where they have shifted a lot of the supply chains from China while passing on some of it to the consumer, absorbing some of it, and not being overly punitive. Certainty seems to be triumphant, even amid a higher tariff environment.
Is that how low the bar is now?
Yes.
Into July 9th?
Absolutely. It seems like people are shrugging it off, and what they've seen is it's not overly inflationary. Consumers are strong enough to absorb it on the margins, and overall, companies adapt and adjust.
The transshipping tariff, if we can call it that, you've got to do something then about Indonesia, got to do something about Thailand as well. You've got to secure all the other countries, or all that traffic, all that trade is just going to find itself going elsewhere.
Yeah, and this really raises the question, the specter between China and the U.S. as they continue to negotiate, given the fact that ultimately China's waking up to the idea that this is a key part of the negotiations for the United States with other regional players that do a lot of business with them.
Let's talk about China. The U.S. lifting curbs on exports of designed software for semiconductors to China in a sign that the trade deal between the two countries is in effect. In exchange, Beijing pledging to speed up approvals for critical mineral exports. Is this the so-called Geneva Accords from a number of months ago?
This is so deeply confusing. This was supposed to be done weeks ago in terms of getting the rare earth minerals back into the United States. Then there was the renegotiation of the Geneva Agreement where, okay, now those rare earths are going to come through. And the likes of Ford have been halting some of their production of cars because of the lack of magnets from China. Those can all restart. But even then, the rare earth imports to the United States had been falling. So now maybe another bone will be thrown to them in the form of software tied to AI production. And maybe this time it will work. It just raises the question, who has the leverage and how far have we actually negotiated a deal between the U.S. and China?
They're going to keep fighting for that leverage, that's for sure. That's the story with trade. We need to sum up the last 24 hours in markets, specifically in the UK. Markets rebounding from a sharp sell-off in the last 24 hours. Prime Minister Keir Starmer giving his full backing to Chancellor Rachel Reeves after stoking concerns about her future in the role. Joining us now from the City of London is Bloomberg's Adam Blenford. Adam, welcome to the programme, sir. For the people who are on vacation and might have come back this morning, how would you describe what's happened in the last 24 hours?
It's been one of those intensely personal moments in politics where we sometimes have to look, a little more deeply about where the links between the pressures of the political job, the importance of international financial markets, and then the human cost of some of this also comes into focus. We saw a tearful UK Chancellor of the Exchequer in the House of Commons yesterday, as unrelated to, but at the same time as Prime Minister Keir Starmer didn't overtly give her his backing. They've had a really tumultuous week or so with the failure of a bill where they were trying to push through £5 billion of spending cuts from welfare payments. It's really pushed the pressure on her, focused the pressure on her fiscal plans and her economic plans, and the speculation was that whether that had kind of weighed on her yesterday and what was going on. Starmer then really backed her vociferously in an overnight interview with the BBC and has come out all guns blazing this morning in terms of backing his Chancellor, saying that they're working in lockstep, they're thinking in the same way, and that she's going to be in position for a very long time. And then even in the last half an hour, the two of them have appeared together. Starmer was there on a prearranged speech, and Reeves made a slightly surprise appearance in which she came and she mentioned and reinforced the idea that she's committed to the fiscal rules, which are part of obviously of her economic plan. Starmer denied that this was all an opportunity to try and calm the markets, but as you showed just before the segment, those international bond markets are slightly calmed this morning by what has been really a full court press to try and convince them that the economic and financial and government leadership in the UK is in place and things are stable.
Adam Blenford, over in the UK. Adam, thank you, sir. Summarising the last 24 hours, incredibly volatile in the United Kingdom. Begs the question, who's in charge right now, the Prime Minister or the 10-year gilt yield?
Right now, it's the 10-year gilt yield. If you look at the reversal, though, he'll deny that. You know, British politics, love a good drama in British politics. It seems like U.S. politics are very dramatic, but lack that same kind of level of personal drama and poignancy that we're experiencing with either a head of lettuce or the tier in the Commons.
Haven't seen tears this morning in the House, have we?
No, we haven't.
Might see them later.
Maybe from exhaustion.
From Hakeem Jeffries speaking. I think he's wrapped up, by the way.
All right, so we can expect
I saw
a vote
them on
at
their
any time.
feet and applauding moments ago. We'll see. Joining us now to extend some of this conversation, not the last bit, but the bit about foreign exchange and politics. George joins us now. George Saravelos of Deutsche Bank. George, welcome to the programme, sir. This EM-type dynamic, which keeps gripping developed markets over the past, I'd say 12 months, maybe even longer, George. How are you explaining that to clients at the moment?
Well, our view is it has more to go. It's here to stay. And I think the critical driver of all of this is that fiscal deficits everywhere are going up. And of course, this was the case for the US over the last 2-3 years. But the really big shift since the start of the year is if you look at all the countries outside of the US, with the UK being one exception, but everyone's increasing fiscal spending again. Canada, Germany, China's front-loading. We're seeing discussions in Japan. And I think it's this global increase in deficits combined with sticky inflation that is creating these tensions as far as this discussion goes.
Well, George, let's talk about the tension specifically in the United Kingdom. Just yesterday, the pound and British assets get an absolutely whipsawed, presumably over the future of Chancellor Reeves, but I wonder if it's something bigger than that. Is it about her future or the inability of this government to consolidate spending?
I think there's two problems on the UK. There's the communication problem and the macro problem. The communication one is that effectively these fiscal rules, they're extremely clumsy. You see they're dependent on projections, which the OBR has 5 years out, productivity, which no one believes. And every time you see some shift in gilt yields, the market starts talking about gaps. And I think that just creates a broader problem of instability, and we see that. And then there's the broader macro problem, which I would argue applies just as much to the UK as it does to the US, which is both of these countries are running big twin deficits. And that is why you're seeing increased vulnerability to negative news. We experienced it in April in the US with the whole Liberation Day back and forth. And now we're seeing a small micro version of that in the UK. But I would say both the UK and the US have those two common denominators: external deficit and internal deficit, and that's going to be causing problems.
There's a big difference, though, between the two, and we're watching it in real time as the United Kingdom tries to figure out how to message their deficit spending and how they plan to cut or not from some of those expenditures. In the United States, Congress just keeps on spending, and they're about to pass a bill that increases the deficit over the next 10 years by some $3.5–4 trillion. Why is the U.S. such a different market when it comes to dynamics and how much the bond market is waking up to this?
So you're absolutely right. The US has had a greater degree of resilience, so to speak. But I would argue since the start of the year, you're actually seeing convergence, whereby the US is becoming more sensitive to these things. Now, of course, over the last few months, the market has calmed down, but let's not forget what happened in April. And I would say a key driver of why the market has calmed down is because we've had some downside surprises to inflation. And of course, the bond market is most sensitive to those inflation surprises. So let's see what happens over the next 6 months. But between the UK and the US, I'm a lot more concerned about the US, because if I look at the shocks hitting the system at the moment, in the US, not only do you have the tariff discussion, which everyone is so focused on, but the bigger underlying shock, in my view, is the labor market, where you're seeing a very sharp reduction in immigration, which is equivalent to a sharp slowdown in growth and potentially upside surprises to inflation. And that is the worst mix if you're thinking about debt sustainability and the funding of those twin deficits. So the immigration story to me is much bigger than the tariff story as far as the US goes.
So, George, if we could just sort of solidify this parallel, if you see the United States as being a more significant story and, frankly, a worse story than the United Kingdom, which is experiencing a lot more real-time volatility in their markets, what do you think will be, A, the breaking point, and B, the consequence for both the dollar and long-term yields that have been relatively calm amid this process?
So there's two ways this can get resolved. As you say, it can either be a calm way or it can be a disorderly way. The calm way is what we've seen over the last few weeks, where the dollar weakens. As the dollar weakens, effectively assets cheapen up. You can draw in those marginal buyers. We also authored a piece talking about a Pennsylvania plan, which effectively, I think, is being realized. The US Treasury shortens the issuance of duration. The domestic banks, the pension funds absorb the debt, so foreigners can disengage from the bond market. I think that's the orderly plan. The disorderly one is if the negative supply shock I was discussing becomes more acute, you get much bigger inflation surprises. And at the same time, Fed independence gets challenged. And we're seeing that in the background, well, arguably not in the background, in the foreground with some of the statements. The reason the market's calm is because inflation is calm. But if that growth inflation mix worsens, that fiscal dominance question, I think, will come back to the fore very, very quickly. And that's where you get the tipping point to disorderly dynamics.
Yeah, George, I'm pleased you corrected yourself because it's certainly not happening in the background. The president's not being subtle about it at all. George, thank you, sir. George Saravelos there of Deutsche Bank on a jobs data, on a payrolls report a little bit later, and on this Federal Reserve.
You know, Deutsche Bank put out a report just talking about George, saying that only 16% of respondents believe that the Fed is completely independent. That, to me, was shocking.
That's a problem.
That is a big problem. 25% think that political pressure will lead to lower rates, and you have seen rate expectations come in the more that President Trump jawbones Fed Chair Jay Powell.
The immigration story is huge.
It is.
Massive for the number. Later on this morning. That's the big debate happening stateside. If you're just tuning into this and maybe you're sitting outside the United States looking in, it's a big conversation about just how much immigration has been reduced, what that means for the so-called break-even rate in the labor market. Maybe we only need 100K in jobs growth and unemployment can still hold pretty steady.
Yeah, and to build on that, this idea that George was talking about, and we saw this in the JOLTS data on the margins, the idea that job openings were growing because potentially people were losing services jobs from immigrants going home. And wages may be going up just a touch because people had to offer more to bring domestic labor on board, raises the question of that kind of stagflationary mix that George was talking about that becomes very hard to counteract.
106 sounds low. It might not be called weak later on this morning. 106,000 is the estimate in our survey for payrolls at 8:30 Eastern Time. The previous number, 139. With an update on stories elsewhere this morning, with your Bloomberg Brief, is Danny Berger. Hey, Danny.
Hey, John. President Trump's one big, beautiful bill is on its way to a final vote in the House. Republicans cleared a procedural hurdle to advance the tax and spending bill earlier this morning. As you can see, debate is still underway, but once that finishes, it sets up a vote later this morning ahead of Trump's self-imposed July 4th deadline, and we will bring you those developments as they happen throughout the morning. Elsewhere, Microsoft is cutting about 9,000 workers, or less than 4% of its workforce. It's the second major wave of layoffs this year as Microsoft looks to rein in costs while ramping up AI spend. The most recent cuts are meant to streamline process and management layers. Microsoft also cut 6,000 workers in May. And some tragic news in the world of sports this morning. Liverpool football star Diogo Jota has been killed in a car accident in Spain. The 28-year-old father of three married his childhood sweetheart less than 2 weeks ago. Jota's 26-year-old brother, Andre, also a professional footballer, was killed in the crash. Really tragic news this morning, and that's your brief. John.
Hey, Danny, thank you. Absolutely tragic. Up next on the program, watching the hard data.
Data has been so resilient. So I think that the cuts really can't happen unless you get actual hard data that begins to fall in line with the soft data that we've seen, where there's been quite a bit of weakness.
Up next on the program, we'll catch up with Sarah House of Wells Fargo.
to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we? We don't want to lose you, Emily, in all of this.
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Unfortunately, this might be a long morning. Tracking events down in Washington, D.C., I can confirm that the House Minority Leader, Hakeem Jeffries, is still speaking. He's still going. And he might still be going in a few hours' time.
Yeah, our understanding is he's currently going through some Medicaid stories as he prepares for the final vote of this bill.
What is the objective here? What is the purpose of just talking for this long? Who's it for? The American public, or for his peers, his colleagues in the House? What's this about?
I mean, yes, this is sort of the evergreen question, right? A lot of the grandstanding, the little clips, a lot of the testimony that we see with Jay Powell that we wonder, why did that person ask that random esoteric question and then not let the person finish because they want to clip it and put it on social media? And so, yes, that seems to be where we are today.
The House is slowly getting closer to a full final vote on the one big, beautiful bill, making some progress overnight. I have some more thoughts for you on this throughout this morning. Elsewhere, waiting for the jobs report. That should drop on time at 8:30 Eastern time. Equity futures at the moment on the S&P just about positive on the S&P 500, higher by 0.02%. Under surveillance this morning, we're watching the hard data.
The data has been so resilient. So I think that the cuts really can't happen unless you get actual hard data that begins to fall in line with the soft data that we've seen, where there's been quite a bit of weakness. If we see a sub 100,000 job and certainly a negative jobs number, that would start to create the narrative of weak, hard data that would allow the Fed to cut rates.
Here's the latest this morning. Investors counting down to the payrolls report out in less than 2 hours' time. Wells Fargo cut its outlook to 100K from 115 after the ADP report showed a surprising decline. Sarah House of Wells Fargo joins us now for more. Sarah, welcome. A lot of people have come on the program in the last few days and said, ignore the headline number. How misleading might the headline number be later this morning?
Yeah, so I think you really need to dig into the details of this report. So, you know, we saw a decent headline number last month, but as under the surface, you saw really narrow breadth. I think so that's another important facet we'll be looking at, as even as the break-even rate of non-farm payrolls may be slowing, you still need to see a widespread growth across industries for it to be durable, and that's just something we haven't seen. I think the other thing you'll need to be watching is what actually happens with the unemployment rate as the Fed officials, we've already seen that move towards the top end of where they think full employment is. And so I think seeing that drift up further, I think could progress these discussions of, okay, maybe we do need to begin cutting rates over the next couple months.
Sarah, you mentioned that process, the so-called break-even rate may be coming in, maybe lower than it was 12, 18 months ago. How much lower? What kind of number are you and the team thinking about?
Yeah, so when we look at the immigration effects and just the fact that you're likely to see an outright decline in the immigrant population this year, so you were thinking probably somewhere around 90,000. So, we had a report out yesterday from the AEI suggesting that it could be significantly lower, even somewhere down 40,000. But I think right now, probably sub 100,000 is where we're looking at, just given some of those immigration dynamics, as well as just the slower growth in the native population that we've seen.
Sarah, just to build on what George Saravelos was talking about, he thinks that the market is not counting enough the sort of stagflationary ramifications from the drop-off in immigration, the idea that it could reduce productivity, in effect, and increase costs, the inflationary boost that people don't want to see. Do you think that the numbers back that up in any way?
Well, I think if you look at the distribution of foreign-born workers in the economy, so a lot of them in ag, a lot of them in construction, so in some cases areas that are harder to actually see some significant productivity gains. And so I think, especially when you look at construction, that's already a fairly tight labor market as well. So certainly the potential to see upward pressure on there. Other areas like leisure and hospitality, again, where it's maybe not quite as easy to see some additional productivity gains. And so I do see that as a potential offset to the broader headwinds that we're seeing in the labor market right now, coming from still tight monetary policy and, of course, still a lot of economic policy uncertainty.
We started this hour with Max Kettner of HSBC saying that he didn't care what happened and that he didn't actually think that it mattered what the numbers show because they've been so messy and he'd already drawn his conclusion from other numbers. Can you give us a defense of why this number matters?
It's a piece of the puzzle, and it's a very important piece, but I agree that the NFP numbers, you have to take them in some ways with a grain of salt, especially that first print. So we saw that pattern of downward revisions reemerge. We're seeing still a pretty significant gap with the QCW data that inform those benchmark revisions. So all of that point to the payroll gains recently still being overstated, and so I think it's reasonable to, okay, you still want to pay attention to this headline number. It's still generally considered the gold standard. The Fed puts a lot of weight on it, but understanding that this is, again, just one piece of the overall labor market puzzle.
Sarah, thanks for your view on things. Sarah House there of Wells Fargo, looking ahead to the payrolls report later on this morning. How many people have told us to ignore the headline number and just focus on unemployment? Focus on that one data point, and that'll tell you a whole lot more.
Yeah, and a number of people will argue that even don't focus on that. Maybe we should have gone to the beach, John. What were we thinking? Because essentially one person after another says that things have gotten so noisy. What's the point anymore?
Max is just ignoring it all, right, over at HSBC. Apparently the labour market doesn't matter to him.
Well, it's sort of this question of which data matters, especially if you have downward revisions down the line or potentially upward revisions. Key point that I think is you have a lot of very smart people who have been coming out saying opposite things, looking at the same data. And that, I think, points to the confusion of the moment that we're in.
Torsten Slock of Apollo will join us on the programme a little bit later this morning after we get the payrolls report. After Mike McKee has broken those numbers, Torsten will respond to them. He just put this out. Unemployment rate is expected to move higher. That's his call for this morning and maybe beyond in the next several months.
Yeah, so how much higher for the market to wake up to it rather than just say, okay, time for the beach?
Torsten is with us a little bit later this morning before, of course, we all head to the beach. Up next on the programme, Priya Misra of JP Morgan, Bloomberg's Tyler Kendall, Sarah Wolf of Morgan Stanley, and Michael Collins of PGIM. The second hour of Bloomberg Surveillance is up next.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, We are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
In general, we think that momentum is still positive. And again, we would be overweight risk assets.
If you're walking into the bond market, you have to do it with open eye.
I hope the third quarter is nothing like the second quarter. I would love that quarter over again. We're not going to get it.
The tail risks have been trimmed off, and the worst cases have been walked back.
People are underappreciating the risk to the upside.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It is Payrolls Thursday, 90 minutes away from the jobs report, heading into the long weekend at all-time highs on the S&P 500, at least so far. Equities this morning slightly positive on both the S&P and on the NASDAQ 100. Going into this at 8:30 Eastern Time, the estimate in our survey, job gains, payrolls growth of 106,000. The previous number, 139, and a lot more attention on the unemployment rate.
Because there is this mismatch of, are we just seeing an entire labor market that is shrinking, contracting, as immigrants do not come into this country and continue to migrate out? This is really the key question. Do we understand the dynamics of a labor market that is so dramatically in flux that not only do you have the immigration picture, but you've got the AI picture, and then you have the hesitation of a lack of certainty around policy that's hampering hire plans. You put this all together, and you've got Max Kettner going to the beach early because it is so confusing that some people are just discounting it altogether.
The chairman of the Federal Reserve can't go to the beach early. He's been called out already on social media going into this number. Too late, his nickname from the president, should resign immediately, apparently. If you look at the dual mandate at the moment, inflation around 2%, full employment, we have got to have the debate, which side of the dual mandate right now is most at risk?
Yeah, and that ultimately is a debate that they don't have the answer to. They do, though, lean into the idea that the labor market and the U.S. economy is strong enough to give them the luxury of waiting it out and getting more data, potentially those 3 CPI prints before the September meeting, as a number of different Fed members have indicated. This is a point of disagreement. There are a lot of people in the market who agree with the moniker too late, even though, by the way, Too Late Powell has just turned into Too Late. That's actually a name. Is that really where we are right now?
Apparently, yeah. Chairman Powell himself acknowledged that he was a little bit late last year. when he started reducing interest rates. So maybe he's going with that.
Okay, and pretty much no one in markets agreed with him that it was too late because the market saw inflation.
Some people thought it was too early.
Some people thought it was too early. Some people thought it was too much. It just points to the fact that we're in a deeply uncertain moment. And really, people are questioning the fundamental argument that this is a strong U.S. economy that can withstand interest rates at these levels. That is a crucial debate, and it is being muddied by the political overlay of, oh yeah, you reduce it to 1%, that benchmark rate, we can borrow then, and then we can lower the overall costs of the U.S. government debt market, which no one really is thinking is going to happen.
You've mentioned Max Kenner of HSBC a few times. He joined us about an hour ago, basically ignoring the jobs number at 8:30 Eastern Time. And I think that speaks to a lot of investors at the moment, ready to move on. Ready to move on from the tax bill, which a lot of people assume will pass later on this morning in the House. Ready to move on from the trade story on July 9th. We've brought up Vietnam a few times now. The fact of the matter is, this market has been so anchored to the extreme that they're willing to accept a 20% tariff on Vietnam just because it wasn't 46, the 46 we heard on April 2nd.
Sorry, I'm so glad you said this, and I apologize in advance because I want to take out my little soapbox, get on top of it, and start, but I'm not going
Grandma.
to.
We've got all morning.
I mean, we don't have all morning, and everybody will turn off the TV if they haven't already, but there is this question of what does all priced in mean? Right? Is it just being pegged to an extreme? Is it that people have gotten so burned by trying to short anything or to sell anything that they don't want to do it again? And so they say everything is priced in and they are just benumbed to the different realities. Is it because people are sick of being bearish? What does priced in mean at a time when we don't even understand where we are economically to the degree where people are ignoring a labor market report that typically was the linchpin of so many economic projections? I'm done. Thank you.
So the slow clap. No, I'd give you a fast clap. I'd give you a fast clap.
Okay.
Conditioned by the experience of the past few months.
Yes.
Sick of missing out on gains.
Yes.
To see the market hit the lows of April 8th, then rally 20% plus on the S&P, more than 30% on the NASDAQ. That will reinforce behavior. That will condition you. You know what changes it? Data.
Yes.
When you start getting hit around the face with data that moves in the other direction, that's when you start to wake up.
And to build on that, how much has this market become more vulnerable to a downside shock because of that conditioning? And this sounds really gloomy, so I'm going to stop because it's not necessarily gloomy.
Nobody wants you to stop this morning.
Well, but there is this feeling that I don't know how prepared a market is for a downside surprise of the economy at a time where people feel pretty good about everything.
Equities on the S&P, just about positive. The jobs report, about 86 minutes away. Coming up this hour, Priya Misra of JP Morgan, with stocks hitting fresh all-time highs. Sarah Wolf of Morgan Stanley counting down to payrolls, and Mike Collins of PGIM, with President Trump continuing his attacks on Chairman Powell. We begin this hour with stocks higher. Investors counting down to the payrolls report, due a little bit later this morning. Priya Misra of JP Morgan writing, it's a low hire, low fire labour market. Economists expect the slowing in hiring to continue, but if the monthly pace is lower for the break-even rate and the unemployment rate is around 4.3%, there is no urgency for the Fed to cut. Priya joins us now for more. Priya, good morning.
Good morning.
The Fed chair says the economy is solid. Will we see that at 8:30 Eastern Time?
You know, I think we'll see a slowing. All the soft data has been suggesting slowing. The labor differential is sort of worsening. I think while it's clear it's slowing, what's the level? If it's 100,000, even I would say 90,000, that's in line with consensus. That's in line with potentially a new break-even rate that's much lower. So we're going to look at average hourly earnings. We're going to look at that distribution of those payroll gains. We're going to look at the unemployment rate. If it's 4.3, what Chair Powell's been saying is this is a resilient labor market. There is, there's no inflation pressure. That I'm going to be watching because, I think inflation is the reason why the Fed is not reducing the level of restrictiveness. But if it's an okay economy, they're going to wait because they know the tariff impact takes a while. It's only been 3 months since Liberation Day. The Fed knows that goods inflation is likely to pick up. So they'll want to see how persistent is that, what happens to service inflation. So if the labor market's okay, their urgency to cut goes down. I think the front end is a little vulnerable in that scenario, but I still think it's asymmetric, meaning if you get a 50,000 payroll, we'll look at the unemployment rate, but that 50,000, I don't think anyone's saying that,
it's going to spook people.
It is going to spook the market. It's going to spook not just the rate market, it's also going to spook the equity market. That's in this soft landing la-la land. I think there's some complacency there.
Which is what Lisa's going nuts about already this morning.
Okay, the soft landing la-la land. It's not totally fair. There's real AI, but yeah, it seems like people are very rosy.
Before we get into the market, can I just pick up on that word slow? We've had this debate all week. Slow is not necessarily weak. There are structural factors, cyclical factors. If we get a slowdown in payrolls growth, is that the consequence of immigration or the slowdown in the economy? Which one is it?
I think it's both. And, that's not a cop-out answer. The reason for that is the structural weakness you could see even before the immigration drop. If you look at last year or the year before, it was a highly concentrated labor market, meaning it was education and health, it was leisure, hospitality. That's the structural aspect you're talking about. The new graduate hiring, why is that so weak? That's maybe the AI story. So I think, those are the structural aspects. Now, where is immigration kicking in? We haven't really seen it in construction, but that would be one area, leisure, hospitality. We're seeing it a little bit in jolts. So I think it's a confluence. I mean, that's what we've been dealing with all year, is a lot of these structural factors and the cyclical, and the market has to sort of price both in. But I think on the labor market front, the slowing is both. We're going to see, I think the immigration one, the Fed might not worry that much about, because if they're leaving the labor force, is there actually some wage pressure that's picking up? The structural story is one where they have to be concerned, because that means that wage pressures in the rest of the economy are not high. That can allow them to maybe look through this, tariff-related increase in inflation that we're likely to get.
Here's one reason why I actually believe what Max is saying, and as much as I've been gloomy, I understand the view that the U.S. economy can adapt and adjust and roll through this without some sort of significant downturn. We've seen these economic cycles that are different from one another depending on the industry, and we've seen them operating at different times with the cyclical versus some of the structural issues. And that's been a help, because it's actually kept a floor under how low and how weak the economy could get. Do you see that going away, or is that going to be a feature that continues to support this market from some of the worst case scenarios?
So you bring a great point. I think businesses, if they have a little bit of certainty, they can plan, which is why I think the market cheered the Vietnam deal, which I saw and said, oh, it's 20%. That's higher than what we thought. We thought it was going to be 10% on the rest of the world, maybe 25, 30 on China. This is 20 plus 40% on transshipment. And then I thought maybe the market just wants certainty. I think businesses know that's what they're paid to do, to manage around the new rules of the game. So if they know what the new rules of the game are, I think that they can plan around it. The problem is uncertainty is it a feature or a bug? I would say it's a feature of this administration. Secretary Besson has called it strategic uncertainty. Are we going to have all the certainty around trade? Unlikely. Are we going to have certainty around deregulation? Maybe taxes, we'll get some certainty that taxes are not going up. Everyone expected that. So, but to your earlier point, I think private sector balance sheets are healthy. So which is why I think the economy's been able to withstand high, interest rates for the last few years. There was a lot of fiscal support as well. Fortunately, fiscal support's not going away. So, I don't want to sound too negative. I just think that growth is likely to be below potential. Recession is not our base case, as long as the tail risks that have receded and the markets price that in. As long as those tail risks don't come back, we get some certainty. I think we're looking at a 1% GDP, that soft landing below potential growth. I think that's our base case. But I do worry, the more uncertainty we live with, the more companies remain frozen, and consumers, look at consumer spending in the first half of this year. It's not been strong. It's the weakest since 2009 if you exclude COVID. Consumers step back and companies step back, and then not doing anything is saying something.
Right. We are getting some certainty, though. And right now, as soon as we finish with the magic minute in Congress with Hakeem Jeffries, we might get a vote, and then we'll get a bill that actually does get passed. And we will bring forward some of that stimulative effect, as you were talking about, the fiscal impulse not going away completely from Washington, D.C. At what point do you worry about what George Saravelos is worrying about, the sort of twin deficit experience that we're seeing over in the United Kingdom coming to the United States? Because we're not really seeing that dynamic right now.
We're not. Now, a couple of points on that. On the twin deficit issue, that is a long-term structural issue. It's the reason why we need foreign capital. We've got a current account deficit, we've got a fiscal deficit. So we need foreigners to buy U.S. assets. Our view is that is still happening. All of the data since April suggests that where auctions are fine, take data, custody holding, we are seeing investors hedge FX, and that's why the dollar continues to weaken. Now, the question is, markets are forward-looking. Will that continue? I would say if the U.S. economy remains solid, if some of the uncertainty goes away, we're still the deepest, most, liquid capital markets in the world. So I think foreign capital coming into the U.S. remains. So I'm less concerned around that de-dollarization around U.S. assets. But the other issue with the twin deficit is we are earning a lot in tariff revenues. I mean, I'm not talking about whether tariffs are a good thing. The economist in me doesn't love the idea of tariffs, but it's going to raise, according to the CBO, $2.8 trillion over the next 10 years. The bill, the fiscal bill, is worth about $3 trillion, like fairly close. Though the math works out. If you think that the end game, you look at the signal from the noise, is we're going to have some tariff on the rest of the world, 10, 20%, a higher number on China. That's going to raise revenues, and that twin deficit problem becomes a little less concerning than it was 6 months ago, because yes, the deficit's an issue we've got, and that's why I think tariffs are not going away. It's very appealing to Congress and to the administration if they're able to raise money through that tariff channel. So I'm a little less concerned. The UK needs to take hard decisions.
We'll talk about the UK another time. Your point on the US and tariffs, nailed it. The biggest test of the Democrats the next several years. What do they campaign on? When the money starts to trickle in, are they going to campaign on removing these tariffs? We saw what happened last time around with China, didn't touch them. This time around, they're going to be a whole lot higher, but when you start to get that income, are they actually going to campaign on removing those tariffs?
This is the reason why people say it's so hard to remove tariffs, because you are structurally changing the way that the United States earns money. And after Smoot-Hawley in the 1930s, it took a very long time to get those tariffs off, precisely because of this. It is politically unpopular to raise taxes in order to offset any kind of income that you're getting from tariffs. And that's essentially what the Democrats might have to do.
A few months ago, Priya Misra of JP Morgan was on this program and called the 30-year bond a risk asset. What do you think the next question is going to be? In the next segment, Priya Misra of JP Morgan is going to stick with us. That risk asset this morning, yields are lower on it, down by a basis point, a 30-year at the moment, 4.79. With an update on stories elsewhere, with your Bloomberg Brief, is Danny Berger. Hey, Danny.
Hey, John. The House of Representatives is on track to pass President Trump's One Big Beautiful Bill this morning, ahead of Trump's self-imposed deadline of July 4th. Minority Leader Hakeem Jeffries, you can see there, has been speaking on the floor and has been going at it for more than 2 hours. Once he's finished, voting will begin, and we'll bring you all those developments as they occur throughout the morning. President Trump also says Federal Reserve Chair Jay Powell should resign immediately. This after the head of the Federal Housing Finance Agency called on Congress to investigate Powell, alleging his recent testimony to the Senate about the central bank's planned renovations to its headquarters was deceptive. The Trump administration has lifted chip design software curbs on China. The move comes as Washington and Beijing implement a trade deal. The U.S. Commerce Department informed the world's 3 leading chip design software providers that they no longer need government licenses to do business in China. And that's your brief, John.
Danny, thank you. This is why a lot of politicians become news network anchors. You know why? The most fearful word in your ear when you have to anchor a TV show is when they say the guest is not there.
Yeah.
And there's 10 minutes on the clock and you hear this word and it says stretch.
Right.
And you just have to make things up for about 8 to 10 minutes. King Jeffries would nail it, wouldn't he?
Yeah, although I don't know
just
if anyone will still be listening. Stories? It's true. I mean, honestly, I was actually thinking they'd be very good at, bloviating for long periods of time, although people behind them might be sleeping.
What's the channel the Democrats go on? Where they sort of get a job there afterwards? What's it called?
You're not putting this in.
No? All right.
No.
Up next. We're nearing the finish line.
We feel very good about where we are, and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people.
Up next on the program, Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Equities just about positive so far this morning by close to 0.1%. No drama here whatsoever. The drama down in Washington, D.C. at the moment, working overnight in the House under surveillance this morning. We're getting closer to the finish line.
It's been a good day. We're in a good place right now. This is the legislative process. This is exactly how I think the framers intended for it to work. We feel very good about where we are, and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people. This is going to be a great thing for the country. Look forward to moving it forward.
Here's the latest this morning. House Republicans moving towards a final vote on the big, beautiful bill ahead of President Trump's self-imposed July 4 deadline. Bloomberg's Tyler Kendall joins us now for more. Tyler, can you confirm that the minority leader is still speaking?
Yeah, hey, John, he is still speaking. He's afforded something known as the magic minute, which means he could go as long as he wants. He started at 4:54 a.m. Eastern, so we are well beyond the 2-hour mark. Now, I'll let somebody else weigh in on how effective this is as the House really approaches nearly the 24-hour mark of being in session. But he's not talking to his tired colleagues. He's trying to talk to the voters because Democrats are going to use the one big beautiful bill as their campaign messaging during the 2026 midterms, because the package at the moment does appear poised to pass, because once Leader Jeffries is done speaking, House Speaker Mike Johnson is afforded the opportunity to start. It's unclear if he would take it because Republicans want to get this done as soon as possible. So our assumption is they're going to start voting on finalized passage once Jeffries is done. And the magic number here, as you well know, is going to be 217 votes. House Speaker Mike Johnson can only afford to lose 3, and it looks like he does have the votes. If we take the vote on the rule earlier today as any indication, he had 219 Republicans on board. But John, that meant that one Republican was a holdout and didn't vote for it. And it wasn't a House Freedom Caucus member. It wasn't a fiscal hawk. In fact, it was Congressman Brian Fitzpatrick. He represents the 1st Congressional District in Pennsylvania, and he raised concerns about how this package makes changes to Medicaid. I will point out that he represents a district that President Trump actually lost in 2024, which brings us right back to this conversation about how this will play heavily in the midterms.
Tyler Kendall, stay close. We'll come back to you when this starts to progress and move forward a little bit more. Priya Misra of JP Morgan is still with us around the table. Priya, I promise you that question. The 30-year bond in America, you called it a risk asset. Is it still a risk asset?
It is a risk asset. It's got much more duration than the 5-year or the 2-year. But you have to, are you getting paid enough for that risk? That's what markets do. We look at risk and we see return and we say, are you being compensated enough? That compensation has gone up significantly. How we look at compensation, I mean, I don't want to bond geek out here. Term premium has gone up. But let's look at the curve. The curve, the Fed funds to the 30-year curve, over 100 basis points, or 2-year, 30-year. It rarely, the curve is higher than this when Fed funds is high. Has the curve been 200 basis points? Absolutely. If Fed funds is at 0, then the 10-year could be, 2%, 2.5%. The long end can be higher. The curve has steepened. The market has understood that the long end is not, should price in more fiscal risk premium, more inflation risk premium. 2 months ago, when I was much more negative on the front end, on the long end, I was worried about, can the president fire Chair Powell? Is there the Sell America trade? Is that going to take off? Are we going to alienate all investors who want to buy U.S. assets? I think some of those tail risks have been taken away, along with other tail risks. So now I think the long end on a rate basis actually doesn't look that bad. Can that curve keep steepening? Absolutely. If you get weakness in the data, I think the front end is going to be more sensitive to that. The curve likely, continues to steepen. We like the belly of the curve, but on a rate basis, 480 on the 30-year is not that bad.
How much is this a global story? And it has to do with the United States, but also has to do with Rachel Reeves, and also has to do with what's going on in terms of Friedrich Merz.
Yeah, I'm glad you brought that up. I meant to say term premium also tends to be globally correlated. You see this in Germany, you see this now in the UK. Yesterday was a reminder of 2022. Fortunately, the market seems a little more stable today, but there is increasing fiscal stimulus globally. There's also this question of demand for duration. And I think what we're seeing, DMOs or treasury departments globally will have to decide how much do they want to issue in the long end versus the front end. The US is going to have to make that, US Treasury has to make that decision as well. I think as that term premium, as the curve keeps steepening, you're going to see, yes, there's fiscal premium, but you're going to see, not just in the US, globally, and we've seen some signs of that in Japan, where these treasury departments are going to say, let's just issue a little bit further in the curve. That'll bring that supply-demand, better in balance. But absolutely, I think yesterday was a perfect example. We had a weak ADP number. Now, ADP, I don't know about its predictability for non-farm payroll, but as its own series, it is weakening. And what did the bond market do in the US? It looked at the UK, it looked at Germany, and it said, okay, rates have to be higher. So we have to keep an eye on everything happening domestically, but also internationally. And this higher term premium, steeper curve, that's a global phenomenon. It's absolutely going to feed through into the US.
This is a conversation for the long end of the curve. Let's come all the way in to the front end of the curve. The Treasury Secretary, Scott Bessent, speaking just moments ago to the American press and saying the following. 2-year Treasuries are telling you that the overnight rate is too high. So Fed funds right now is a range of 425 to 450. If you can bring up the 2-year on the screen, that is sub 4% at the moment. And I wonder from your perspective whether you would put some weight on the argument coming from the Treasury Secretary this morning, that because the 2-year yield is so much lower than the Fed funds, that ultimately 376 is screaming that the overnight rate is too high.
I think that's the market telling you what the Fed is also telling you. So yes, I would agree with Secretary Bessent, but that's in line with Chair Powell, with the dots. I think we talked about the urgency to cut is not there with the labor market where it is with all this inflation risk. You fast forward 3-4 months, and we do think the inflation rise due to tariffs is going to be one time. We're seeing service inflation. I think this was the good news of the last 3 months. Apart from the tail risk being taken away, that's service inflation, housing inflation, ex-shelter service inflation is declining. And so if that continues, the Fed can start to normalize policy. That's soft landing cuts, though. That's not what the president wants. The 200, 300 basis points, that's not the amount of cuts that the market's pricing in or the Fed's telling you. But getting down to neutral, whether it's 3 or 3.5%, that's essentially what the 2 years pricing in. And I think it's fair. I think the market will be very much on board. I don't think that's a politicization of the Fed. That's the Fed doing their job, looking at the dual mandate and saying, let's slowly get down to what we think is neutral.
The Fed committee seems to be a little off on judgment. The words of the Treasury Secretary earlier on this morning.
Yeah, when he was asked whether he wants Jay Powell to resign, he said that there are a lot of strong candidates for Fed chair, and he expects to name 2 of them later this year. It raises this issue. This is an economic debate that is very real about whether or not the Fed is behind the curve or whether it can afford and should be waiting for a lot longer. To overlay politics into this just adds another layer of complication, and I think a lot of people in markets are trying to grapple with both. Does this question the independence, or does this go to the economic debate that a lot of really strong economists are debating right now?
Priya, this was great. It's good to see you. Priya Misra there of JP Morgan. Coming up on this program, Sarah Wolf of Morgan Stanley as we count down to the payrolls report. Plus, Danny Berger with your morning movers. Software technology companies jumping as the US lifts export curbs on China.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Bersachi in Doha, Qatar, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Equities on the S&P positive by 0.1%. We're 60 minutes away from the jobs report in America, 2 hours away from the opening bell. Looking at your morning movers this morning, here's Danny Berger. Morning, Danny.
Good morning, John. Well, we learned that companies received from the Trump administration news that they would be able to sell design for chip makers into China without needing a license. Now, that is a change, and it is part of the trade deal between the U.S. and China. In return, the U.S. gets some of those critical minerals, but those companies that sell into China from the U.S. are rallying in the pre-market. You can see Synopsys up more than 5%, as is Cadence Design Systems. We also got an upgrade from Morgan Stanley to a regional bank this morning, that regional bank being Valley National. Morgan Stanley saying that it is trading at a steep discount, that things have improved, like its balance sheet, like its reduction in exposure to real estate, but the market hasn't fully realized that, so goes to an overweight, and shares are rallying 1.8%. Now, I mentioned in the last hour that Datadog is rallying because it's been added to the S&P 500. Well, there were expectations. Some banks flagged Robinhood as maybe one of the stocks that also could have been a candidate to be added to the S&P 500 as Juniper gets taken out. But because Robinhood wasn't added, we are seeing shares fall 1.6%. This just usually happens because passive money goes into the index. And so Robinhood had been rallying on the expectation that it might go in. John.
Danny Berger, thank you. Appreciate the update. More from Danny later on in the program. On our radar this morning, one of our top stories, House Republicans nearing the finish line, moving towards a final vote on President Trump's big, beautiful bill. Debate continuing this morning with a potential vote on deck later, ahead of Trump's self-imposed July 4th deadline.
Yeah, and the debate being Hakeem Jeffries with himself in the book that he has in front of him during the Magic Minute that's gone on for a couple of hours now, and it looks like he's got about half the binder left to go through. This raises a question about, A, what people were offered to get on board who were potentially no's before this was going through the House, and then B, the market's reaction to this, seemingly pretty sanguine about the deficit and how much this might increase it. Priyam Misra actually being constructive, saying that, honestly, this is looking like you're going to get a lot of revenue from tariffs that's not being counted in this. It might not be as deficit driving as people are expecting.
Still called the 30-year a risk asset, but likes that risk of 480, the yield right now on a 30-year bond.
Yeah, seeing maybe yield steepening, but a Fed that might be more poised to cut. A lot of questions around the level versus the relative value and versus the relative level tied to the short end. Very complicated. Nobody wants to really get into this on a Thursday morning when they're looking to get to the beach.
We are looking to get to the beach at 8:31 Eastern Time, 1 minute after the jobs report, a little bit later. The pressure already building on the chairman of the Federal Reserve, the president going into this jobs report, saying that too late, should resign immediately. I said this in the last hour. You know, the president typically gets to see the numbers the night before. And when this came out, a lot of people did ask, has he already seen the jobs number ahead of time?
Which, you know, goes to a question that you asked earlier this week, where you said, how are they going to message a negative number? Are they going to talk about the immigration story, or are they going to talk about how the Fed needs to be cutting rates? I'm not going to speculate as to whether the president is responding to premature numbers that are potentially market moving, but there is this larger question of how much is the pressure building politically and how much is the pressure building economically for Fed Chair Jay Powell to potentially move sooner at a time when there are a lot of question marks about the trajectory of this economy.
None of us know what the job number is going to be. Right. Be very clear about that. I have been surprised that we haven't seen much outreach from the likes of Kevin Hassett, the NEC director this week, who could have come out and said, look, this is a different economy to the economy in years gone by. Immigration is a whole lot lower. And then just describe the concepts. Explain to people that you could see a run rate of 100K in jobs growth, maybe even lower, but you won't see unemployment go up. And it might not weigh on wages either. And explain why. Walk people through that dynamic. Otherwise, you're chasing your tail. If we come out with a number in 60 minutes' time and it's 50K, everyone will just say that's a really, really weak number. This economy is doing absolutely awful. But I think there's another argument to make there. And a lot of economists on Wall Street are already making that argument.
But it's nuanced. It's a difficult one to message. If you say the reason why we're not growing faster and seeing more job creation is because of Fed Chair Jay Powell, it's his fault, he needs to do something, is a much easier, simpler message than it's actually a complicated rearrangement of the immigration backdrop. As immigrants leave, you have this number that actually is going down, and that leads to potentially a low headline number, but it still means that it's a solid labor market. Doesn't really fly in headlines.
I know it doesn't work for Truth Social posts, but that is the job of the NEC director, just to communicate some of these issues. Anyway, hopefully we can catch up with Kevin Hassett sometime soon. Let's talk about the UK. The UK Prime Minister, Keir Starmer, saying Chancellor Rachel Reeves will stay in her role for years to come, giving her his full support, hours after failing to guarantee her position when asked in Parliament just yesterday. The gilt market all over the place in the last day.
Yeah, the fear that Rachel Reeves was getting pushed out for having too much fiscal discipline that she was trying to foist on the UK market. Rachel Reeves currently speaking to broadcasters in Parliament. She said that she's not going to comment on the personal issue, but she said she's just cracking on with the job. And she denied that the emotional display was tied to the Prime Minister. I just wonder whether the genie's out of the bag. You have a prime minister that's trying to cater to a labor department, a labor party that wants to see ongoing welfare payments, and a whole host of people who would like to see the same at the same time that you have a deficit that is potentially constrictive and growth cooling. It is a very difficult, toxic recipe for the British government.
It's hard not to draw the conclusion that the Prime Minister looks weak this morning. Given the opportunity to back his Chancellor yesterday, didn't take it. Bond market had its say, he backed away. Yeah. So to say this is not about the bond market, come on.
It's all about the bond market in the United Kingdom. We saw this in 2022, and we just retested that. It is notable that even with the pushback that we have seen from Keir Starmer, you haven't seen a full retracement in the bond market, in the gilt market, back to levels before yesterday.
Let's bring it back to the States and turn to the labor market. Microsoft cutting 9,000 jobs in an effort to limit costs while ramping up AI spending. It's the company's second major wave of layoffs just this year. Sarah Wolf of Morgan Stanley weighing in ahead of the jobs report later on this morning, writing this: we think labour demand is slowing, but so far the slowdown is modest. We forecast headline payrolls adding 140,000. Sarah joins us now for more. Sarah, good morning.
Good morning.
So big question, and you've got a little bit of time, so walk us through it. What on earth is happening in this labour market?
Well, we're seeing that there's a mix of indicators. The openings data from JOLTS, hiring, layoffs, that's more or less stabilized and doesn't look that concerning. But there's a broad base of indicators that are showing a more significant deterioration, and I think that's why the Fed is so split on where the economy is going. Are we headed towards a gradual slowdown, or should we be more worried? So if we look at the Challenger data on layoffs, that's more concerning than the JOLTS data. How consumers feel about the labor market is more concerning. Jobless claims data has been rising. I think overall, what we could take from this is that the labor market's cooling off. Part of it is the immigration story that you were talking about. But I don't think we're quite at that point where we're going to see an inflection higher in the unemployment rate. What will drive that into the point with the Microsoft layoffs, once we start getting more of that economic slowdown from tariffs hitting the labor market, pushing companies to do layoffs, we don't have enough hiring happening to reabsorb those workers. And that's where we're going to start to see the inflection higher in the unemployment rate. And we could see another 40 basis points higher to 4.6, 4.7 by the end of the year pretty easily.
Wait, hold on a second. 4.6, 4.7, that would trigger potentially the SOM rule back to where we were last year. Are you saying that you kind of are sympathetic with the idea that maybe the Fed is on the back foot and might be too late?
The Fed's definitely on the back foot. It makes every labor report more and more important as we get into the end of the year. because they're going to have to be patient. They're likely not going to cut in July because this one print, unless we're somewhere between 0 and negative, is not going to be enough for the Fed to deliver cuts. But if we get something in August ahead of the September meeting that shows a consistent deterioration around the 0 range, the Fed's going to start cutting, and they might actually feel like they need to come with bigger cuts than 25 basis points. One of the things Chair Powell said is that we would have been cutting if it wasn't for tariffs, which basically means they're ready to cut interest rates. And so if they're coming later, they might be coming larger.
How much of this story is AI? We've been flirting with that for quite a while, and the idea of Microsoft continuing to do their layoffs. They had an 18,000 person layoff, now a 9,000 person layoff. We saw this with Meta, the year of efficiency, which has led to the year of big gains and $100 million bonuses. But I'm just curious, is this sort of the path forward?
I think a lot of actually what we're seeing broadly for hiring right now is AI might actually be supporting some of the hiring because you need all these data scientists and resources to build out the AI infrastructure. Once we really start to reap broad AI productivity gains, that's where I think we're going to see more of that ripple down effect into layoffs or weaker hiring. So we're seeing it a bit in small pockets in the tech sector, but I don't think AI is the story right now. I think the fact is the economy is growing in the first half of the year by 1%. Immigration has slowed down, so break-even payrolls have gone from 200,000 last year to about 100,000 now. And so all of that, I think, is what's going to be showing up in the data right now.
Have you seen any differences between goods sector hiring and service sector hiring over the past few months?
Well, we're seeing the services sector start to cool off. Most of job gains were coming from education, healthcare, government-related jobs. That was actually driving 2/3 of job growth over the last few years. And now that has started to deteriorate, which means we need other sectors to step up if we don't want to get negative prints. So we need the CapEx side of the economy to start to accelerate, so investment-related jobs to pick up. We need manufacturing and construction to start to come back. We're seeing cracks in the housing market that's weighing on construction hiring. We're getting early signs that onshoring is happening, but it's not providing a meaningful boost to manufacturing employment quite yet.
Nothing you've said in the last 5 minutes could be summarized as solid. Why is the chairman calling this solid?
I think he's trying to keep optionality and have a calm head, right? He's trying to guide the economy through very turbulent, volatile times when you have very different communication coming out of the White House versus the Federal Reserve. And then if you also think about the views among the FOMC, their views are so dispersed that the best thing to be is calm and remain optionality. If you look at rates pricing right now, it's about 25% for July, 90% for September, then you're between 60 to 70% for October and December. It's a good place for the Fed to be. It allows them to cut at basically any meeting through the end of the year without disrupting markets. And so his communication has clearly been effective at setting them up that way.
So just to present a counterfactual, and just to let's go into the realm of hypotheticals, if this Fed were to cut by 100 basis points, hey, how about 300 basis points? What would happen to inflation? Would that really cause inflation expectations to materially rise given the backdrop that you just portrayed?
I think if you look at the services side of the economy, which is actually offsetting, which is pushing down inflation right now and will likely offset some of the tariff effect, that's going to continue to moderate, I think, even as the Fed is cutting interest rates. Because if you look at all the forward-looking indicators, in particular for the housing market, so shelters, the biggest chunk of services inflation, that's trending lower and coming sustainably lower. And I don't think interest rate cuts are really going to change that. So I do think that we're in a good place for the Fed to cut in a couple of months from now, because as long as tariffs are transitory, the underlying trend should come down, and growth is so weak that the Fed needs to deliver a little bit of stimulus.
Sarah Wolf of Morgan Stanley. Sarah, good to see you.
Good to see
for
you.
dropping by. Looking ahead to payrolls, not too far away, 8:30 Eastern Time, the estimate 106K in our survey. With an update on stories elsewhere with your Bloomberg brief, let's cross back over to Danny Berger. Hey, Danny.
Hey, John. We are still monitoring the House of Representatives, which is on track to pass President Trump's one big, beautiful bill this morning. Voting is expected to start after Minority Leader Hakeem Jeffries, who you can see there, speaking live on the floor. We don't know when that will happen, as he is permitted to speak as long as he wants, and he's already been going on for 2.5 hours. We'll bring you any developments as they happen throughout the morning. Elsewhere, President Trump announced a trade deal with Vietnam. It includes a 20% tariff on Vietnamese exports to the U.S. and a 40% levy on goods deemed to be transshipped through the country. In return, Trump said Vietnam agreed to drop all levies on U.S. imports following weeks of intense diplomacy. And in sports, the second round of Wimbledon is underway after an upset-filled first round. American Frances Tiafoe lost to Cameron Norrie, while Taylor Fritz won in a 5-set thriller. Jannik Sinner and Novak Djokovic both take the center court later today. And in the women's tournament, number 1 Aryna Sabalenka survived a close first set to move on to the next round. And that's your brief, John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes. Up next on the program, the pressure building for a rate cut.
The consensus view among almost everybody was that tariffs would start to impact the data in March. It didn't happen in March, it didn't happen in April, it didn't happen in May. There's no question the inflation news has been much better than anybody thought. So the income trends are great. The unemployment rate's going to stay low.
We'll see about that at 8:30 Eastern Time. We'll get a view from Mike Collins at PGIM up next.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equities a little bit firmer here by not even 0.1% on the S&P and the Nasdaq 100, a similar move. On Russell doing better, small caps up by 0.8%. In the bond market, 10-year bond yields grinding lower for a fourth consecutive week. If we close out at that level, a fourth consecutive week, the longest such streak going back to February of this year. We've had a real pullback at the long end. The focus on the front end at the moment, the 2-year 376.21, yielded down 2 basis points on the session, and once again, the Treasury Secretary Scott Bessent making an argument I've heard him make before, comparing that 2-year to where Fed funds is, Fed funds, by the way, 425 to 450, and making the argument that that 2-year is telling you the overnight rate is too high.
Yeah, by something of the tune of 75 basis points, that the Fed could cut rates by 3 times without necessarily causing a disruption to markets. That's an argument he's made before. Whether Jay Powell adheres to that, he has not. He doesn't adhere to this at all. And he says that the market is looking at one thing and they're looking at something else, and that's the reason why they're data dependent.
Pretty Mishra put it well. Really, the 2-year is reflecting a Fed dot, which shows you rate cuts anyway over the next 18 months.
I mean, this is the big issue that I have. Are we talking about the same thing with different political overtones? Are we talking about a Fed that is poised to cut 2 times, regardless, later this year? And then, you know, this argument in both the economic sphere as well as the political sphere, you need to cut by 2 or 3 times later this year, which is essentially exactly what they are planning to do.
We'll see if it starts in September. Under surveillance this morning, pressure building for a rate cut.
The consensus view among almost everybody was that tariffs would start to impact the data in March. It didn't happen in March, it didn't happen in April, it didn't happen in May. There's no question the inflation news has been much better than anybody thought, and tariffs are not inflationary. So the income trends are great. The unemployment rate's going to stay low. You're going to see the labor markets tighten and growth accelerate in the second half of the year.
Here's the latest this morning. President Donald Trump amplifying his pressure campaign against Fed Chair Jay Powell, writing on Truth Social, too late, should resign immediately. Michael Collins of PG and Fixed Income writing the Fed's hands are tied for now, but we still think a Fed funds rate cut or 2 are likely by year end. Michael joins us now for more. Mike, welcome to the program, sir. Let's talk about these rate cuts. Are they cutting interest rates at the Federal Reserve later this year, in your mind, because inflation is coming down or because this labor market is going to start cracking?
Both, actually. You know, I mean, we've been in the camp, Jonathan, as you know, that the Fed is really stuck, right? They're going to keep the rate where it is until things change, either in terms of a labor market weakening or this tariff-induced inflation not being as bad as feared, and maybe being just a one-off and seeing inflation really stay kind of in the low 2s here. And I think in both cases, the data are moving in the right direction, right? They are really supporting the case for a rate cut or 2 by the end of this year, which, as you've been talking about, is fully priced in.
Mike, do you care about this report that we get in 40 minutes' time?
You know, I really think that people are talking about what is the run rate, what is the steady state level of job gains each month. And, you know, maybe it was, you know, we were running at 400, then 200, then 100. It feels like because of just the natural slowing in the job market cyclically, but also the immigration, net immigration effect, it feels like that natural steady state of job growth, Lisa, is below 100 now. Who knows? Maybe it's 0, maybe it's 50,000. So I think you're naturally going to see lower prints on these monthly job gains. And I don't know if it should spook the market. The linchpin is that unemployment rate, right? You could still have a fully employed labor market with slowing job gains. And I think that's really the conundrum the Fed is going to face. They're going to see these slowing jobs numbers and see the labor market still look fairly tight. The big number today we're looking at really is the wage gains. And obviously the wage gains have been slowing steadily for a couple of years now. And I think we'll continue to see that as companies, you know, they're not necessarily firing people. They're just pulling back on hiring right now. But wage gains are definitely slowing.
If you don't see inflation as being a persistent feature of this U.S. economy, and if you do see tariffs as not as inflationary as people previously believed, why isn't the 30-year, why isn't the 10-year yield a lot lower in the United States?
Yeah, I think they're just pricing in, you know, 5 rate cuts, right, for the next year or year and a half is what's priced in. That seems very reasonable to us, right? If that happens, then you have a kind of a normal upward sloping term structure, right? So that's what's fully priced in, and that seems natural. What is not priced in, Lisa, is the downside tail risk, right? What is not priced in the credit markets, in the equity markets, in the vol markets, and arguably, to your point, in long-term rates is a nastier downside surprise where, you know, Trump does get his way and the funds rate doesn't go down 100 basis points. It goes down 200 or 300, right? And that is a very different world. That is not what we're expecting. But again, the markets are assigning a really low probability to that, and probably too low.
Mike, just to pick up on that, let's just focus on risk assets. Let's talk about equities and say high-yield bonds. High-yield credit, of course, you're very familiar with. You know it well. Credit spreads right now, 280 on high-yield spreads and grinding even tighter. And what's interesting about that, if you take the Economic Surprise Index, something else you know well, but for our audience who might not be familiar, just where is the data coming in relative to expectations? That's been rolling over since November. It's had a smallest bounce, but ultimately the trend over the last 6 months, not great. So the surprise index has been rolling over, the equity market's been going higher, and credit spreads have been grinding tighter. How do you explain that? Either we're whistling past the graveyard or the data is just becoming less and less relevant. Which one is it?
Yeah, I think it's the whistling past the graveyard for sure. I know, Lisa, it's good to see her fired up this morning about this. And, you know, the financial conditions is something that, you know, not a lot of people are talking about, right? Yeah, could the Fed cut 100 basis points now? Possibly. Maybe that's the right level to be at, frankly. But, you know, what would happen to financial conditions, right? Would the stock market go up another 10 or 20%? Would credit spreads continue to grind in? And that brings in a whole host of other risks to the upside of the economy and the upside of inflation, right? This economy has been driven by the upper end of the wealth and income spectrum, which has been driven by this paper wealth effect, right? And I don't think you want to add fuel to that fire. And I really believe that's one of the reasons the Fed is really hesitant to cut here, because they don't want to add fuel to that fire.
If you think people are whistling past the graveyard, Mike, what's your highest conviction call right now?
The conviction is that, you know, growth is going to moderate a little bit, and recession risk really does look low, right? I mean, the big theme we've been focused on, Lisa, throughout this whole cycle is, you know, where are the tipping points in the private sector? You know, yeah, the public sector is a mess. The fiscal situation globally is a mess. But, you know, typically these recessions happen, these downside risks happen when you have an over-levered housing sector or financial sector or corporate sector or consumer sector or mortgage sector, and you are not there this cycle. We have not had a re-leveraging of the private sector. Yeah, there are some pockets in lower-end consumers where you're seeing bigger increases in debt and leverage, and you're seeing a big increase in personal bankruptcies and small business bankruptcies, which is certainly worrisome, but it's not systemic enough to take the whole economy down with it, right? So we have a pretty strong conviction that yeah, it's going to be a slowdown in the economy, but this kind of cataclysmic, you know, credit risk off, you know, credit crisis is a really low probability, and that's frankly what the markets are running with and pricing in.
Mike Collins, appreciate your time, sir. Mike Collins there of PGIM, fixed income. Just different ways to think about this market at the moment. Some people just think the data is becoming less relevant for a bunch of reasons, including the fact that we will get clarity on some big policy issues, and maybe the data starts to improve as the year goes on.
Yeah, well, how many times can you get a head fake before you start to feel like, well, what does anything matter anymore?
Go to the beach, apparently, for the 5th time already this morning. Not yet. Payrolls 34 minutes away. Nadia Lovell of UBS, Becky Frankowitz of Manpower Group, Jeff Rosenberg of BlackRock, Torsten Slock of Apollo, and a whole lot more still to come.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Forum in Central Portugal, and this is Bloomberg.
Most likely, we see a slowdown in payroll growth. Over the next couple months, we see this gradual slowdown.
The data is going to weaken. The growth rate is going to fall. The unemployment rate is going to rise.
If you get a 0.2 rise in the unemployment rate, the market is going to respond quite negatively to that.
Labor demand has cooled significantly, but we're not seeing mass firing.
If we see a sub 100,000 job and certainly a negative jobs number, that would start to create the narrative of weak, hard data that would allow the Fed to cut rates.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. The third hour of Bloomberg Surveillance starts right now, tracking live pictures down to the nation's capital in Washington, D.C. The House Minority Leader, Hakeem Jeffries, speaking for 3 hours. 3 hours as the House gets closer and closer towards a final vote on the one big, beautiful bill. Once we've done that, we can move on from taxes to trade. July 9th, the next stop for this market. Before we get there, it's about 29 minutes away. It's payrolls Thursday, and the SMNR survey, 106K. The previous number, 139. Your equity market this morning, positive by 0.1%.
Yeah, and not to make this existential Thursday, but the big question is, what do these numbers mean, and how bad could the number be before it is bad, and how good could the number be before it is good? Citigroup's Andrew Hollenhorst just put out a note, and this to me is really the ultimate question. How bad does the number have to be, or what does it look like in order to get the Fed to put July as a live meeting where potentially they could cut rates? They said that what that could do would be a 4.5% unemployment or negative payrolls. That could potentially push them to cut rates as soon as July. A 4.4% unemployment rate wouldn't quite be enough, but would set up the rest of the year.
You're right to define what's bad, and I'm totally with you. You can't just do it with a headline number. If we get, say, 80, might get 150, I don't know what the number's going to be, but let's say we get 80 at 8:30 Eastern time. There'll be economists sitting around this table saying 80's not bad, immigration's come down, this is probably the run rate of the labour market right now. Check unemployment. you can't define this jobs report this morning without checking unemployment. If unemployment is going up and jobs growth is slowing, the pressure on this Fed to cut is going to build big time.
Yeah, if you start to end up with both a low jobs number and a sense that it's not just because the labor supply is contracting to such a degree, that will present more of a problem. Ultimately, people are wondering, what do we do with these numbers that are getting skewed by both secular and cyclical trends? And that is a very difficult moment to really encapsulate, and that's the reason why we're talking about AI, we're talking about immigration, we're talking about a whole host of other metrics, in addition to how is the economy doing?
The AI question, I think, is still the most important question for a lot of people. Are service sector companies reluctant to make full-time hires because they're investing a lot in AI? Are we going to see much more of that? And you've been on top of this story now for weeks. If you're a graduate coming into this economy, it's getting harder and harder to get a job. Why? Is it about the economy or is it about AI?
The spread between the unemployment rate for recent college graduates and the overall population is about as wide as it's ever been. It's almost a record differential. That is how difficult it is for people to get jobs. It raises a question, is this AI? Or is this because this is a stagnant labor market that doesn't have the give, the forgiveness that allows people to move on and have other options? And that has been the hallmark of American capitalism. There are a lot of big questions here, which is the reason why some people are checking out and some people are checking in and say, look at the details, and then you'll get maybe some of the answers.
The jobs report is just around the corner, 8:30 Eastern time. Coming up this hour, we'll catch up with Nadia Lovell of UBS, following another record high for the S&P 500. Becky Frankowitz of the Manpower Group on the so-called rebalancing in the labor market, and Torsten Slock of Apollo reacting to this morning's payrolls report. He's looking for higher unemployment in the months to come. We begin this hour with stock steady, ahead of jobs data out in just under 30 minutes' time. Nadia Lovell of UBS writing, we believe the bull market remains intact. We would use pullbacks as opportunities to phase in to equities. Nadia joins us now for more. Nadia, good morning.
Good morning.
It's good to see you. Last time we spoke, you went neutral equities. Is that still the position, and why?
That is still the position. I mean, when you look at where the market is today and how much it has rallied back, it feels like a lot of optimism has been priced in the market. Like, of course, the economy has remained resilient. And some of that you can argue maybe it's some front running ahead of tariffs, but we do expect a soft patch later this year, and the market will have to reconcile that. Now, John, that does not to say that we think, again, that the bull market is over. We think that this market can continue to see some gains, modest gains from here, however. And we think that there's still some uncertainty around tariffs that has to be reconciled. And so we are doing stuff. We're just doing things from a relative standpoint. We've been advising our clients to stay fully invested in our mandate portfolios. We're doing more relative value trades, so really, preferring U.S. and EM over like Europe.
We often say you can learn something from the data and you can learn something from how the market responds to the data. So yesterday's data was a tariff on Vietnam. It was 20%. Yeah. This market rallied. Nike and other stocks, Lisa and I have been talking about it all morning, we're up and to the right. 20%, not 46%. The bar seems to be really low going into July 9th. Is that how you look at things?
I don't think that the bar is that low going into July 9th. Is Vietnam a template, right? I think most of the market is sort of pricing in tariffs to stay around, effective tariff rate to stay around 15%. And so if you start to see more of these 20% tariffs and still you have sectorial tariffs to come, that is going to challenge that narrative, right? And ultimately, we do think that by the end of the year, we're still in the same place. But in the short term, we could see some volatility. It isn't clear what we should expect on July 9th. We're hearing different things from the administration. Bassett is saying one thing, the president is saying a whole other thing. So we do expect to see some deals, at least in principle. And then after that, we do think that you could see a bit of a escalation again in some of the trade tension, particularly some of our largest trading partners. We still have EU to go.
How much is that offset by what's getting done in the House today? And I'm not just talking about Hakeem Jeffries, who has been in a 3-hour role, but just getting through a bill that is front-loaded and is going to be stimulative, in particular to businesses.
Yeah, but I think some of that is already priced into the market. Yes, it will potentially be stimulative early next year or even towards the end of the year. So we do think that some of that is additive, but again, it's not going to offset the full potential headwind and so then that you could get from tariffs re-accelerate again.
John was saying that you can learn something from the data and you can learn something from the market's reaction to it. And you could see that with respect to the tariffs, but you can also see that with respect to payrolls. Yeah. And we've been trying to understand, Mike Collins talking about whistling past the graveyard. Are people looking past weakness to their peril? What kind of number do you think the stock market would wake up to and say, wait a second, maybe this isn't quite the sort of benign backdrop that we've been looking at.
Lisa, I know you're going to like this one. It's not just about the headline. We also have to look at the revisions, right? Because gosh, haven't we seen a massive amount of downward revisions? And so while the headline numbers can cause some knee-jerk reaction, I think you have to just peel back the onion. You know,
we're peeling as quickly as we possibly can. Carry on.
You know, the equity market has weird reactions on payrolls, as we know, and that doesn't necessarily transpire for the rest of the trading session into next week. And so I think if you see something, you know, under 100K and, you know, massive downward revisions from prior months, we've been running at 40 to 50K downward revision. So is that 100K really more 60K? And so I think that that's going to give the market some pause. So if you see something like 80, that probably means that the labor market is weakening faster than people expected, and that could accelerate cuts from the Fed. But again, we'll see where it comes out.
Already pricing in those cuts in the bond market, and I think increasingly equity investors are as well. We've heard from a range of guests in the past week that they're willing to look through weakness because ultimately it will introduce rate cuts from the Federal Reserve. And I've heard less thoughts on July 4th, July 9th, taxes and trade, and more thoughts on 26. It just feels like a lot of market participants have moved beyond 25 and they're focused on earnings growth next year and beyond. Is it too early to do that?
It is a little bit too early to fully look on 2026 because the next 6 months is going to matter as well, and how sort of things progress into 2026. Reality is, if we see an acceleration in terms of unemployment rate, if the Fed doesn't come to the rescue fast enough, if tariffs reaccelerate, we could end up in not even a soft patch, but something even worse in terms of a recession. And so eventually you can get recovery in 2026, but the path to that can be a much choppier path than, say, sort of a market that goes straight up and to the right.
I'll make it really simple. At 8:30, is bad news good news or just bad news?
I think, again, it always goes back on how bad that news is, right? Yes, there will be parts of the market, if you see a weak payroll numbers, will get excited that the Fed will be looking to cut. But I think by the time you get to next week, particularly when you still have the uncertainty around tariffs and those rates, you could see the market start to take a breather again.
Nice try. That's all I could say.
It was an attempt.
I know, that was good. But, you know, this is the difficulty, you say. So is bad news good news? Is good news bad news? And other than Stuart Kaiser, who looks at me with disappointment, everyone else says, let's get back to that onion and keep peeling it back.
You can feel the bias though, can't you? The bias is sort of downside risk into this payrolls report. I think we do have to sort of introduce another question. What happens if it's good? What happens if it's actually pretty decent at 8:30?
I know. I've actually wondered this. Have we really accounted for a potential upside surprise? And then is that bad news for the Fed? I guess the bigger question is, how much and at what point can Fed cuts offset any potential weakening in the economy for risk assets, right? I mean, essentially, if people are betting that some Fed cuts, even with weakening, is a good thing for risk assets, then can we absorb bad news more easily than maybe an overheating economy into potentially tariff-driven inflation?
Nadia, thanks for indulging us or tolerating us. We appreciate it. Nadia Lovell there of UBS. Neutral on equities this morning. Equity futures positive by about 0.1% on the S&P. With the latest news elsewhere, some of our top stories in our Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. One of the top stories continues to be President Trump's one big, beautiful bill. It is on its way to the final vote in the House. Republicans cleared a procedural hurdle to advance the tax and spending bill early this morning. Debate is underway, as is the magic minute from Representative Hakeem Jeffries. But that sets up a vote for later this morning ahead of Trump's self-imposed July 4th deadline, and we'll bring you any of those developments as they occur throughout the morning. Elsewhere, President Trump says Federal Reserve Chair Jay Powell should resign immediately. This after the head of the Federal Housing Finance Agency called on Congress to investigate Powell, alleging his recent testimony to the Senate about the central bank's planned renovations to its headquarters was deceptive. Elsewhere, Lululemon is suing Costco. It accused the wholesale retailer of copying its apparel designs. The disputed products include hoodies, jackets, and pants that allegedly replicate Lululemon's designs and trademark silhouettes. Costco has not yet filed a response to the lawsuit. And that's your brief, John.
Danny, thank you. Now we know where to go. Didn't know before.
I mean, come on. Unless people really care about the little, like, hair. Is that what that is? Like a women's hair?
I've got no idea what that is.
You know, the
logo.
Sort of, the logo,
yeah.
Is
that what it's meant to be? I didn't
I'm
know
not
that.
sure, but I'm just trying to imagine what that could possibly be. But this is I'm like thinking, how much is that dance going to take?
Yeah, right?
Yeah,
like, this is a great commercial for Costco. Anyway.
Not sure that was the intention.
No. Danny, thank you. Up next on the programme, the Morning Calls, plus Becky Frankowitz of the Manpower Group as we count you down to the payrolls report. The payrolls report about 18 minutes away.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Vacation begins in 16 minutes' time, 1 minute after we get a payrolls report at 8:30 Eastern Time. Equity futures into it. Your scores look like this. Positive 0.1% on the S&P at all-time highs coming into Thursday morning. On the Nasdaq 100, up another 0.08%. Let's get you some morning calls. First up, Needham, upgrading Meta to hold, seeing upside to estimates and strong labor productivity. That stock is up by 0.75%. Your second call from Goldman, raising its price target on Tesla to 315, pointing to better than feared Q2 vehicle deliveries. That stock is up by 0.4%. And finally, BNP Paribas Exane upgrading FedEx to outperform, saying the stock is arguably oversold. The stock is up in a pre-market by 1.4%. That's some of the calls this morning. Let's turn back to the labour market. Investors counting down to payrolls. Manpower Group President and Chief Strategy Officer Becky Frankowitz seeing a rebalancing, writing after several years where job seekers held the upper hand, the balance of power is starting to tilt back towards employers. Becky joins us now for more. Becky, welcome to the programme. Off the top, I just want to talk about the service sector. I want to understand your experience at the moment. Are you seeing service sector providers reluctant to make full-time hires and moving towards temporary workers because of what's happening with technological developments?
Yeah, so I'd say two things. We're not seeing a lot of movement anywhere. So when you say, are we seeing big shifts? We're really not seeing that. We're starting to see some impact from AI. That is happening. We're seeing increase in hiring around statisticians, people who can model data, and the big hirers in that space are the Accentures of the world, Microsoft, et cetera. We are also seeing on the other end of the spectrum of the labor market, summer hiring start to pick up, really from frontline supervisors in food service preparation, and a big surge in our retail workers, both online and offline, as consumers shop in both forms. So the labor market is slowing. That power pendulum is shifting towards employers, but there are a couple of bright spots. But make no mistake, it is a slowing, very strained labor market in the United States.
Becky, you touched on another theme and why it's so difficult to read right now. It's not just technology or the broader economy, it's also immigration. Becky, are you seeing certain sectors that would typically depend on immigration looking to hire more aggressively elsewhere, domestically here in the United States of America, and finding it difficult to get the talent?
Yeah, so we are definitely in a talent shortage. There's no question around that, both in talent supply and also skilled talent. That is happening. It's ironic, though, John, as you would think we'd see a big surge in our new graduate hires, but it is a tough time to be a new college graduate in the U.S., where unemployment among new graduates is 6%, juxtaposed to 4% for the broader economy. So you would think if we were looking for new-to-world workers, we'd have lower unemployment among that group, and we're actually not. And so my hypothesis is employers just aren't hiring. They're not hiring entry-level, anticipating AI to take some of those roles. They're looking for more experienced hires when they're hiring. And for those summer jobs, those transition jobs, they're going to those high school students for summer employment.
So Becky, can we build on this? Because this is something that we've been discussing for a long time. Is this the new normal where it will be a lot harder to break into the workforce, particularly for white collar jobs in the technology, in the banking sphere, because of AI taking on a lot of the roles that entry-level workers typically did?
Yeah, Lisa, what is entry level? You know, in the future, what is entry level? I mean, I personally learned how to work by calling on retail stores. The job that I started and learned how to communicate with others, sell, that job won't be here in 3 years. And so it is still here today, though. AI is starting to impact, but it's impacting in the data structures versus in actually taking those frontline jobs. However, we can't anticipate that's going to happen. So this idea of how do you get work ready, it is going to change. You won't come in and do the tasks, the repetitive tasks. You'll have to come in and be ready to contribute at a different level. And that is why I believe that we're seeing this higher unemployment among these new college graduates.
So, and we could talk about AI and the way it's going to transform the market, and I'd love to do that at another time. If you put this through to job creation, does that mean that we are headed toward a lower job creation environment for a long period of time, that we're moving more to a more European model in a way, where there's lower firing and lower hiring, and that's just the way it is?
Yeah, I don't know if we're moving to a more European model structurally, but I think what we are seeing, and it may surprise you, that jobs that are resilient or durable are manufacturing jobs, production operators, supervisors. Again, even right now where we're seeing decreased in demand, where is the hiring happening? It's happening in medical and health, registered nurses, retail supervisors. So there are still durable jobs out there in our current economy. In terms of the future and what that looks like, you know, the belief continues to be that there'll be new jobs created, software developers, which we've seen be impacted, that job's being reshaped now. There's new titles, AI ethicist, two words I would have never put together. So there are being new jobs created, but we're in a bit of a holding pattern as people wait for the new normal to set in. They're holding.
That speaks to the low churn of the moment. Becky, appreciate your time as always. Becky Frankowitz there of the Manpower Group. Becky's great at breaking this down. Just really making us understand, helping us understand how complex this labour market is right now. There are shortages in some places, demand issues in others, and within the demand issues, there's a whole bunch of reasons for it, not just the broader economy, trade, tariffs, whatever, policy volatility, uncertainty, all of that, but also technology. We keep going back to AI.
And it goes to something you've talked about, which is where will the jobs recession be? It will be the white-collar jobs recession. You're talking about technology and the financial sector, and that's where the unemployment rate, particularly for new graduates, has gone up dramatically. Where are the jobs? Manufacturing. It's in the services sector. It's in the healthcare. It's in some of these other areas that are harder to really replace with quantitative computing in the same kind of way.
What's it going to do? Replace us or enhance the jobs we already have? First of all, it's going to slow down hiring, at least in certain places, until we have a full understanding of what this actually means. Does that speak to the difficulty that graduates are having right now? Because that's a major problem, both for the economy and politically. If you don't like what you're seeing politically in certain cities, if you don't like that, they're going to vote a certain way.
Well, yeah, if you've got an entire group of people who are being locked out of a labor market, they might be more inclined for a different type of economic structure for, say, a municipality, which could play into it. I mean, I don't want to get into this kind of political argument. There is, though, this complication of how you understand this evolution. And if you either have to be incredibly highly skilled and incredibly good at critical thinking on one side to be very wealthy, or you're manufacturing and working as a nurse. I mean, these are the bifurcations right now. that people are trying to extrapolate out.
We've got the rest of this year to talk about politics in New York City, haven't we?
Yay.
So let's move on. The jobs report's 8 minutes away. Mike McKee's dropping by to help us understand what to look for. Mike, it's a different jobs report. There's a different feel to things going into this. What are you looking for?
Well, everybody's looking for a slowdown in job creation, and I'll certainly have to check the TV anchor hiring to see if you guys have a future. But we're looking for only 106,000 jobs created during the month of June. The whisper number, 95, 96. So basically, Wall Street leaning to the idea that we're going to get a disappointing report. Now, what is disappointing to the Fed? They're going to be looking at the unemployment rate because that's their signal for whether the economy is slowing. And we're going to have to go out to 3 digits because it barely cracked 4.2 last time, rounded down. It could easily round up this time to perhaps 4.4, depending on where we come in. We also have a lot of other numbers today. Jobless claims, 241, leaves us in the same range that we have been in. Continuing claims, still kind of the same range, but expected to go higher. So we'll see what that works out to be. And then we've got 10 o'clock numbers, too. Trade balance out at 8:30, expected to be bigger, perhaps, than what we saw last month. ISM services, maybe a slight rise, but it's prices paid that'll matter there because the jobs part of ISM services will be already behind us. And capital goods orders, not expected to change at all. But a lot of data for people to trade on today. And so we're going to be watching to see if it gives us any signal for how fast the Fed is going to have to move. Not whether they will move, but how fast.
Yeah, Mike, just on that, on the Federal Reserve, how bad would this number need to be just to make that July meeting a little bit more of a live meeting?
Well, I think if you got close to 4.5 on unemployment, then it would put it on Wall Street's agenda, might put it on the Fed's agenda. But I think the Fed is going to try to avoid July at all costs because even if we get a tariff impact in June, it's just the first month of that we would be seeing. And they'd like to have 2-3 months before they actually know that a trend is in place.
Michael McKee, I'm taking you down with me. Appreciate your time. Mike's going to be back with us in about 6 minutes' time to break down the jobs report. Not just tracking that, the labour market report is, of course, just around the corner. Also tracking events down in Washington, D.C. We're told getting closer and closer to a final vote on the one big, beautiful bill. Hakeem Jeffries, the House Minority Leader, is slowing things down a bit. And Lisa, this just in, some breaking news. Jeffries, according to reports that I'm seeing, is now reading from a fresh binder. Okay? So you've been tracking the binder and how things are progressing. Apparently it's a fresh binder now.
Oh, this is a new paradigm. I need to refresh my ideas. What is he reading? Shakespeare? I mean, seriously.
Isn't it Stories of Medicare? Isn't it something like that? Isn't that what he's been doing for the previous 3 hours?
Stories of Medicaid, yeah. I mean, what kinds of stories? Once upon a time,
I've got no idea. Yeah, they needed... Yeah.
Evidently, you need to pay attention. We will watch that, or we will not be watching that, but we'll be watching the binders and how many there might be.
We'll have someone else to track that. Okay?
Thank you. I think that's good. One thing that I am watching is the market expectation for Fed cuts. Right now, we've got a 23% chance of a July rate cut, which is actually pretty significant. You've got a 96% chance baked into markets right now of a September rate cut as people really look to this Fed potentially moving. You asked the right question. How high is the bar for the Fed to move in July? That's been a moving target.
The jobs report is 5 minutes away. The estimate in our survey, 106K. The previous number, 139. A lot of focus on the unemployment rate. We'll get the numbers in just a moment. The payrolls report is just around the corner. Stephanie Roth of Wolf Research joins us in a moment alongside Jeff Rosenberg of BlackRock, Torsten Slok of Apollo. Your labor market data up next.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The jobs number just seconds away. The payrolls report about 20 seconds out. Going into it, your scores look like this. Equity futures on the S&P. Positive by 0.1% as we come into Thursday at all-time highs. On the Nasdaq 100 up by 0.1. On the Russell, the small caps up by 0.8%. In the bond market, 2-year, 10-year, 30-year. Yields down into the print. We're down by 2 basis points. The 10-year 425.73. With your jobs number this morning is Mike McKee. Good morning, Mike.
Good morning, John. A lot of numbers to go through here. 147,000 jobs created according to the Bureau of Labor Statistics, which is above the 106 estimate that we got from Bloomberg Economics and the economists we survey. Private payrolls up 74,000. Let's take a look here at the unemployment rate. It falls to 4.1%. There was some thought it was going to go maybe as high as 4.4. The forecast was for 4.3. So much better number than anticipated. We also see, and I'm going to jump here to jobless claims, a big drop in jobless claims to 233 from previously reported 237. So jobless claims and unemployment go down, and it looks at this point like it's status quo in the labor market. Labor force participation, 62.3%. Average hourly earnings, they come in low, up 0.2%, pushes the average for the year down to 3.7% from 3.9. Weekly hours, 34.2. The revisions to payrolls 147. The revision is a net of 16,000 additional jobs, so not much change there. Trade balance comes in at 71.5 billion. The forecast was for 71, so that is actually pretty close to right on. Won't make much difference in people's second quarter GDP guesses at this point. And then back to claims, 233, and the continuing claims number comes in at 1,964,000. That is the same as the revised number for the prior week. So at this point, this looks like a very status quo labor report. We got to look under the hood to see what categories moved, and I'll do that while you guys are checking out the market reaction.
Mike McKee, thank you. You can take a guess. The sound in the last couple of minutes, the door slamming shut on a July rate cut. Look at this move at the front end of the curve, up 12 basis points on a 2-year yield, 389.86. In the FX market, what happens when you start to see yields go up like that? Dollar stronger, euro dollar rolling over. So some dollar strength, some higher bond yields. The equity market, I'm not sure, doesn't know what to do with this right now. Equity futures positive by about 1/3%. But good news is good news, and this is good news, much better than expected. An upside surprise on headline payrolls, 147, the estimate 106. The unemployment rate was at 4.2. In our survey, economists were looking for that to climb up to 4.3. It comes in at 4.1. And if you want some high-frequency data, or at least some higher-frequency data, jobless claims, much lower than expected. Across the board here in the labor market, this is a pretty solid read.
You really can't find many cracks here. Even the revisions. I mean, we were talking to Nadia Lovell earlier about the potential for downsides revisions. They were revised up from 135,000 to 141,000. When you look at, okay, does this mean that it's inflationary? No, it doesn't. Hourly rate for earnings actually went lower, came in lower than people expected. So what does this mean for the Fed? What does this mean for exactly what this labor picture is doing? Right now, it seems like good news is good news, and the bond market is trying to reassess.
Shout out to Mike Apen over at Morgan Stanley. Had an estimate of 140 going into this particular print, so not bad, eh?
No, I would say that you nailed it, and right now you went against the grain. Congratulations.
Well, then Mike would acknowledge it's sort of like blindfold and dartboards and all that stuff every single month, but let's be pretty clear about this. Coming into this print, a lot of people thought there was some real downside risk going into this jobs report, and we might get a much lower number, particularly after what we saw in ADP, and there's no sign of that in NFP whatsoever.
I think that your conclusion is the absolute correct one. This absolutely slams the door shut on any kind of July rate cut, and you are certainly seeing that getting priced into the market. What this means beyond that remains to be seen, whether this can actually be something we can draw a conclusion from, or whether this is going to be a confusing jumble of numbers that Mike can try to extrapolate apart. And I'm very curious about those TV news anchors that you were talking about, Mike.
Still got a job, Mike, I hope. Looks like hiring. We'll head back to Mike in just a moment. With us around the table, Stephanie Roth of Wolfe Research. Stephanie, good morning.
Good morning.
Your first take on this one.
Yeah, I mean, this is something that we were kind of warning people about, an environment where the steady state pace of hiring comes down pretty substantially and the unemployment rate starts to fall. Because we're in an environment where there's a significant detraction from a foreign-born population, and that puts downward pressure on the unemployment rate. It reduces the unemployed people, and at the same time, it lowers the steady state pace of hiring.
So 150, around 150 now, is what 2 years ago? 250? 225?
Granted, like a lot of the job gains was driven by government, so I think we have to take that with a grain of salt. If you look at private payrolls, that was fairly sluggish, and by category, it was kind of slow as well. So the steady state pace of growth has come down. I would look at it from a private perspective in particular first. And then we're in an environment where you're seeing a tightening in parts of the labor market, which is what the signal from the unemployment rate.
What do you make of the fact that we didn't see hourly earnings significantly rise, or rise even as much as people previously expected? It kind of goes to this idea, can we get a decent jobs number without really any kind of inflationary impulse?
I think it was the timing of the survey week. So this is something that's somewhat underappreciated when you're forecasting the payroll gains. It tends to be very sensitive to the timing of the survey week, and this time it was earlier in the month, which doesn't capture the 15th, which then 15th tends to be the time where you get pay raises and that type of thing. So that tends to put downward pressure on the average hourly earnings number. So we were looking for 0.2 for particularly this reason.
Do you think that this calls into the question the need for the Fed to cut in September?
Yeah, in our base case, we have them not cutting, although it's a close call. It certainly reduces the odds. Certainly July is off the table. And now the question is, can they still cut in September? Base cases, they probably don't, but there's a lot more data, and this is just one print among many that we're going to be getting by the time we get to September.
Stephanie Roth is going to stick with us around the table. The jobs number just moments ago, 147,000, higher than expected. The estimate in our survey was 106. The unemployment rate expected to climb to 4.3%, actually dropped to 4.1% from 4.2. Got a bunch of other data as well because it is Thursday, and it is payrolls Thursday this time around because of the long weekend. So we got jobless claims as well, and claims came in much lower than expected. 233, the estimate was 241. We've got Torsten Slog with us around the table from Apollo. Torsten, I want to come to you a bit earlier than expected because I want your view on this. You were expecting unemployment to start climbing. Unemployment's falling back. What explains that?
I think the key issue here is the immigration factor, as Stephanie is mentioning, that it is very, very important. So Tara Watson and Wendy Edelberg estimates now that we are seeing significant decline in the long-run payroll growth of closer to around 50,000. And the fact that the unemployment rate is going down is something that, of course, is quite surprising. And the fact that we now have so strong payroll growth, even with a decline in the long-run steady state for non-farm payrolls, tells you that this was a fairly strong report, and this is a very strong economy, which argues to your point, which is our view, that the Fed will only cut once this year, simply because rates will stay higher for longer. There is no need, especially not with Powell at the same time saying that he expects a meaningful rise in inflation over the coming months.
Is it fair to say that this was the goal of the Trump administration, that they wanted to get immigration down so that even if you have payrolls growth of 100 to 150K, you could actually see the unemployment rate start start to fall.
Exactly, because both labor supply is declining when you deport roughly around 1 million people at an annual rate, and at the same time, labor demand may also eventually slow down, but if it doesn't slow down, then the decline in labor supply on its own will exactly create a report like this one, namely where you have a declining unemployment rate. So it is obviously better than the consensus expected, also better than what we had expected, but it tells you very clearly that the labor supply story is playing a very important role here.
At the same time, it also suggests that the economy or the business environment is much more solid than many people expected as well in terms of hiring, in terms of looking for that, and it's coming without the inflationary impulse that some people were worried about. Do you think that that's durable?
Well, and that brings us back to the discussion around what is the effect of the trade war. Tariffs not going to have an impact. So far, it's remarkable where you have inflation basically still steady, and now job growth still relatively strong. So in that sense, there literally is very little sign of the trade war having a macroeconomic impact at this point.
There are going to be people who look at this and say, this might be the last gasp before a real material weakening. We can't trust these numbers. Max Kettner's already gone. What do you say to that?
Well, that's why the next few weeks with the earnings season will become very, very important, because that's when we'll figure out, is the pig coming through the python in terms of the tariffs heading eventually earnings? Because at the end of the day, we are raising about $400 billion in tax revenue at an annual rate at the moment. Total earnings for the S&P is about $2 trillion. So that means that someone needs to pay $400 billion if tax revenue is going up $400 billion. Is it consumers through higher inflation, or is it companies through lower earnings? And we still, with this report, of course, have just not seen that yet. So exactly to your point, Lisa, over the next several weeks, we'll find out in Q2, how did companies actually respond to higher tariffs? Did they respond by passing prices through in the form of higher inflation? We'll find that out also very soon. Or did they also, in this case, turn out to actually lower their earnings and say, we're going to eat some of the tariffs? And that becomes the main question for markets now, namely, what was actually the response to tariffs in the second quarter?
Mike McKee is back with us for a little bit more. Mike, you've taken a second look at the numbers. What explains the upside surprise?
There's just some hiring in a lot of different categories. You're going to laugh at this. The biggest category for hiring was government. 73,000 additional jobs, but that is almost all in state and local government. A lot of it in state and local education. 7,000 jobs lost in the federal government. Now, maybe we get a lot more once we get to the fall and some of those people who are getting severance finally leave the labor force. To what you guys have been talking about, the interesting thing here is that the number of people who are in the labor force foreign-born went up this month. Same is true of the people who are in the labor force who are native-born, although the overall level of the labor force falls by 120,000 people, 130,000 people. So you can see why the unemployment rate went down. 93,000 people or got employed according to the household survey, and 222,000 lost jobs. But because of the drop in the labor force there, you're seeing a lower unemployment rate. But the labor force doesn't seem to be having been affected by the overall numbers of people who are being deported. Manufacturing lost 7,000 jobs during the month. Construction gained 15,000, more than anticipated. Retail trade only 2,000. Now, if we are seeing a slowing in spending, that might be showing up there. That might be one of the first ones that we see that is a problem. And Lisa, I checked on you, and arts and entertainment hiring was up by 20,000. Nice. I don't know whether you are arts or entertainment, but you would fall in that
Both,
category.
Mike, both.
Yeah.
Arts and entertainment.
Dear
so for
Lord.
right now, you're okay.
All right, thanks. I'm so glad. That was the news you need to know.
Mike McKee, thank you, sir. Looking at bond yields this morning, bond yield higher by 8 or 9 basis points at the front end of the curve off the back of this upside surprise. Once you push that through foreign exchange, you get a stronger dollar. Euro dollar right now negative by about 0.5%, 117.42. Talked about the equity response to that. Not convincing, still positive though by about 0.2%. Talk about the market. Jeff Rosenberg of BlackRock jumps on to talk to us. Jeff, welcome to the program. What on earth did you do with this one this morning?
You know, Jonathan, I haven't heard you say it yet, but, you know, this is a great example of where the first reaction is not necessarily the last reaction. I think we got to rewrite these headlines, everybody. This is about the private payrolls, and private payrolls disappointed to the downside. Mike McKee just talked about it. The upside surprise, it's government, and that may be surprising. Federal government was down. That's not surprising. That's DOGE and the cuts. It's state and local that's very high. If it's education, to me, that sort of sounds like there's a lot of education workers coming back into the job market in June. No, that's a seasonal adjustment effect. So the story here is not the headline. The market is reacting to that. Maybe it's the algos. Let's get the humans back in the room, back into the trading, and look through this report. This is a slowdown and a little bit disappointment on the private payroll side. You know, you look at private services, it's well below 68,000. It's well below the 6-month average. Not like earth-shattering here, but this is the slowing in the job market that we are expecting. The market reaction is trading off of the headline, but I think the story here is much more about private payrolls, and that is actually a very different headline. Now we'll see if the market eventually picks up on that as the end of the day.
Jeff, you're right. I always say it. So let's rewind 15 minutes. The first move is not always the right move. So let's wait and see what happens later in the day. There you go, Jeff. I got it out. Jeff, let's talk about what we're seeing in private payrolls then, and talk about this move in the market. Would you fade what we're seeing? High yields at the front end. Would you fade what we're seeing in the FX market? A stronger dollar?
Yeah, I mean, that's basically my point, is that the initial reaction here may be a bit overstated with regards to repricing. Now, I agree with you. I think July may have been, overstated to begin with. But I think the broader story here is the slowing in the payrolls that we've seen for some time. I think it's actually confirmed by this report. And then I want to reemphasize what Torsten just said, because I couldn't agree more, that it's really going to be about profit margins and what we learn from corporations. I think you used, Torsten, the pig and the python. That's exactly it. I mean, we're still waiting for the impact to show up. It's been showing up, and you know, the other story around payrolls is they've been overstated, and so the big question is there an underlying weakening here that is a little bit greater than what is anticipated? I think the story here today of headline versus privates is kind of throwing more confusion in there. The revisions were a surprise to the upside. People looking for, you know, the revision story to show up, so that was a little bit stronger than expected. But I think it's really going to be about the corporate reaction here. And it's been, as we saw in the JOLTS data, you know, it's been a pretty stagnant, very, you know, benign kind of layoff environment. We have to see whether or not that is maintained.
But Jeff, isn't this kind of conducive to risk assets? And I say this at a time when you have a potentially stimulative bill coming out of Washington, D.C., albeit increasing the deficit. But you have sort of steady, if slowing, growth at the same time that you have a Fed that is poised to cut rates in September and potentially again later this year. Isn't that potentially still okay for everything to continue on the status quo?
Well, yes, in some sense that's the case, but it's already well into the price. So you look at like the performance of cyclicals versus defensives, for example, you know, you're seeing, you know, expansionary type moves in the face of that. You know, you said slowing but steady. I'd emphasize more the slowing. You know, most of the economic data is slowing, and that's what the payroll data here is validating. Now, it's not the end of the world, and it's not saying the sky is falling or there's recession, but this is consistent with a mid-cycle slowdown. So there's a little bit of a disconnect between kind of what we're seeing in valuations and what we're seeing in terms of the slowdown. And that doesn't necessarily, you know, mean you jump in with both feet and everything's sky is clear. You got to take a little bit of caution with respect to what's in the price versus what we're seeing in terms of the macro backdrop.
Hey, Jeff, appreciate it. Jeff Rosenberg there of BlackRock. The message you sent earlier on about 2 hours ago.
Which one?
Which is basically the data of the market are on 2 different pages.
Well, exactly, and this is partly because the market right now is looking to AI, is looking to different advancements, is looking to good enough, and the economy is looking at a very different backdrop where you have very low hiring and very low firing, and that at some point you have to have a meeting of the two.
Stephanie, you heard Jeff there, the distinction, headline payrolls versus private payrolls. You talked about it briefly as well. 2 different stories.
Kind of, to some extent. The government, the strength in government specifically tied to education was probably a seasonal quirk. Totally agree with that. The fact that private payrolls are in the 70s shouldn't be that alarming, though, because we know that the steady state pace of payrolls growth has come down. We should be concerned if it was stronger than that, because we don't have the labor force to support it. That if it was running notably above 100,000, you're going to start running into problems with inflationary pressures picking up.
Torsten, you've been making the argument that unemployment will climb. You're expecting it to rise in the months to come. What convinces you of that at the moment?
Well, the problem also with this story, with the data today, is that the AI story is just not playing out. So that means that we're not seeing people losing their jobs and the unemployment rate going up because of that factor. The expectation from our side was that there was a slowdown in demand that pushes the unemployment rate higher. But the fact that not even the AI story is showing up here, and it really is mainly a story of just a simple decline in labor force participation because we simply have a smaller labor force. And also the added issue here, government employment going forward. If we're now also going to hire more workers for ICE, if we're going to hire, generally speaking, at a number of different fronts with a huge budget increase, we could also now begin to spend much more time over the coming months on thinking about what's going on in the private sector employment numbers relative to the government sector.
Are you changing your mind then? Because you've been talking about stagflation for a while later this year. Is there a challenge to that right now?
So on the inflation side, I mean, Jay Powell in Sintra just a few days ago said again that he expects a meaningful increase in inflation. He said that at the congressional hearings. He said that also at the press conference. So we still have, if the Fed chair says, I expect a meaningful increase in inflation, that's something we should take very seriously. So to what Jeff's point was exactly that I still think that we're waiting to see what was the corporate response in the second quarter to tariffs. And tariffs, yes, it may seem like it's behind us. Uncertainty certainly looks better. We can begin to talk about now with this report what that means for July the 9th and the deadline next week. Yep. But the conclusion is, if we at least at the moment still have a question mark around how did companies actually respond to tariffs, I think it's too early to take the champagne bottle out here and say, this is all over.
Torsten Slok, Stephanie Roth, to the two of you, thank you. Don't pop the champagne just yet. When are we? I think we're about 12 days away from numbers from JP Morgan when we start to hear from corporate America about what the plans are for the next several quarters and beyond.
Yeah, July 15th, you start to kick off those bank earnings. Then you see whether it's profit margins or whether they're going to just pass it along to consumers, less in the banking sector and more in others. I'm sitting here thinking, how do you price in or how do you factor in slow-moving changes that are seismic in monthly data? And I think this is the reason why everyone's heads just kind of spinning, because you have all these stories that make perfect sense and these theories, but the numbers aren't really catching up.
So what do? You get to the beach. If you're not already left, all right? I think a lot of people have already left, haven't they? If you're still with us, thank you. Take us into the car with you. Nice journey with Bloomberg TV in the background. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John, just a quick recap of that data. The U.S. added 147,000 jobs in June. That was higher than expected. May payrolls were also revised higher. The unemployment rate, that came in lower than expected. But labor force participation is down, and average hourly earnings fell just slightly. The report prompted traders to scrap wagers on a Fed rate cut later this month. Elsewhere, President Donald Trump and Ukraine's Volodymyr Zelensky are expected to hold a phone call on Friday. The FT reporting that the world leaders will discuss the U.S.'s decision to pause some key weapons deliveries to Kyiv. The Ukrainian president will reportedly raise the idea of a potential future arms sale. DeepSeek is ramping up hiring. The Chinese AI startup posted 10 positions on LinkedIn, signaling that it's looking for talent outside of its home market. Similar jobs were posted earlier this year on Chinese recruitment sites. The positions are based in Beijing and Hangzhou. And that's your brief, John.
Danny, thank you. Appreciate it. Have a nice long weekend. Up next on the program, setting you up for the day ahead. Plus, Bloomberg's Tyler Kendall tracking the latest in the House. House Minority Speaker Hakeem Jeffries is still speaking as we wait for that final vote on the one big beautiful bill.
Today's CFOs are reshaping the C-suite, Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this
In Washington is driving Wall Street. We draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Just about holding on to gains here in the equity market following that decent, solid upside surprise on the headline number, at least, in the payrolls report. And on unemployment, the right kind of downside surprise. Equities positive by 0.2%. Your trading diary for the next 24 hours and a sneak peek of next week. The House expected to vote on the president's tax bill any moment now. Sprinkler data at 10 a.m. Friday, of course, markets close. Looking ahead to next week, the president's tariff deadline. Tracking everything down in Washington. Bloomberg's Tyler Kendall. Hey, Tyler.
Yeah, hey, John. Well, we're still waiting for Hakeem Jeffries to finish speaking. His magic minute is now verging on to 4 hours. I'll also point out we're just minutes away from the House being fully in session for 24 hours. And what he's doing right now is he's previewing Democrats' argument against the One Big Beautiful Bill as it does appear poised to pass. We do have some new reporting for you. Steve Scalise telling Bloomberg News on the Hill just minutes ago that ultimately what helped to get the logjam clear, get these holdout Republicans on board as we expect them to be, was President Trump telling them that he's done negotiating and that they have to get on board to pass his agenda.
Tyler, we'll be tracking this for you throughout today, hopefully for not much longer. Tyler Kendall there of Bloomberg, thank you. We were talking about it briefly. The president emboldened. This is about to pass, we assume. Decent jobs numbers this morning. On to next week. It's going to push a little bit harder on tariffs.
At a certain point, we're not seeing the effect of tariffs come in unemployment or in inflation. You have to wonder what that does to his agenda.
You ready for the long weekend? I think we're all ready for the long weekend.
You don't even have to ask. Come on.
From New York City, thank you for choosing Bloomberg TV. Have a wonderful long weekend. Enjoy the July 4th holiday. We'll see you next Monday from New York. This was Bloomberg Surveillance.
Is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books. What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
We got a blowout jobs number. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a surprise report. The U.S. added a whopping 147,000 jobs last month, which was well above the estimates. Meanwhile, on Capitol Hill, a final vote could come this morning on President Trump's big, beautiful bill. And on the trade front, bargaining chips. The U.S. lifts export curbs on China for semiconductor design software. Katie, what are you watching?
A lot to keep an eye on this morning, including on Datadog. AI stocks and chip designers poised to benefit from the news. Now, that marks a shift in the U.S.'s approach to export controls. You can see various chip stocks really rising right now, and I was a little bit early, but I am excited to talk about Datadog.
Yeah, well, let's talk about it right now. Datadog will replace Juniper Networks in the S&P 500 on July 9th, that fateful day, as Hewlett-Packard closes its acquisition on Juniper. You can see, as a result, Datadog shares are rising more than 10%. Katie?
We'll dig into that, but let's get back to the story of the morning, and that is that jobs number coming in hot, blowing past forecasts. Let's break down the data with Michael McKee. He is our international economics and policy correspondent. So, Mike, 147,000. The estimate was for 106,000. Where exactly did all this surprise strength come from?
Aha. I'm glad you asked. As BlackRock's Jeffrey Rosenberg said, it is not the headline number that we care about. It is the private sector payrolls. I'll get to that in a second. Let's just run through the numbers. 147,000, as we said. Unemployment rate falls to 4.1%. That's what everybody's trading on. Average hourly earnings come in a little weak. Jobless claims for last week do fall a little bit, and continuing claims, no change at all. So basically, kind of tells you it's a status quo labor market, except for this. What Mr. Rosenberg is pointing out is that government employment was up by 73,000 during the month, so half of what we got. And that was mostly state and local, and a lot of that in education. Private payrolls up just 74,000 during the month. The labor force fell by 130,000, which is the reason that we saw the decline in the unemployment rate. The foreign-born labor force falls for the third month in a row, 134,000 fewer people than last month, and maybe that is due to the immigration enforcement. Healthcare and social workers, your biggest job category besides the government workers, as always, up 58,000. So it is a story in two parts.
All right. Well, it looks good, certainly, to markets. Michael McKee, thanks very much for that. We welcome now our Bloomberg TV and radio audience, or we are going to welcome them in just a moment to talk to Stephen Myron, because this report really was better than any of the estimates that I saw, and certainly any on our team.
And you can see that surprise in the market reaction, futures flying, yields flying, as well as traders sort of reprice those July rate cut expectations.
Absolutely. We now welcome our Bloomberg TV and radio audience worldwide. I'm Matt Miller alongside Katie Greifeld, and joining us first on Bloomberg to discuss this jobs report and the U.S. economy, as well as the big, beautiful bill, is White House Council of Economic Advisors Chairman Stephen Myron. Stephen, great to get you on the program this morning, especially when we see such a positive jobs report, 147,000 jobs and a lower unemployment level. What is driving this?
Good morning. Thanks for having me. Look, as you said a moment ago, this report was better than 78 out of the 79 forecasts that came into the Bloomberg consensus, right, into the Bloomberg forecast. And so what we see is an economy that continues to defy expectations, continues to defy, all the doom and gloom that's out there, whether it's about the border or immigration or tariffs. This labor market continues to power ahead. And, something else that you guys mentioned, that, Mr. McKee mentioned about the foreign-born labor force, I think there were tons of predictions that there'd be a disaster in the labor market because of the border policies, and nothing could be further from the truth. The economy continues to create jobs, and if you look at the details of the jobs, all of the job gains since the president took office are due to native-born Americans, and there's actually been a decline in foreign-born workers, which means that all of the benefits of the expanding economy are accruing to Americans instead of migrants.
Stephen, I do want to talk a little bit about what this means for the Federal Reserve. We know the position of the administration is that Jerome Powell and the Federal Reserve should lower rates here, but you take a look at the numbers we got this morning, that headline blowout print, the fact that the unemployment rate is now 4.1%. What would be the case to lower interest rates here?
Well, that's a great question. I want to be clear up front that the Council of Economic Advisors does not tell the Fed what to do on interest rates. But nevertheless, I talk about the economy. And, to me, it looks like an economy that's normalizing. This is a normalized pace of job creation, a normalized labor market. And the inflation rate has been running at a 1.5% rate since, the headline CPI has been running at a 1.5% rate since the president took office. So that's an economy that's normalized and is sort of maybe even running a little bit below where the Fed would normally think about inflation ideally settling. And so I think it's only a matter of time until interest rates normalize as well. Now, I want to be clear, I'm not telling the Fed what to do, but, I would just make that as a prediction.
Well, but we still have 3% inflation, right? Average hourly earnings were up 3.7%. And the president has asked the Fed not just to cut rates, but to cut them by 3 full basis points. In what world is that a good idea?
Well, it's an idea. It's a good idea in a world in which the economy is normalized, and policy will eventually catch up and normalize as well. And as I said a moment ago, inflation has been running at a very subdued pace since the president took office. It's been running at 1.5%. And I also want to emphasize that the president's suite of supply-side policies, through providing tax incentives for investing and building out the capital stock, deregulation, cutting red tape so that businesses can produce more with the same amount of resources, energy abundance, bringing gas prices down to the lowest price at the pump since 2021. These are all profoundly disinflationary. When you push out supply, you get lower price pressures. And so it makes complete sense to expect inflation to continue to normalize, to continue to run at a reasonable pace. Because if this is the opposite of what the previous administration did, where they stimulated demand into a rigid supply side. Instead, we're expanding the supply side, and that's going to reduce price pressures.
But I just want to follow up here, Stephen, because you got your PhD at Harvard under Marty Feldstein, which is a very good school. Can you imagine if the Fed cut 3 full percentage points? I mean, that either causes an overheating in the economy or chaos in the bond market.
Well, I think it depends. It depends where neutral rates are and how restrictive policy is. And as I said before, there's accumulating evidence that the economy is normalized. So, I think it's only a matter of time until interest rates follow. And as I also said, I think that, it's important to think of inflation as being not purely a monetary phenomenon. That's a bit of a fallacy. Fiscal policy plays an enormous role. And if fiscal policy, if government regulatory policy can push out supply, that brings downward pressure on prices. If you don't have enough goods goods and services and you make it easier to produce more goods and services, you get more goods and services and therefore lower price pressures. It's basic economics, supply and demand. And if you push out supply, there's less price pressure.
Stephen, I do want to get back to the details of this jobs report, but before we do, it seems like what you're arguing is basically that the Federal Reserve, and not that you're telling them what to do, but it seems like your argument is that they should normalize interest rates, get back to neutral, which does seem different than what we're hearing from the president himself, that they should not just ease policy, but ease it very aggressively.
Yeah, I mean, look, I think that there's a strong argument for the things that I just mentioned about policy normalization, and I think there's also a strong argument that the Fed has had a mixed track record in recent times of properly understanding the effects of fiscal policy. I mean, the president was right in 2021 when he said that fiscal policy was on a disastrous track and it was going to create massive inflation, and the Fed caught up to his view, which turned out to be correct, but it took them a while, and arguably they were too late. And I think again, the Fed is overly fixated on tariffs. There's zero evidence thus far that tariffs are leading to any macroeconomically significant inflation at all. You've got the Amazon, one of the Amazon CEOs coming recently and saying that inflation is not really showing up in their sales. You've got, evidence from high frequency prices in some of the research by my former grad school classmate Alberto Carvalho and others, showing that there's really only noise in terms of inflation of imported goods. And so there's just no evidence. And if you go back to 2018, 2019, same thing. We ran this experiment already. We have historical evidence. There was no material macroeconomically significant inflation, and yet the Fed is fixated on what's ultimately a small change in policy, a 10% tariff, whereas the other macroeconomic consequences of the other policies, deregulation, tax incentives for investment, these are going to be massively disinflationary, and I don't think that there's really a necessarily great understanding of the effects of fiscal policy on inflation nor on growth, and this is why everyone gets the growth forecast wrong over and over and over again about the effects of taxes on growth and revenue.
I'm glad you brought us there, and you did your dissertation on that, households reacting to federal tax policy. In terms of tariffs, we've been talking about this. We're all positively surprised. Companies have had huge margins, and they're able to absorb, it looks like, some of that into them so far. In terms of growth, when we cut $4.5 trillion in taxes over 10 years, but then only reduce spending by $1.2 trillion, isn't that a red flag? I mean, historically, you look at the Reagan tax cuts, we saw exploding debt and deficit from that. You look at the Bush tax cuts, we saw an extra $6 trillion in deficits after those. You look at the 2017 TCJA, we have seen another $1.8 trillion added to the deficit. I mean, can you point to a time in the U.S. history when cutting taxes but not meeting those cuts with requisite spending cuts has resulted in the kind of growth that you're forecasting, 4 to 5% of a dynamic growth boost?
So that growth boost is over a 4-year period, and so if you divide it by 4, it's about a percent over that. It's about a percent over that period. But I think that we've got plenty of good evidence, right? So first of all, our forecasts are that we'll get in the neighborhood of 2.8%, close to 3% growth over the next 10 years as a result of the full suite of the president's policies. But that's exactly what the growth rate was in the first term until COVID. The GDP growth in the president's first term from 2017 to 2019 was 2.8% annualized over that period. And I don't think anyone thinks that we can blame COVID on the Tax Cuts and Jobs Act. But it gets better when you look through the pandemic disruptions. There was no discernible decline in revenues as a result of the Tax Cuts and Jobs Act. Revenues as a share of GDP was 17.1% before the Tax Cuts and Jobs Act, and it was 17.1% last year. Corporate revenues went from 1.6% to 1.9%. So the corporate rate was cut enormously. There were huge incentives for investment. There were, reductions in statutory and effective rates, and yet corporate revenue increased as a share of the economy. And this is exactly the type of activity that you want to see when you think that tax cuts, when you think that deregulation, when you think that energy abundance, when you think that all of these things are going to boost economic growth, and that brings in more revenue.
Well, Stephen, I hope to continue this conversation with you soon. Really appreciate your time this morning. That is White House Council of Economic Advisors Chairman Stephen Myron on that blowout jobs print that we got for June. Now let's get to Capitol Hill as the House nears a final vote on President Trump's tax bill. Bloomberg Washington correspondent Tyler Kendall joins us now with the latest. And Tyler, it's my understanding that Hakeem Jeffries is still speaking. What is the latest here?
Yeah, hey, Katie. He is still speaking. He's afforded something known as the magic minute, and that magic minute is now verging on past, at this point, actually 4 hours, as we should also say that the House has been convened for 24 hours since it was this time yesterday that they started to gavel in. And what the Democratic leader, Hakeem Jeffries, there is doing is he's essentially previewing Democrats' arguments ahead of the midterms as they try to use messaging around the one big, beautiful bill that they're going to campaign on, because at the moment it does appear that the package is poised to pass. Now, once Hakeem Jeffries is done speaking, House Speaker Mike Johnson might take the mic. It depends, since we know that Republicans want to get this finalized vote out as quickly as possible. But once he's done, we are expecting to move rather quickly to the vote on finalized passage. And the number we're going to be watching for is 217. Mike Johnson can only afford to lose 3 Republicans. And if we use a procedural vote that we saw this morning as a sort of test, it appears he is going to clear that threshold. He only lost 1 Republican vote. It wasn't a member of the House Freedom Caucus or a Republican pitching themselves as a fiscal hawk. It was actually Congressman Brian Fitzpatrick. He represents the 1st Congressional District in Pennsylvania, and he has raised concerns about what changes to Medicaid in this bill will mean for his constituents. And I'll point out, Matt and Katie, he represents a district that President Trump actually lost in 2024, which brings up this conversation looking ahead to how this is going to factor in the midterms.
We are expecting this to go through and then get to the president's desk. Do you know, Tyler, what kind of pomp and circumstance we're going to see when President Trump signs this bill?
Well, we are expecting some sort of signing, of course, on July 4th. This was always a self-imposed, but also a symbolic deadline for this administration. So I would expect some sort of a signing ceremony, likely at the White House and likely with the congressional leaders flanked besides him, because we have to say President Trump had a really big push to get this bill over the finish line. We know that he was calling members directly yesterday. He invited them to the White House, and then the administration actually dispatched administration officials up to the Hill in order to get members on board. Our understanding is that they spoke a lot about the fiscal trajectory of the country, similar to the conversation you just had with Stephen Myron. We expected that they spoke a lot about this idea of stabilizing the debt to GDP ratio, talking about tariffs as a revenue raiser, things like that, that ultimately got those fiscal hawks on board.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there talking to us about the legislation, $3.4 trillion tax bill expected to move through the House and to the White House soon. Coming up, chip makers are rallying after the Trump administration curbs requirements for chip software sales in China. We'll take a look at tech next. This is Open Interest.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Well, the Trump administration is lifting requirements for chip design software sales in China. This move will allow companies like Synopsys and Cadence Design Systems to resume business in the country, and as such, you can see that both stocks jumping pre-market. Joining us now with more is Bloomberg Tech co-host Ed Ludlow. And Ed, we know a lot of these chip companies have been caught firmly in the middle of these trade negotiations between the U.S. and between China. Looks like we're getting a little bit of relief this morning.
That's exactly right. The original restriction on EDA, electronic design automation software, kind of came in the tit for tat in May, where there was a concern about rare earths on the China side. It was kind of like the last remaining tool in the chip restrictions bucket. So we know that Siemens, for example, has already started doing business again in China. Cadence and Synopsys are now going to start working towards that. The software is important, right? Like the cutting edge chip of today has billions of transistors, and the human brain just simply cannot design it. So the context you need to know is that there is some concern that allowing the Chinese access to these software platforms gives them some kind of ability to claw back the ground that they've lost in America pulling ahead in chip design. But in reality, this was kind of more of a political bargaining chip, both in London and the Geneva talks that took place in prior months.
What about the big question, Ed, of NVIDIA selling their highest tech chips into the Chinese market? Are we going to see that barrier lifted?
So I think the latest thinking from the administration, and again, this is based on my conversation with sources, David Sachs came on the show the other day, is that the export controls as they stand now are going to work, right? The backdoor concern was that allowing the Gulf states, in particular the United Arab Emirates and Saudi, access to lead-edge chips might be some kind of backdoor access for China. But as it stands, that there isn't sort of any evidence that that's the case necessarily. We haven't replaced the diffusion rule, and there isn't any sort of codified plan of action as it stands yet, specifically to restrict in a new way, new rules, new parameters for China. And whether NVIDIA in particular, because they have a monopoly in this market for AI accelerators, comes up with some kind of new chip for China, we do not know yet. There are rumblings that they're working on it.
All right, Ed, I know you'll be all over this at 11 a.m. You can catch him there. That is Bloomberg Tech co-host Ed Ludlow. Let's take a look at some other movers on our radar this morning. I'm keeping a close eye on Datadog, which is replacing Juniper in the S&P 500. Juniper is being acquired. That's also to the disappointment of Robinhood investors. There had been some speculation that perhaps Robinhood would be added to the S&P 500. The stock has been on an absolute tear. That was a factor there. Now you can see a little bit of disappointment. And Datadog just cheering the way, up almost 10% pre-market.
Datadog has been Robinhood has been absolutely ripping it, and Datadog is doing well today. We're also watching Olo, which will be acquired by Thoma Bravo for $2 billion in cash, and as a result, this, which is kind of a smaller stock, is up, and now it's a bigger stock.
Yeah, $1.5 billion market cap as of yesterday's close. Apparently, it provides software solutions.
Solutions.
Yes.
That's what we all need.
So important. Coming up, JP Morgan's Gabriela Santos walks us through the jobs report reaction and her earnings outlook as tariffs loom large. That conversation up next. This is Open Interest.
of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back to Open Interest. We're keeping a close eye on futures ahead of the opening bell after that blowout jobs print. You can see the S&P 500 extending its record run right now, up about 0.3%. The bond market is where a lot of the action is. 2-year Treasury yields higher by about 9 basis points as traders really scrap those July rate cut bets. Let's break down the reaction with J.P. Morgan Chief Market Strategist for the Americas, Gabriela Santos. Great to see you in person.
Good to see you.
So we're running into the break, but just give us your reaction to the print this morning, because looking at the market, it seems like everyone was surprised.
I think it was good. I think it was better than feared. We had been hearing that whispers were that we would get a sub 100,000 print. If you look at the 2-year yields, they had already moved lower by 30 basis points since early June. And we had added that extra possibility of a rate cut in July for about between 2 or 3 cuts this year. So we're unwinding some of that with an upside surprise, but I don't think we should get too excited either. It still confirms this trend of a cooling but not cool labor market, especially if you take out the jobs that were added by state and local. You just look at the private jobs, 75,000, it's fine. And especially very heavily.
It's still half of the average I just looked at the average of the last 4 years, and clearly that includes post-COVID recovery, but it's 314,000, so it's not that.
Right, and especially by industry, it was very concentrated in healthcare and social assistance. That's where you still have pent-up demand. The other industries, you didn't see job losses. It's just that still that message of slow to higher.
Nonetheless, we continue to see new records on the S&P 500. We're going to talk with Gabriela Santos about that. She stays with us through the open as futures point to another record finish. This is Bloomberg.
cidade estava sitiada.
Nisso eu começo, eu não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are pointing to yet another record on the S&P 500, 62.93, 62.94 on the futures there. NASDAQ up even more, 0.4%. And so we're going to see a higher cash trade as well after we start to trade. You hear the opening bell, and on the New York Stock Exchange, this is so cool. I didn't even think about the fact that next year is the 250th anniversary of America. And so, Sailforth 250 has come to preview that anniversary at the New York Stock Exchange. You can see a ton of U.S. Navy and Coast Guard members there on the floor of the NYSE. Down at the NASDAQ, Arrive AI ringing the opening bell. I'm guessing they're a software services solutions provider. The stock is down 20% since they went public a couple of months ago. So, Katie, what are you watching? More like games.
I am looking at the chip stocks this morning. Of course, we got the news that the U.S. is lifting export curves for chip design, and you can see that in China specifically, and you can see that reflected in the shares right now. We threw NVIDIA up there, but you can see the bigger beneficiaries are Synopsys, Cadence Design, both of those stocks up 4%, 5.2%. As we were discussing with Ed Ludlow, Matt, we know that these stocks have been really in the crosshairs of the trade talks. And a little bit of relief this morning.
Yeah, a little bit of relief there. And we're also seeing, I think, a lot more certainty, and we're going to get to that in just a moment with Gabriela Santos. Datadog will replace Juniper Networks in the S&P 500 on that fateful day, July 9th, as Hewlett-Packard closes its acquisition of Juniper. As a result, the dog gets a boost of 10%. As Katie mentioned, Robinhood did not get that, but that stock still absolutely soaring. We're back with JP Morgan Chief Market Strategist for the Americas, Gabriela Santos, and it's the certainty, I think, Gabriela, that makes this market happy, right? As we get the passage of the big, beautiful bill and see what's inside it, as we get closer to that July 9th date and start to get deal announcements from President Trump, can this market continue to power higher?
I really think the market has really taken its cues from being past peak uncertainty. We generally understand the contours of tariff, immigration, and fiscal policy. And now it's back to focusing on the stock-by-stock impact of policy. So policy going from an acute to a chronic issue for markets. And most importantly, moving on to what we were focused on before. So the long-term themes, AI being one of them, higher defense spending, deregulation, benefiting the financial sector. So it's really back to business as usual. It's still a resilient market. but not an unchanged market beneath the surface.
Yeah, it's interesting to hear you say that, these sort of long-term policy issues, very idiosyncratic. We were talking about the insurers yesterday, for example. It feels like
Centene.
Centene, never forget it. It feels like renewables are just a hot potato. And given those sorts of headwinds that you're encountering on a stock-by-stock, industry-by-industry basis, where do you have high conviction right now? Where is insulated from that type of noise?
So it's hard to say it's a country overall or a sector overall, but I think some themes we can tease out. It's large cap over small cap. So you still have pretty soggy economic growth, you still have elevated rates, and you still have input costs going up through tariffs. That's still an environment where we feel a lot more comfortable with large caps leading and small caps still underperforming, like it has been the case this year and for a few years. Besides that, I think leaning into areas of the market where there are other supportive tailwinds to really propel revenue growth, earnings growth. And I think this is where the AI theme really comes back. And really the new winners from AI, right? Let's abandon that holistic Mag 7 concept. Let's think about who are the new winners, the adopters who are monetizing it, and the digital and physical infrastructure winners. I also think we can look to other regions where valuations are already pretty discounted and where things are getting incrementally less bad. So that really leads us to Europe, to Japan, to India as another example. So those are areas where I think policy is a bit less top of mind.
I want to marinate on small caps for a little bit, because not that I'm pushing a narrative, but when we started this show about a year ago, I really bought into a lot of the bullish cases we were hearing on small caps. You have this valuation disconnect. These companies are more domestically focused than maybe some of those large caps. Just felt like the stars were aligning for the little guys. Turns out it was another false dawn. Why can't these small companies get off the ground?
I think if you think about when small caps work, it's when economic growth is re-accelerating, which we never expected for this year, so we were not on the small cap train. You need slightly lower rates because they're very financed by bank loans, floating rate, also not the case, and modest rate cuts is what we expect. And then you also need a high amount of risk appetite, since a very high share of these companies are unprofitable.
Got to be brave.
So it's not quite there at the moment, despite the valuation signal having been there for a while. A way we think about investing then in smaller companies with high growth potential is much more in private markets. So looking at VC, private equity, private credit, and companies are staying private for longer. So that's really more and more the market to look for that opportunity.
Gabrielle, I keep going back to the IN page, the Bloomberg Index browser on the terminal, which is exceptionally boring, right? I mean, if we show a picture of it, you'll see just how boring it is, but the year-to-date return column is amazing, right, for fixed income. And you've called the first half, I think, revenge of diversification, right? Does this trade have legs? Do we continue to see this as a good buy?
Yeah, if the movie of the first half of the year came out, it would be called The Revenge of Diversification.
Yes.
Especially in the first quarter, if you looked at the scoreboard, only core fixed income was positive. Because then it was much more a risk aversion, concerns about recession risk rising, so bonds really showing why they're there in the first place.
But high yield.
High yield, really there because of really the carry, right? The super attractive all-in yield of over 7%. We still think that's interesting as we settle into higher rates and lower spreads. And then also diversification by style and region.
Yeah, EM has been crushing it.
EM, developed ex-US, and not all driven by the currency, although that's been a huge story, currency diversification with the dollar down 11%, but also some incremental, less bad, you could even call it positive changes in a place like Europe. So I think really some of the things we were questioning the last 3 years, especially around diversification, they really came back to the forefront. We still think there's plenty of scope to rebalance in a lot of global portfolios.
You know, it's funny to hear you say that, talking about diversification when it comes to region as well. We were talking to Rick Reeder on Monday. He said that he owns more European debt than he ever has before. Part of that comes back to the currency, but definitely people are taking a look.
Right, and I mean, to be fair, you've been saying this for a long time. What about the dollar, though, Gabby? I mean, does that continue. We've seen a 10% drop from the high, and it's been a pretty sharp drop over the past few months. But if you back out and look at, you know, a 25-year picture of the dollar, we're still in a relatively strong place.
That's why I think this is still a drop in the bucket of this rebalancing in currencies and global equity markets because things had gotten so stretched in the direction of the U.S. So this is where I'm not a buyer of the end of U.S. exceptionalism. I think it's just a normalization of U.S. exceptionalism after a very abnormal time period. And if the dollar is a great place to look.
Here's a 30-year chart, by the way, so you can see, you know, my point.
Yeah, exactly. It's been 15 years of solid dollar appreciation. It's a drop in the bucket so far, what we've seen this year, a lot more room to go. And if you stretch it back even further, you would see that these things come in cycles. Before the financial crisis, we had nearly a 10-year period of dollar weakness. Dollar was still the reserve currency. It was just getting less expensive or more in line with fundamentals.
Oh, you ask and we deliver. 40-year chart of the dollar.
There you go.
All right, Gabby, that's a good place to leave it. It's always great to see you. That is JP Morgan's Gabriela Santos. Let's get to this equity market and that fresh record that we're eyeing on the S&P 500. You can see it's coming with pretty good breadth. You have over 370 names in the S&P 500 in positive territory right now, just 120 or so in the red. You take a look at what is leading us there, and it's all the names you would like to see. Amazon, Meta, NVIDIA, Microsoft, Broadcom, really pushing this market higher. Berkshire Hathaway had a rough day yesterday, but it's on the upside right now. Then you look at the downside. There are some tech names in there. I'm looking at Alphabet up there at the top, Home Depot too, but you compare that to the nearly 400 names that you have in the green, not making too much of a dent. Let's take a look at the sector level as well, because it broadly mirrors what I'm saying right now. More green than red. Consumer discretionary up at the top. A lot of that is Amazon. Industrials, tech, financials, the list goes on. You take a look down at the bottom, it's just consumer staples here, down about 0.1%. So really the net here, Matt, is that this is a very risk-on day.
Yeah, absolutely. And what an exciting day it is. Not only
early
is
close.
tomorrow, early close for sure. You can watch me and Romaine Bostick on television and radio from noon to 2. And to top it all off,
tell me,
chip makers are rallying as the Trump administration lifts export curbs for chip design software sales in China. More on that next. This is Open Interest.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta. And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Welcome back to Open Interest. Take a look at this rally right now. The S&P 500 higher by about 0.5%. The NASDAQ 100 not too far ahead of it. And the small caps really leading the charge here. The Russell 2000 up 0.6% after that blowout jobs print. We'll see if that's sustainable. It just has to stay this way until 1 p.m. today because it's an early close on this July 3rd. But let's get to our top calls. Some of the analyst action in focus this morning. And first up, FedEx getting double upgraded to a buy over at BNP Paribas. The analyst there says that the stock is oversold and expects that FedEx will continue to outperform UPS. FedEx shares up 2% or so. Next up, Morgan Stanley naming KKR as its top pick among asset managers. The firm cites improving macroeconomic conditions and says that the company's diversity is positioned to take advantage of, quote, secular tailwinds. You can see shares up about 3%. And we end with Needham dropping its bearish view on Meta and moving to the sidelines with a hold rating on the social media giant. The analyst cites strong labor productivity, but remains cautious on its margins and its free cash flow pressure. Shares up about 1.4% for Meta. That has been a hard stock to have a sell rating on that.
Let's stay, Katie, in the world of technology. I promised, and now I will deliver. Synopsys and Cadence Design Systems are rallying as the U.S. lifts export curbs for chip design software sales in China. The move allows the companies to resume services in China following a trade deal between Washington and Beijing. Joining us now is Mandeep Singh, Global Head of Tech Research for Bloomberg Intelligence. And Mandeep, these companies are indeed rallying on the news, and I suppose it's kind of an olive branch of sorts, but I'm waiting for the real news of NVIDIA being allowed to sell its most powerful chips into that economy. Are we going to get that?
Probably this is a precursor. I mean, we know the administration already changed their diffusion rules, so some of that demand, I think NVIDIA can ship to now outside of China, and it looks like things are going in that direction where they really want the companies here to succeed when it comes to AI and really tap into demand from everywhere, including China.
And I'm curious, I mean, with that in mind, how much does this matter for, you think about Synopsys and Cadence rallying in a big way today, but we know that trade policy is very fluid, especially when it comes to the U.S. and China. So as an analyst approaching this news, taking a look at the fundamentals of these companies, I mean, how much does this specific olive branch matter?
It matters because we know China is about 15 to 20% of Synopsys and Cadence revenue. And even in the case of NVIDIA, the guide that they gave us for the next quarter had China revenue almost go to zero. But anything positive would help them deliver a bigger beat. So from that perspective, it's incrementally, it's all good news when it comes to China and, the ability of companies to sell in that region.
Hey, I want to go deeper into AI by asking about Stargate, this partnership that President Trump announced at the White House a few months ago. Oracle has now made a deal with OpenAI, whereas the latter is going to rent an even bigger amount of computing power from the database supplier. 4.5 gigawatts. I think I'm still trying to get my head around how much is how much. What kind of power is that?
Well, so just to put it in context, overall U.S. data center power consumption is around 22 to 24 gigawatts. So we are talking about a pretty sizable, almost a 25% increment to the overall U.S. data center power consumption. But look, right now we are at a point where Anthropic just grew its revenue from $1 billion to a $4 billion run rate over a matter of 6 months. So the revenues are starting to show up for these AI companies. I mean, yesterday we were talking about Microsoft cutting headcount. So the cost savings are also starting to emerge. And that's why, you know, there is so much excitement around this infrastructure build out. I'm sure at some point we'll have some sort of digestion, but right now it looks like everyone is excited about adding more inferencing capacity. I'm still trying to figure out how the scaling laws are going to shake out this year, but clearly there's a lot of inferencing demand and it's showing up in the revenues of these pure play companies.
All right, Mandeep, really appreciate your analysis there. That is Mandeep Singh of Bloomberg Intelligence, where he leads global tech research. Let's kind of check on stocks right now broadly, because we're still mapping the reaction to what we saw this morning at 8:30 this morning. That big blowout jobs print for June, 147,000 jobs added, the unemployment rate dropping to 4.1%. It's hard to find too much to quabble about. You did see manufacturing, that industry, lose jobs, though, again, shedding about 7,000 there. But you can see the reaction in markets right now. The S&P 500 up 0.5%. The real reaction is in the bond market, though.
Yeah, for sure. We see yields soaring in the bond market. If you take a look at the WB page, I think there we go. The 2-year yield up 9 basis points at 38.75. The 10-year yield up 5.5 at 43.31. I wouldn't quabble on the jobs number.
What verb would you use?
I may quibble with it.
Quibble, quabble.
But what I would say is, while it's a 50% higher number than the whisper number than the survey, and while no one on our team guessed higher than, I think, 105, right? Joe was the winner with a guess of 105.
I did say once I saw everyone come in sub 100K that maybe it's going to be 145,000, but I was still off. The thing is, coming into this report, there was about a 25% chance that the Fed would cut rates in July. And you saw this massive plunge in the odds when we got the number, because July, we know that Jerome Powell said that he needed more data. He wanted to see this month's data. He has it now, and it's hard to build the case for a rate cut when you take a look at just how robust this labor market was.
Right. The point I was going to make is that we're still not even half of the average over the last 4 years.
Yeah.
And it's a little bit unfair because that includes, of course, just the rebound from COVID and not the drop. But that's 314,000 jobs over the last 4 years on average per month. So this isn't fantastic. It's just better than expected, which is what markets care about.
It's about the direction of travel. I hear what you're saying. Before I tease, which I am going to do, I will say we were talking with Mike McKee about how you should never trade ADP. This was just another example, that ADP print, the line to NFP, it's fuzzy or non-existent.
It's a mantra I will not forget.
Never trade ADP. Coming up, TripAdvisor jumps as activist investor Starboard builds a 9% stake in the travel site. We'll bring you the details next. This is Open Interest.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to Open Interest. We're keeping a close eye on shares of TripAdvisor. The stock on the rise as activist investor Starboard builds a 9% stake in the travel site. Bloomberg Deals reporter Crystal Seed joins us now for more. And it kind of makes sense that you would see such a pop when you consider how TripAdvisor has performed in the stock market over the past couple of years.
Yeah, it's down about 10% in the past 12 months. And today, this pop came from Starboard taking a significant stake. And this company, you know, it has the background as a review site, and it's really trying to transition into a booking site, trying to get that revenue that Airbnb, like Booking.com or Expedia has, but so far it's lacking its peer. We don't know exactly what Starboard's thesis is, but it's definitely saying that it's undervalued.
But there are other booking sites like Airbnb, Booking.com.
Stiff competition.
Yeah, like, isn't that a crowded field?
It is a crowded field. Also, if you remember, TripAdvisor actually got spun out of Expedia in 2011. So it used to be a more consolidated space, and now it's gotten a little bit more crowded. What is also interesting is all of these companies are trying to get into the experience space at the same time. So Airbnb has launched their experiences or like themed houses, the same way that TripAdvisor has its own arms doing a similar business. And those actually are some of the biggest growth driver in the company.
Right.
So we're kind of probably just seeing that this transition of travel is becoming more experiential. The younger people are looking for new experiences versus sitting on a beach and going to a nice branded hotel.
I don't know, that sounds kind of nice. But Crystal, we only have about 30 seconds left. We don't know necessarily the details of what Starboard is planning to do, but what is their typical playbook when it comes to these activist situations?
How I look at it is that this is Starboard going back to its core. So it has gone after a really, really large cap like the Pfizer, like the Becton Dickinson of the world. And what Starboard has traditionally been really good at is like the smaller cap consumer facing companies, like what they did at Papa John's, where Jeff Smith at Starboard became the chairman. So we could well see something like this.
I've been using HipCamp.
Have you?
You know what that is?
No.
Crystal?
No, what's that?
So you use it like Airbnb, but it's for camping sites.
Oh, you have been camping
So
a
if
lot.
you want to go camping, I've been bringing my daughters camping.
It's intense.
It is intense.
Yeah.
Good one.
Thank you.
Crystal C. From the Deals team, thanks very much for covering this story. Coming up in the next hour, Julia Coronado on that surprise jobs beat and the changes that we've seen to the tax bill overnight. Plus, we're going to talk to Stu Leonard Jr. on food costs ahead of this 4th of July weekend and the CEO of State Street Investment Management.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Foreign and Central Portugal, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Stacey Lynn. For almost 5 hours now, Minority Leader Hakeem Jeffries has been speaking on the House floor, voicing opposition to the president's big tax and spending bill.
This disgusting abomination, the GOP tax scam, guts Medicaid, rips food from the mouths of children.
It is still unclear how long he'll go. Kevin McCarthy holds the current record for what's called a magic minute, clocking in at 8 hours, 32 minutes. That was back in a vote in 2021. CBS's Nicole Killian with more from Capitol Hill.
The GOP mega bill was considered after a day of delays Wednesday as Republican leaders and the White House worked to win over key holdouts who oppose the Senate's changes to the measure.
I would say those meetings are having a big impact. Members are moving to yes. Donald Trump is the best closer in the business, and we're going to get it done.
The president wants the bill on his desk by tomorrow. A surprising June jobs report showed 147,000 jobs were added last month, and the unemployment rate inched slightly down to 4.1%. Business analyst Joe Schlesinger says this means the Fed will likely continue to leave interest rates unchanged.
This report gives the Federal Reserve plenty of cover because with the job market remaining solid and inflation not yet showing any signs of tariff increases, the Fed can afford to wait and see how the data develop.
That better than expected report has the stock market in the green. The Dow right now is up 262 points, NASDAQ up 160, S&P 500 up 40. The Supreme Court has just agreed to take up a new case out of Idaho and West Virginia on which school sports teams transgender students can join. More than 24 states have enacted laws restricting transgender women and girls from participating in certain sports. Well, it's time to hit the road for the holiday weekend.
I'm Jim Crisula along Interstate 40 in Winston-Salem, North Carolina. AAA says a record number of Americans, more than 72 million, will travel for the 4th of July holiday. Average gas prices are down, and these drivers have noticed.
I'm happy that it's getting down there. It used to cost me over $80 to top off, and now it's a little over $35, so I'm not complaining. I'm getting twice the trips, essentially, for the same price.
Oh, no complaints.
Gas prices are at their lowest 4th of July level since 2021.
AAA's Robert Sinclair says there were fears the fighting between Israel and Iran would push the price at the pump up.
That did not happen, so there's kind of a return to normalcy that's happening as a result, and gasoline prices are going down and probably will keep going down further.